Good morning, everyone. I'm Alexis Christoforous.
And I'm Brian Sozzi, and this is the first trade for Monday, November 25th.
Merger Monday. Schwab and TD Ameritrade come to terms on a $26 billion takeover. That could mean a lot of changes for a lot of investors. We have the latest on what this could mean for you and your money.
That Tiffany twinkle. The stock is surging ahead of the opening bell after Louis Vuitton signs a $16.2 billion takeover deal. We'll dive into details.
And an Uber rebuke. The stock sliding in the pre-market after authorities in London stripped the ride-sharing giant of its license to operate there. We are live in London with the big safety issues behind the decision and how Uber is responding this morning.
Let's get a quick check of the futures here ahead of the opening bell. Dow futures up 74 points. The S&P 500 and NASDAQ also solidly in the green.
That's after China signaled it was making headway in addressing some of the Trump administration's biggest sticking points in a path to a trade deal. We're going to get more on the markets for you in just a bit, but first to today's big story.
Two huge deals to tell you about this morning involving some of the biggest names in finance and luxury goods. Louis Vuitton, the company behind Louis Vuitton handbags and Moet champagne, is buying Tiffany in a $16.2 billion transaction. We'll have much more on that deal in just a moment, but first, we have to start with the deal shaking up the world of online stock trading. Charles Schwab is buying TD Ameritrade in a $26 billion all-stock deal. Schwab stock is down slightly right now on that news, while TD Ameritrade is popping about 3.5% in the pre-market. Yahoo Finance's Jared Blickery is here to break this deal down. So, Jared, the first question is, what does this mean for the average investor?
Well, the average investor is already trading probably for free right now. Charles Schwab, they kind of rocked the industry back on October 1st, and they dropped their commissions to zero. All the competitors have followed suit. And really, Charles Schwab is in a good position here. They only derive about 6% of their revenue from these kinds of trades, from that revenue stream. And so now there's going to be consolidation. And they have chosen TD Ameritrade. There was rumors that maybe TD would get hitched with E-Trade, but that's not happening.
So this shouldn't be a surprise to us, and the fact that they all went to zero commissions. Basically, all of the discount brokers did, and some not discount brokers. Is this the only way for them now to really see growth, is by merging?
It could be. Think about Charles Schwab and what they can offer. They have their own suite of mutual funds and whatnot, and they can really offer these products to their customers. So it's really about assets under management. They're going to have something like $5 trillion, which is rivaling Blackstone right now, or excuse me, BlackRock, right, which has about $6 trillion. So, yes.
Jared, I was briefly able to hop on the conference call that's going on underway now discussing the transaction, and it sounds as though TD Ameritrade might be completely gutted. There are a lot of synergies here. It's close to $2 billion, a lot of cost cutting coming.
Yeah, and consider the fact that they also merged with Scottrade not too long ago. Right. There's just been a lot of consolidation. It has to do with the nature of electronic trading itself, which you could argue that it really started about 15 years ago with Reg NMS and how we have all these fractured marketplaces right now. This just makes the sense in the natural evolution of the game, though, that they are going to be selling their order flow to companies like Virtu Financial and also Citadel, and they're not going to make up the entire revenue stream that way, but they will make up a little bit.
What do you think it's going to mean, though, for individual investors? Because I see this and I say, you know what, now we have less choice.
Yeah, there is a little bit less choice. That's the kind of nature of consolidation. Also, there is an argument to be made that this will hurt the marketplace at least a little bit in terms of selling order flow because you don't have as much transparency. So there are arguments that I think will be made. Regulatory authorities have to approve this. And, Toronto Dominion Bank does own a significant portion of TD Ameritrade. And so this does have a few hurdles to cross now.
What does this mean to a company or companies like a BlackRock or Morgan Stanley?
Well, BlackRock is very much a different company than Morgan Stanley, which is mainly a broker and also a bank. But I would say BlackRock, they have a big competitor on their hands now, which is Charles Schwab. Of course, BlackRock is very big into ETFs and whatnot. And there's no denying that Charles Schwab is a big name, but really not in that same department. Overall, the average person, the average trader, probably not going to notice too much. But like I said, there is the argument to be made that this will hurt transparency in markets.
Anybody else you see hooking up in the industry? Where might might we see the next merger?
Oh, you want me to speculate here?
I do.
We still got E-Trade out there. Some of these smaller brokers are going to have to figure out how they're going to compete in this marketplace, and they do derive a
Interactive brokers too?
Yeah, Interactive brokers. They're more of a trader's brokerage house, so they're still going to be having client accounts that pay money for their trades because they get better execution. But I think the trend is definitely here. Unless you're an active day trader, commissions are going to be pretty much zero for the good time.
Definitely shaking up the industry with this $26 billion deal. Jared Blickery, thanks for putting it in perspective. All right, now on to our other big deal on this Merger Monday. Tiffany stock soaring more than 5.5% right now after LVMH announced it is buying the luxury retailer in a $16.2 billion deal. Now, there are hopes that LVMH might be able to turn things around at the struggling luxury retailer. Emily McCormick is in the newsroom with this story today. So, Emily, LVMH's CEO has had his eye on the U.S., we know, for a long time. Can he restore Tiffany to its former glory?
Well, that is the hope here, and this is a big bet on the luxury jewelry market. It's one of the fastest growing luxury industries in the world, and on China. So if we think about sales for Tiffany, those have been slumping pretty much globally, but if we look at mainland China, they actually have seen double-digit growth in the most recent quarter. One of the things that they've been trying to do there is really build out their millennial brand. That's something that LVMH will be able to help them do with the support of this highly capitalized company, market capitalization of about $220 billion, about 75 brands under that portfolio. And on LVMH's side, this is really going to help bolster their luxury jewelry brands. If we think about them, they've been a little bit less exposed to this area, especially when we think about some of their competitors like Richemont, which is the owner of Cartier. One of the things that CEO Bernard Arnault had said recently in an interview with Bloomberg is that he's really looking back to that acquisition of Bulgari by LVMH back in 2011 as the playbook here. And with that had really been around modernizing and expanding the product lines and really elevating that look to resonate with a global audience. Also been very focused on the communications and marketing side. We look at the results there. Sales had doubled for Bulgari since 2011 and profits increased fivefold. So hopefully we'll see similar results with Tiffany.
Emily, isn't the big risk here that they overpaid? This isn't where Louis Vuitton came out a couple weeks ago. This is a significantly higher bid for a company, to your point, that has been struggling the past couple of years.
Right. If we look at reports over the past couple of weeks, and if we look at this transaction deal now, that's at more than $16 billion, that it's an all-cash transaction at $135 per Tiffany share. Earlier, rumors had been around $120 per share for Tiffany, which would have been below the peak price that we'd seen Tiffany actually trade at. That was near $140. So there is a little bit concern on the valuation side, but if you think, and what analysts are saying is if you think about the value that LVMH might be able to unlock for Tiffany, it does justify the price that we're seeing today.
Welcome back, Merger Monday. Emily McCormick, thank you. Coming up here on the first trade, another major setback for Uber. What the ride-hailing company can do next after a big loss in London.
Time now to take a look at the European markets this Monday, see how they are faring. Things looking pretty good there with the FTSE 100 up about 68 points. We've got the CAC 40 in Paris adding 25, and the DAX in Germany up about 62 points. Yahoo Finance's Tom Belger is in London this morning. And Tom, Uber has been stripped of its license to operate in London over fears for passenger safety. The stock we see taking a hit here in the pre-market. What are the details?
Well, Uber's vowing already to appeal this decision to cut it out of one of its key global markets. Its CEO slammed this decision as wrong and says it's fundamentally changed already to address safety concerns. But what we've learned today is that at least 14,000 trips in London were taken with people pretending to be Uber drivers, uploading their own photos to actual Uber drivers' accounts. And those are effectively uninsured trips with strangers. And the transport authorities say it's unacceptable that the systems Uber has were so easily manipulated, even though the issue's now been fixed. Uber can continue to operate for now, though, while it appeals. And you'd expect something of a backlash to continue. Uber's retweeting customer support for its position. It's seen it's a union that represents drivers, saying this will be a hammer blow for 45,000 London drivers. And you could potentially see Uber reviving a petition it created around 2 years ago when it was first initially banned that had almost 1 million signatures. So that backlash potentially against Sadiq Khan, the London mayor, likely to grow. But you could see some of those drivers move over to other firms, and you're sure analysts say there'll be no shortage of other up-and-coming rivals nipping at Uber's heels and really keen to scramble quickly to fill the void if Uber does crash out. You certainly can't write Uber off yet, though. Shares might be down, but they've got 3 weeks to file an appeal. And if they manage to make changes in the period before that, or before the magistrates make a decision, they could well sway it their way. So while this has been rumbling on, or while this has happened now, it has been rumbling on for some 2 years since a ban was first proposed. But in practice, for most customers and for most drivers, things have carried on as usual. So who knows? We'll have to wait and see what happens.
Tom, simple question here, but Uber not operating in London, will that improve traffic?
I think it possibly will. One of the reasons they've cracked down on congestion in traffic in recent years has been the exponential rise in Uber drivers over the past decade across the capital.
All right, Tom Belger, thank you. Let's head down to New York Stock Exchange now and check in with Yahoo Finance's Inez Ferrer. Inez?
Brian, GE is tapping an outsider for that CFO position. Carolina Dybeck Hapa will be starting in early 2020. You'll recall that back in July, GE said that Jamie Miller would be stepping down after a smooth handover. And Dybeck Hapa is CFO at Maersk, and she also had spent 16 years at Assa Abloy. We're also this morning watching the medicines company up about 22% in pre-market. This is after Novartis said that it will acquire the medicines company for $9.7 billion, or around $85 a share in cash. And this will really help Novartis extend its reach into the heart treatment market. The medicines company is a New Jersey-based company, and they have an injectable treatment to lower cholesterol levels. And we're watching eBay this morning. eBay up in pre-market around 5%. This is after a Wall Street Journal report says that eBay is nearing a deal to sell StubHub to Viagogo. Now that's the Swiss ticket reseller, and this deal could be announced as early as today, and it would be for about $4 billion. This would be seen as a win for Elliott Management since eBay has been under pressure from activist investors this year. Back in March, they added 2 new board members, so certainly a win for those activist investors that had been wanting some sort of a spin-off of StubHub.
All right, Inez Ferrer down at the Stock Exchange, thank you. Lots of wheeling and dealing here ahead of the Thanksgiving holiday. Coming up on the first trade, Taylor Swift makes history at the American Music Awards. Your news bites are next. Let's take a look at today's News Bites. Pro-democracy activists have scored a huge victory in Hong Kong. Their preferred candidates won a majority of seats in the territory's local elections over the weekend, and turnout was exceptionally high, with an estimated 7 in 10 eligible voters casting ballots. Young people were among those who came out in force in the wake of months of protests. Defense Secretary Richard Esper has fired Navy Secretary Richard Spencer. Esper says he lost confidence in Spencer's handling of the case of Navy SEAL Edward Gallagher, who was accused of war crimes in Iraq. In his resignation letter, Spencer cited President Trump's decision to split with the Pentagon and defend Gallagher. Trump recently reversed Gallagher's demotion. Michael Bloomberg has officially joined the large pool of Democrats running for president in 2020. The three-time New York City mayor and billionaire businessman has already reserved $35 million worth of TV time for his political ads, a number that far exceeds his opponents. There are concerns about his late entry into the race, but the 77-year-old says he is a, quote, new choice for Democrats. And Supreme Court Justice Ruth Bader Ginsburg out of the hospital after being treated for chills and a fever. The 86-year-old has a history of serious medical issues and had surgery for lung cancer and radiation treatment for pancreatic cancer over the past year. She is the most senior member of the court's liberal wing and has vowed to stay on the court as long as she is in good health. And a record-breaking night for Taylor Swift. She took 6 American Music Awards home, including Artist of the Year and Artist of the Decade. But mostly, she avoided making mention of the bad blood between her and her former record label, only speaking of a, quote, complicated year and wearing a shirt with the names of some of her former albums. Sending a message there, Taylor. All right, coming up on the first trade, from the gridiron to the boardroom, we'll look at how a bad owner could make for a bad team.
The Washington Redskins are far from the best team in the NFL, but this sports business may have a problem that extends beyond the playing field. The issue may actually lie in its ownership. Yahoo Finance editor-in-chief Andy Serwer is here. Andy, I really enjoyed your piece over the weekend. Sell the team.
Yeah, and that is the chant that you hear in FedEx Field for the Redskins to Dan Snyder, the owner of the team. He's owned the team for 20 years. The team has not been successful. And, you know, a lot of it really lies at his feet, you guys. And I think that maybe it's an obvious point, but I think it's a point worth making anyway, which is to say, if you have an owner who's a bad person, the team tends to not do well. And then the problem is they never want to sell the team.
Yeah, in your article, you say it's not just about incompetence, it's that his lack of character. Talk to me about that.
Yeah, and there's chapter and verse that you can get into in terms of Dan Snyder and how he treats people and the lack of respect and all the small indignities that the staff has to go through in terms of, making fans having to pay to watch practices and banning signs and on and on and on. And you can see the turnover among his coaches. I think there's just been,
I think it's a morale issue even among the players that they don't want
for
to.
Sure.
They don't want to play for him.
It's like a revolving door. It's a carousel, not only of coaches but of players.
Right.
And at a certain point, a team gets a reputation, and people don't want to play there. People don't want to work for them, and then it becomes this vicious cycle. And it's very hard to get out of. And it's not just the Redskins. I mean, look at what's going on here in New York City with the Knicks. And the Dolan family. And then before that in LA with the Clippers and Donald Sterling and the New York Islanders and the ownership that they've had there historically as well. A lot of these people who I call bad people, deficiency of character, sometimes they run afoul with the law and the authorities. They have problems in the business world. And so it carries over to the team, and then you get a loser, and it just stays there, you guys, and it's hard to get rid of.
Annie, what's amazing here, on paper, he's made a pretty penny for doing such a horrible job.
It's actually a little deceptive. I mean, this team, he bought this team for $700, $800 million 20 years ago. It's now worth $3.4 billion. Wow, that's great. On the other hand, if you look at some of the other teams and the appreciation that they've seen in the value of their franchises, there's a lot more. First of all, owning an NFL team is like a gold mine. I mean, it's a license to print money, so he's just done well by sitting there and not doing a particularly great job, I would say. But if you look at the Dallas Cowboys, Jerry Jones has owned that for 30 years. He paid about $150 million. It's now worth $5.5 billion. Now, Jerry Jones has no halo over his head either.
Right.
But he hasn't engendered what I would consider a toxic atmosphere in Dallas the way Dan Snyder has in Washington. And therefore, the team is worth $2 billion more.
Sounds like an undervalued asset in the Redskins.
It is, and I think he could still sell the team for upwards of $4 billion. And we know Jeff Bezos has been poking his nose around.
Maybe he can unlock the potential there.
There would be
for shareholders and fans.
Right, he owns the Washington Post, so there would be a natural tie in there. But
we should mention the Redskins did win yesterday. They beat the Detroit Lions. They are now 2-9.
Right.
You used to root for them, right?
I did. I've kind of switched over to the Ravens now because I just get to, after 20 years, like, okay, I can't take it anymore.
Right, gotcha.
Right?
Well, it was a fun read. Thanks a lot, Andy.
Thank you, guys.
The opening bell is coming up next here on the First Trade. Here's a look at the action in overseas markets, and we'll be right back. Welcome back to the first trade on this Monday morning. We're about 5 minutes away from the opening bell. Stock futures looking to rally. Dow futures up 65, S&P futures up 8, and NASDAQ futures climbing nearly 33 points right now. Let's go around the bell with Krishna Memani, Vice Chairman of Investments at Invesco, and Amanda Agati, Chief Investment Strategist at PNC Financial. And of course, we have Yahoo Finance's Jared Blickery at the Wi-Fi Interactive Board. Good morning to you all. Amanda, I'm actually going to begin with you because boy, oh boy, we thought it was going to be a quiet week, right? I mean, Thanksgiving's just a few days away. Now we got all these deals to talk about and lots of different industries. What is it about this environment right now that makes it ripe for deal making?
Well, it isn't just today. It's really been a function of this entire year. I mean, really, after a dry spell over the last couple of years, 2019 has really been kind of the year of the deal, if you will. We've seen really significant pickup in M&A activity over the course of this year. Q3 was down a little bit, but still up something like 30% year over year. So not at all surprised to see this wave of M&A activity continue. I think it's a sign of the times. We're in the late innings of the cycle. I think companies have been very hesitant to push for a CapEx revival, given all of the uncertainty that kind of is swirling around in the macro and the headlines. And so they're really wrestling with this buy versus build decision. And so I think you're seeing that show up very much in this M&A wave that we're seeing this year.
Krishna, do you think we will get another wave in deal activity, at least looking out to the end of the first quarter of 2020?
I think so. So I think Amanda's point is a good one, which is when you don't have inorganic growth, when you don't have organic growth because of overall economic activity on a global basis kind of being subdued, especially because of trade issues, inorganic growth is what you focus on. And that's a lot easier because you're buying businesses which are pretty well established. So this is going to continue because overall growth rate is going to pick up. We'll see a bit of reacceleration in the global economy, but we are still talking about slightly north of 3% for global growth, and maybe we get to 2% for the U.S. growth.
So is it fair to say that the trade war activity, the uncertainty with that is just could drive more deals?
Absolutely. I think trade war issues keep growth under control and capital expenditures under control. So companies look for inorganic growth as opposed to organic growth in that environment. Speaking
of growth, Amanda, what's your feeling on growth stocks right now versus value versus defensive plays as we head into 2020?
Well, aside from the M&A story being a biggie for the markets, we actually think one of the biggest themes kind of in the second half of this year really comes down to this major factor rotation that we're seeing in growth versus value, and even to some degree cyclicals. You know, growth has been on an absolute tear for the lion's share of the cycle, and really when growth is scarce, investors seem very willing to pay up for growth stock. But I think it's really hard to chase growth at this point in the cycle, given the massive valuation dispersion and differentials between value. And as soon as we started to see a little bit of a macro reprieve over the last few months, cyclical outlook over a short-term basis starting to brighten, we start to see value, and to some degree cyclicals, although they are not necessarily the same thing, start to reassert themselves. And so, you know, the key will be to see whether we shift from a deep value story to more of a higher quality value story in terms of market leadership. That will be the key for us in terms of whether this rotation is actually sustainable or not.
So Amanda kind of sidestepped the issue. From my perspective, I don't think this is a sustainable move. I think the spurt that you're seeing in terms of in terms of value and cyclical picking up by the first half of next year, it's going to peter out again, because overall growth is not going to accelerate to a level where you can actually get a lot out of industrials, a lot out of cyclicals, or definitely a lot out of value. I think growth is still going to remain the focus for the markets for the foreseeable future. You may see, as we have in the past, short-term turnarounds, but that's not a permanent feature, unlikely to be the case for a while.
And here we are kicking off a holiday-shortened week on Wall Street with the opening bell at the New York Stock Exchange and the NASDAQ. Stock futures were looking pretty good here on what we are calling M&A Monday, and the Dow Jones Industrial Average going to open up 55, actually more than 60 points higher.
Amanda, when you see the deal like Louis Vuitton coming out here and spending over $16 billion for Tiffany, doesn't that make the argument that cyclical is undervalued?
Well, certainly, I think cyclicals are undervalued to some degree. I think you have to pick your spots very carefully, though. But I think the story with LVMH and Tiffany, kind of in my mind, really leads to some more questions than maybe answers at the moment. I mean, I think this is clearly, a big deal for the luxury goods market. So you have to wonder, is this kind of signaling some kind of peak in luxury goods? We've seen actually in terms of consumer spending trends, kind of a shift higher for middle market consumers or middle class consumers kind of reaching a bit. But we haven't seen the high end consumer continuing to reach higher. We've actually seen a little bit of a pullback there. And so kind of have to wonder if that's some sign of a peak in the luxury goods market. I think the other thing to think about there too, though, is a lot of exposure for both of those companies in Asia. And so what does that mean for the Asian consumer? We continue to believe the Asian consumer is very alive and well and should continue to spend. But it could also have some important implications for the trajectory of Asian economies. Perhaps we are set for a reacceleration there.
What do you think, Krishna? Does this deal today make sense? Has the luxury market peaked and now giants such as Tiffany and LVMH need to come together?
Well, I don't think it has peaked. I think if you look at consumer strength on a global basis, that's probably the only thing that is holding up global growth as much. So I think it's really more an adjustment of which channel are you marketing on. So I think Tiffany and LVMH are very different companies in that regard. It's really ultra high net worth versus mass affluence. So I think that is really a diversification move on part of LVMH rather than kind of moving out of consumption focused sectors because they are really worried about the global economy. I think Amanda's point about Asian consumers is a good one. Asian consumers were supposed to support all of these brands. Hasn't really panned out according to plan. So that remains an open challenge for all of these really high-priced brands.
Mm-hmm. Jared, over to you at the Wi-Fi Interactive Board.
Yeah, we have tech doing well. Apple is up 0.8%. Microsoft up 0.6%. A few stocks in the red here, but not by much. Johnson & Johnson down about 18 basis points. Financials, we have the 10-year T-note yield is now down about 1 basis point, had been up about 2. We're seeing JP Morgan up 0.5% along with Goldman Sachs here. And if we take a look at our leaders here, these are kind of the canaries in the coal mine. We see biotech today doing very well, up 1.3%, followed by the SOX. That's up 1%. Did kind of stumble last week. UBS had a double downgrade of KLA, and the entire chip sector kind of fell off a little bit. But we see the NASDAQ is up 0.2%. And to the downside here, banks, regional banks really underperforming. That is the KRX, the KRE regional bank index there.
All right, Amanda, I want to talk about that other big deal of the day. Charles Schwab buying TD Ameritrade for $26 billion in cash and stock. They're going to have $5 trillion in assets if and when this merger is approved. It's going to be one less choice for investors. Are you concerned at all about what that's going to mean for the landscape for the individual investor?
Well, not necessarily concerned about the landscape for the individual investor. I mean, it is a doozy of a transaction. There's no question about that. But Fidelity and Vanguard are still monsters in the space. So certainly some options there from an individual investor standpoint. I think it's much more interesting in terms of watching the evolution of the financial services industry and the asset management industry in particular. I mean, fee compression is obviously here to stay. And so companies are really trying to figure out what is the right path forward. Can we really add value via a number of other services and offerings? Of course, those come with a cost. So balancing kind of that return on invested capital and margin compression as fees continue to fall will be really important. But I think it's just a sign of the times, as all these other mergers and acquisitions that we're talking about today. The industry is really in a transformative place, if you will. And so no sign of that really slowing, I think, from our perspective.
And Krishna, what are your thoughts on this?
Well, so I think while for individual investors you have choices, for RIAs, the fastest growing part of the wealth management space, these were the two biggest players providing custody services and things like that. So I think this is going to reduce choice in that space, and this is what Schwab's focus has been. This is a really fast-growing part of the market, and they're devoting more resources. I think if they run into trouble, it'll be because of the fact that both of them are so powerful in the RIA space rather than individual investors.
How does this change what you do?
Well, it doesn't really change any of that because as asset managers, we are really not relying on these investors. I think it changes to the extent that we service a whole lot of RIAs who use Schwab and TD America as their custody platform. So both of them have very good asset bases, and they're trying to combine to grow this. And this is going to be very interesting.
Do you expect to see some layoffs as a result? Because there is a fair amount of overlap between the two.
There's going to be a bloodbath in terms of synergy savings and retrenchment, as typically is the case in all of these. These businesses are not growing at a fast enough clip where without synergies you can justify paying the premium that you're doing. So effectively, that has to be part of the equation.
Amanda, are these jobs out there? I think synergies they called out in this press release are close to $2 billion. They were talking about on the call a lot of branch consolidation. Where do all these folks go?
It's a good question, and it's not an obvious answer. I mean, I think it again, I just keep going back to the theme today is the sign of the times. You know, the industry is evolving, the U.S. economy is evolving, and so rethinking some of these more traditionally held positions, whether they be investment, manufacturing, otherwise. I mean, I think really individuals need to be focused on the longer term. I think this is going to continue for quite some time. It's not just one industry or one sector. It's really just a transformation of the overarching economy. And so hard to give you an answer about where the jobs go. But I think, individuals really need to be focused on where they are situated in their industry, what is the path that might lie ahead, and try and stay ahead of it, try and be proactive. Yep. So definitely a lot more change to come here.
The new era has begun. Amanda Agati, Krishna Mamani, and Jared Blickery, thank you. Coming up here on The First Trade, possibly a big change for those with diabetes. A new pill that might make insulin pumps obsolete. Yahoo Finance's Inez Ferre is standing by at the New York Stock Exchange. Inez?
Brian, let's talk about some upgrades and downgrades this morning, starting with Netflix, downgraded at Wells Fargo to underperform from market perform, with the analyst note saying that the cost to acquire new subscribers will be more expensive than what investors realize. Also, the note says that spending levels will remain high as you see more competition, of course, in the space. And we're watching NVIDIA this morning, seeing a bit of a pop. This is after being upgraded at Morgan Stanley to overweight from equal weight, with a price target of $259. The analyst note at Morgan Stanley says that NVIDIA is well positioned for growth, given the expected acceleration in gaming and data centers in 2020. And going into Black Friday, Frozen 2 may be helping Hasbro. Hasbro was upgraded at UBS to a buy from neutral with a price target of $117, with the analyst note saying that their research shows that there's been an uptick for Hasbro in November, in part in the doll category and also action figures. Brian, Alexis.
All right, Inez, thanks so much. Oil is holding steady after a Chinese concession left some room for a possible resolution in the trade war with the U.S. Yahoo Finance's Jared Blickery is at the Wi-Fi Interactive Board with today's commodities report. So, Jared, how's oil kicking off the week?
kicking off the week with a little bit of volatility. It's up about 1/3% here. If we look at the overnight price action, we can see there was a dip right around 9 a.m., but it recovered from that pretty handily. If we look at a 3-month chart on a candlestick basis, we can see the trading range, which we have from about 55, and there was a pretty strong rejection from this level last week, all the way up to 59. That is the area that we're watching here. So far, pretty quiet action overnight, except for that one hiccup, but also looking forward to the inventories reports. We're going to start with those after the bell. We get Bloomberg, then API tomorrow evening, and then the DOE numbers on Wednesday. And as always, trade is going to play a big factor in what oil does next.
And Jared, you're also watching gold.
Yes, we are watching gold. It's had a bit of a rough couple months here. Now it is trending down just a little bit. We can see it's off about 0.5%, but a lot of this has to do with the interest rate situation that we've been talking about. As interest rates move down, as they have been over the last 2 weeks, gold should be catching a bid, but we really haven't seen that to a high degree in the price action. We got a little bit of a rise here, but really not too much. We are seeing it sell off now. We have the 10-year T-note yield down about 1 basis point, had been up about 2. But I think really interest rates are going to tell the story of where gold goes next. The reason being that gold is a safe haven from assets that don't pay any interest. So looking back, we can also see a similar situation in copper futures. We've been tracking that as well. We have this rounded bottom, and we're just trying to find a base here. Trade is going to have a big a big effect on these markets here, and we're watching copper trying to hold that 2.6 level into the close today.
You know, Jared, also interesting, Bitcoin has fallen through a trap door, just as gold has struggled to do as well.
Yeah, it has. And really briefly, I do have a chart here, and we can see Bitcoin has just really fallen off a cliff over the last few days. Here's year to date, and we can see it just kind of falling off there. We do have support at the 6,000 level, but that's quite a bit below.
That is an ugly, ugly chart. Jared Blickery, thank you. Another big deal to tell you about this morning, this one in pharma. It's a pretty much for a single experimental drug. Novartis is buying the medicines company for $9.7 billion. Shareholders of the smaller biopharma company will get $85 a share, a roughly 45% premium over Friday's closing price. The deal gives Novartis control over the medicine company's promising new cholesterol drug, inclisiran.
This morning, we also have our eyes on shares of Oramed Pharmaceuticals. That company is touting a successful phase 2 trial of a new oral form of insulin for treating type 2 diabetes. And the CEO of Oramed, Nadav Kidron, is here to talk about it now. Welcome and good to have you here.
Thank you. Good to be here.
If this is approved, would this be the first pill taken orally for treating diabetes too?
It will be the first insulin pill in the history of the insulin. Since insulin was discovered, we're almost going to hit 100 years for that, never insulin was being able to be delivered orally.
And how does it work? It goes straight to the liver, or does it go through the bloodstream first? How would it be different from a needle, aside from the fact that a person wouldn't have to get the needle?
So the advantage goes ways beyond the patient's compliance. The idea is that when we give insulin as an injection, it goes directly into the bloodstream. But when you take the Oramed's technology and you take the oral insulin and you give it as a pill, it goes into the liver. And the liver is the organ that regulates the secretion of the insulin into the bloodstream. So it's really mimicking the physiological way that the body works.
How far are you away from FDA approval on this?
So the biggest news was about 2 weeks ago when we announced that we had a successful phase 2B trial. So we showed for the first time in history, we took a large group of patients, we gave them the Oramed oral insulin, and the other group got the placebo, and we showed that it works. Now we left to go through a phase 3, get the FDA registration, and we have a drug on the market.
I always thought that an injection would be a quicker acting way to deal with diabetes than the pill. What about that? When time is of the essence, would the pill still work?
You're absolutely right. The biggest advantage of the injection is the timing, but the biggest advantage of the oral is that it really helps us control the disease in a much better way. So at the end of the day, what we should see in the market is oral insulin with some injectable insulin, and the two of them will give us a new horizon for the way we treat diabetics.
What's the roadblock to getting the FDA to approve this?
Okay, so the FDA wants to see, first of all, that this is a safe drug, and it wants to see that the efficacy works well enough. So even though it's insulin, so it's not a new drug, and we know that insulin has been around for many, many years, Oramed still needed to go through the whole trials, phase 1, phase 2, and now we're going into a phase 3 to show those two. It's safe, you can use it, it works, and it's going to help a lot of diabetics out there.
How big could this one pill be in terms of sales, in terms of profits? Surely you have some kind of, maybe some estimate on it?
So I'll tell you, the good news maybe for shareholders, but the bad news for us as a society, we spent last year almost $800 billion on diabetes. And the oral insulin can take a meaningful part out of that, because people will start with the insulin much earlier. Because someone would be afraid to take the needle, but he will start with oral insulin as an earlier treatment. So hopefully we can take a big part of those patients that will switch and will start off with the oral insulin.
If and when it gets to market, because we're going to stay positive here, any idea on cost, and would insurance pick that cost up?
Okay, so part of the idea of the cost is that it's going to be in line with our other ethical medicine. But we also want the payers to look at the big picture. And the big picture is that by starting giving oral insulin as an earlier treatment, we can potentially lower the overall crazy cost that we pay for diabetes these days.
And last but not least, do you need to be part of a larger company just to reach full potential for this drug?
So at the end of the day, diabetes is so much all over the place, so you need someone to distribute it, you need a big pharma to do it, and that's like you saw before, but another deal, usually they need to fill up their pipeline, so they come to the small companies. And
are you in talks with anyone?
We are in talks with some potential partners, but once things are at the point that we can disclose more, we will disclose more.
All right, well, please come on back and talk about it.
With the water is good, I'll be happy to.
Nadav Kadran, thank you.
Thank you.
Coming up here on the first trade, Disney once again wins at the box office. The cold hard cash it brought in from Frozen 2.
And taking another quick check of the markets, the Dow now up nearly 100 points. We've got the S&P 500 gaining 14 and the NASDAQ up 68 on this day of deal making on Wall Street. Don't go away. We'll be right back. Now for a look at some of the companies and stocks the Yahoo Finance team is watching for you today. General Electric has a new CFO. The company has picked Carolina Dypak Huppe for the post, replacing Jamie Miller, who's stepping down. Huppe comes from the shipping giant Maersk, where she was the CFO. Huppe will be in charge of all financial activities at GM and lead its digital technology operations. Apple will soon be expanding its operations in India. That's according to the country's information technology minister. He says one of the iPhone maker's suppliers will start manufacturing chargers and other hardware at a plant in southern India. Apple already makes some iPhones in India. And HP is doubling down on its decision to reject a takeover bid from Xerox. In a statement, HP said the $33.5 billion cash and stock offer, quote, significantly undervalues the company. HP even raised the possibility of its own bid to buy Xerox. Activist investor Carl Icahn has been pushing for a deal. And Tesla CEO Elon Musk's derailed Cybertruck launch didn't seem to throw off too many potential buyers. Musk hinted in a tweet that the company has already received some 200,000 orders for the truck within just 3 days of its launch. The truck starts at $39,000 and Tesla plans to start manufacturing it in late 2021. And Frozen 2 caused a blizzard of ticket sales at the box office this weekend. The long-awaited sequel plowed in more than $350 million worldwide. That shattered records, making it the highest-grossing worldwide debut for any animated film. I was part of that ticket sale price because I, too, went to go see it. Great movie. Hard to beat the first one, but it was fun. And those are your companies to watch for Monday, November 25th. Fighting back. A Georgia woman claims Target is infringing on her trademark. We'll talk to her about the details of her lawsuit next.
You may have seen Target's newly launched flagship food brand Good & Gather while shopping at one of their stores, but the owner of a similar line, Garnish & Gather, is suing the retail giant for copyright infringement, saying that Target knowingly and willfully violated trademark laws. Here to talk about the lawsuit is Emily Golub, owner of Garnish & Gather. Emily, good to see you here. So what has been your interaction with Target up to this point?
Yeah, so when we found out about the launch of Good & Gather in mid-August, we sent a letter to Target and let them know about the infringement. And unfortunately, Target really hasn't taken this matter seriously. They let us know that they would be happy to help us out with some search engine optimization. And unfortunately, that's just not acceptable. You know, this is the future of our brand, and the brands and marks are just way too similar. So it's really disappointing.
That was a cease and desist letter, I would imagine, that you sent Target in mid-August. You know, this has all the trappings of a David and Goliath story here, Emily, and I'm sure you're very well aware of that. I'm curious if you have seen a direct impact on your brand recognition, on sales since Target came out with its line.
Yeah, you know, we have seen a lot of our customers share with us that, gosh, this brand is really similar and really confusingly similar and such. So we are really worried about what this looks like for us in a year from now. You know, once Target's been able to pump millions and millions of dollars into making this their flagship brand, you know, where does that leave us? It's really challenging, and it just feels like all of our growth is really in jeopardy. You know, if we were to enter into a new market, you know, we've been considering growing in the Southeast, growing to Nashville, to Athens, and we have customers in those markets who would be excited that we were there and excited to support us and tell all their friends about Garnish & Gather coming to town. But when those customers then walk in the next day and see Good and Gather all over the shelves at Target, it's bound to be very confusing. And it just really makes our ability to grow and support our company really challenging.
Emily, what's next for you in your fight against Target?
You know, we're hopeful and feel very confident in our legal team and with our counsel that we will be able to, pursue this in court. But honestly, I would hope that we could have a discussion with Target before getting there. I never wanted to take this to court or have a legal battle with Target. I just wanted to grow the brand that I've worked so hard for the past 6 years to protect and to have. And I would hope that Target would take responsibility and come to the table and have a reasonable discussion about how we can resolve this. I would like for them to stop carrying the brand and to rebrand, and their flagship grocery line is something different. And, I wish them all the best in that. But, I really need to protect my brand.
Emily, we reached out to Target and they sent us this statement. I want to read it to you. At Target, we have a deep appreciation and respect for trademarks. We're aware of this lawsuit and are confident that Target's brands, including Good Gather, are distinctive in the marketplace. We've shared that feedback with Garnish Gather and will continue to defend these claims through the legal process. What is your reaction to that statement?
Yeah, unfortunately, I just don't think that's accurate. If you look at Good and Gather and Garnish and Gather, they're incredibly similar. While the brands and logos themselves are not identical, we're really concerned about the words. We're a word of mouth business. And so we don't have the resources to be advertising on billboards or in magazines. Everybody hears about us through word of mouth. And so when you're saying these words, Good and Gather and Garnish and Gather, G&G, they're incredibly similar. If Target had Good and Gather on the shelves for the past 6 years, and it was their flagship grocery brand, and we tried to launch Garnish and Gather as a new brand, you bet your bottom dollar that they would be coming after us and saying that this was infringement.
Emily, what if they come to you with an offer to buy your company? Would you consider it?
We would definitely be open to having some discussions. And I think that Target's a great brand, and up to this point, really respected what they did and would have been interested in a strategic partnership with them. But, so far we haven't had that sort of response from Target.
All right, Emily Golub, thanks so much for sharing your story with us this morning. And that is going to do it for the First Trade for this Monday. I'm Alexis Christoforous.
And I'm Brian Sozzi. Welcome back, Merger Monday. Now let's get one more check of the markets with Inez Ferre down at the New York Stock Exchange. Inez?
Brian, Alexis, it's official. eBay has announced that it will sell StubHub to Viagogo. That's a Swiss ticket reseller for $4.05 billion. The deal is expected to close in the first quarter of 2020. eBay bought StubHub back in 2007 for $310 million. And Canopy Growth, we're watching this stock after the company says it has received the Canadian license to operate its beverage facility in Ontario. It will start producing 11 cannabis-infused beverages starting today. Make sure to stay with us. Wi-Fi AM starts right after the break. Dan Roberts and his team will be talking about this Merger Monday. Don't go anywhere. We'll be right back.
Good morning and welcome to Wi-Fi AM here at Yahoo Finance on this Monday morning, the start of Thanksgiving week. I'm Dan Roberts. We've got Brian Chung and Julie LaRoche here on the couches, ready to eat the turkey. But first, we'll do a show. The markets right now are in the green. The Dow is nicely moving higher. It's up 120 points. The NASDAQ and S&P moving higher as well, and we will keep monitoring. But we are starting the show with some big news about Uber overseas. Uber has lost its license to operate in London. The city has stripped Uber of its operating license there, claiming that the ride-sharing service is dangerous to passengers. Now, in the decision, regulators with Transport for London cited, quote, a pattern of failures that placed passenger safety and security at risk. And the group went on to say that it does not have confidence that similar issues will not reoccur in the future, which has led it to conclude that the company is not fit and proper at this time. Now, this isn't the first time that Uber has had problems in London. The company's license was suspended there in 2017. Then it was reinstated in June 2018. Now it has been stripped again. Worth noting, Uber calls this decision extraordinary and wrong and has vowed to appeal. Well, guys, this is the story for so much tech. Airbnb also facing regulatory hurdles still, a thing that a lot of people might not realize. Even right here in New York, Lyft has the same kind of problems Uber has, so this was a risk when it went public.
Yeah, and they have 21 days to appeal. Help me understand, though, what the heart of the matter is. It's something about images, photos,
right,
not matching up with the drivers.
Right, so they were saying that actually some unauthorized, as in not authorized by the City of London, drivers were able to upload their photos to Uber accounts wrongly, with it basically without the approval of the local government. So they were saying that this is a security issue, right? We don't want people hopping into people's cars if we cannot authorize that these are licensed taxi drivers who know their way around the city or aren't going to abduct people, right? So they said it's a main security issue. So that's obviously something from a PR standpoint you never want to hear about your own company, especially a ride-sharing company like Uber. So
and London is a huge city.
And also, when I think of London, I also think of those iconic taxi cabs that they have in London. So you're kind of going up against an already established institution as well. So of course the scrutiny is going to be that much more strict on you, if you will. And again, I keep saying this on our show. This also goes back to trust. And I personally don't want to get in a car with someone who might not be properly licensed, uploading their photos the wrong way. I don't know.
And Uber's,
I'm sure the cabbies would like this.
Yeah, and Uber's had issues in London before, but the reason why they're fighting so hard is because it's such a huge city for them from a revenue standpoint. So I think the statistic is 25% of the revenues come from 5 cities, which includes London, I think Sao Paulo, Brazil, New York, San Francisco. I can't remember the last one, but obviously a huge focus city for them. So that's why Dara Khosrowshahi, I think, rushed to have that tweet out that basically said, this is wrong. This is just a flat out wrong ruling from TfL. But as Julia mentioned, there is an appeal process.
We are going to appeal. Funny to hear you mention, you don't want people getting into the wrong Uber. I remember actually in the early days of Uber, on a Friday or Saturday night in New York City at 1 a.m. when everyone's like trying to get in Ubers and it's so crowded, you're on the Lower East Side and everyone's leaving the bars. All the time, people would just open the door of an Uber and assume it's for them and then get in the wrong one. That used to happen all the time.
It starts a lot of fights, I feel like, in the world.
Yeah, well, it's also just a safety thing, too. I've opened car doors that were not Ubers before.
Yeah.
Because,
it was weird.
It would be like a black Camry come up and you think, oh, that's
like,
not.
Dude, get out of my car.
Yeah, always ask, check the license, the license plate always. And then I don't say, oh, Julia getting into a car. I make the driver say my name.
Oh.
Yeah.
Smart. And they also implemented on the dashboard now, you can have it display a color.
Yeah.
That is your color. Yep.
Right.
British Cabbies. One of my favorite novels is told by a British cabbie, The Book of Dave by Will Self. Okay, Michael Bloomberg is officially running for president. Yes, it is happening. The billionaire former mayor of New York City threw his hat into the already crowded Democratic competition over the weekend. Of course, some critics are saying that it's too late and he is only going to divide the Dems further, but some supporters are pleased that he is running. Yahoo Finance's Jess Smith is live in D.C. and can give us the reaction so far. Hi, Jess.
Hey, Bloomberg is pitching himself as a person who has the business and political experience to bring the country together. In a campaign ad, he made the pitch that he is a middle-of-the-road candidate. Let's watch.
America waiting to be rebuilt, where everyone without health insurance is guaranteed to get it, and everyone who likes theirs can go ahead and keep it. Where the wealthy will pay more in taxes, and the struggling middle class will get their fair share. And jobs that just allow you to get by will become jobs that let you get ahead.
But Bloomberg is a billionaire, and other candidates like Senator Elizabeth Warren and Senator Bernie Sanders have really run campaigns targeting billionaires. So it's not clear if the party could end up backing a candidate like Bloomberg. Sanders has accused him of trying to buy the election. Bloomberg has spent about $30 million on TV ad time. He is not taking political donations. He is self-funding. And one interesting point about that is if he's not taking donations, he won't be able to make the debate stage because, Dan, you have to meet a certain number of individual donors to make that requirement to make the stage. So it's going to be interesting here to see how all of this plays out.
Yeah, Jess, I think it'll show us whether, in fact, the debates are important or not. I mean, if he can do well without being at any of the debates, it kind of casts a lot of doubt on whether we need the debates, or at least whether we need so many. There have been so many of these things.
Yeah, there's already been 5, so that is a good point. We'll see how he does. It is interesting that he is skipping Iowa, New Hampshire, and focusing on the states later on. That is just a new strategy that we haven't really seen before, so we'll see how successful he is in this effort.
Well, Jess, I actually want to go back to the idea of skipping the debates, not going to various states. Is he actually serious about running, or is he maybe trying to move the Democratic nominee, whoever that might be, more toward the center?
Yeah, that's an argument that we've heard from some analysts out there who say that he is trying to kind of bring the party together, shift the focus a little bit. He originally was not going to run because Vice President Joe Biden was running, but now that Biden isn't doing as well as people had expected, this is kind of the reason we think that Bloomberg's getting into this race again.
Hey, Jessica, and some say that he might take a chunk out of Pete Buttigieg or Joe Biden's kind of base right now. What do we know about Buttigieg? Apparently he has his own retirement plan actually out now. So what exactly is that proposal? What does it look like?
Yeah, he released one of the most detailed retirement plans that we have seen from the 2020 candidates today. And in a statement, he said, "I am determined to usher in a new era for older Americans, one that empowers them to age and retire with dignity, one that equips them and their families with a sense of security over their futures, allowing them to see it as a time filled with possibility." So here's a look at exactly how he would do that. His plan would establish a new long-term care program that would give certain retirees $90 a day to help cover the cost of long-term care. It would also raise the payroll tax cap to put more money towards Social Security. This is a popular idea among Democrats. He would put additional Social Security taxes on income above $250,000. He also wants to expand benefits for unpaid caregivers, so people who stay home to care for a child or a relative will get credits towards Social Security down the road. And finally, he calls for a public option 401k. Workers could opt in to contributing 1.5% of their pay to a rainy day fund, and then that would trigger a required 3% contribution from an employer to their retirement account. But one expert Yahoo Finance spoke to said that that 3% would eventually somehow come out of workers' wages. Buttigieg's camp makes the case that this will not only appeal to older voters, but also young women, young people of color who tend to be caregivers, unpaid caregivers most often.
Hey, Jess, just quickly, I don't want to put you on the spot too much or get too media insidery, but another big story related to the Bloomberg running over the weekend was, well, what does that mean for Bloomberg, the news outlet? And being based in D.C., I know that you see a lot of Bloomberg political reporters, and Bloomberg came out and said, you know, here's our plan for coverage. A lot of people have been criticizing that, and a lot of staffers on Bloomberg Opinion are leaving temporarily to work on Bloomberg's campaign. So I would just be curious in D.C. whether you're hearing people talk about that aspect of, you know, let's say Mayor Mike gets elected. I mean, what does that mean for the news outlet that bears his name?
Yeah, it is a topic of conversation that people are bringing up out here. The fact that the news department is not going to investigate Bloomberg or the other Democratic candidates at this point is kind of raising some eyebrows, but that's something that we'll definitely be watching as this plays out, something that people are keeping an eye on for sure.
Yes, they are. All right, Jess, thanks so much. Coming up here on Wi-Fi AM, we will dive deep on the Black Friday outlook for the big apparel names. Stay with us. Welcome back to Wi-Fi AM here at Yahoo Finance. Markets, for the moment, all in the green. Let's go down to the floor of the New York Stock Exchange where Ines Ferre can tell us what is happening. Hi, Ines.
Hi, Dan. Tech's leading the gains this morning. NVIDIA hit a 52-week high this morning, up about 4.5%. This is after Morgan Stanley upgraded the stock to overweight from equal weight and increased its price target to $259. The analyst note says that NVIDIA is just well positioned given the growth that's expected with acceleration in gaming and data center in 2020. And the note also said that even though gaming and data center fell short in 2019, the stock did well. Year to date, the stock is up about 65%, Dan.
All right, thanks, Ines. And another thing I know hit 52-week high today, Lululemon. Really interesting. Okay, Thanksgiving is almost here, and that means millions of shoppers will be spending on Black Friday, or so we hope, for the health of the economy. Joining us now to discuss the outlook for the big retail names, UBS retail analyst Jay Soul. Hey, Jay. Thanks for coming on.
Hey, thanks for having me.
Do you think it'll be a big, successful Black Friday?
Well, Dan, unfortunately, I think it's going to be an okay Black Friday. I think the data that we get tells us that consumers are going to spend, but they're really prioritizing other categories more than apparel and footwear right now. So they want to spend on their home, they want to spend on travel, they want to spend on experiences. Apparel and footwear is kind of on the low part of the totem pole when it comes to what people want to spend their money on.
That's actually an interesting point because when you look at the broader economy, the U.S. is doing well, the consumer's doing well. So, I mean, what does that say about apparel and footwear going forward? Are we going to see like a total paradigm shift? Or, I mean, the economy's good. It's not like we're in a recession, so.
Right. Well, Julie,
RIP apparel.
What I would remind everybody is that there's major disruption happening right now in retail. The shift to online spending has continued to make the retail marketplace evolve. People are using the internet to find ways to price compare, better than ever. It's a value-focused environment. People want to go to TJ Maxx, they want to go to Ross stores, maybe more than a department store, where they can find a great brand for a low price. And that's something that's really depressing sales. So, yeah, the economy is good. People are spending, but the dynamics within retail specifically are making it hard for the companies to get this kind of sales growth.
Those trends about apparel, maybe people are buying plane tickets instead. Now, do we expect that to hold through the rest of the holiday season as well? Because something that's really interesting to me is that sometimes apparel purchases, especially during the holiday season, will be driven by the temperature sometimes. If it just gets really cold, more people will go out to buy winter jackets for Christmas, for example. Have you seen that as a dynamic? Is there any expectation for that in this retail season?
Yeah, Brian, that's a great point because, this time of year when it's cold outside, if it's really cold, people will go buy jackets and sweaters at full price, and that's great for retail. But what's interesting is the weather in November has been cold, but we haven't seen that lift to sales, that we would expect to get because of the cold weather. So maybe if December turns out to be also cold, it sort of says that we shouldn't expect a great boost because, we haven't had it yet.
Yeah, and when we talk about apparel and how things have shifted, most recently, as I understand it, there's also been a major shift in sneakers that I think might not just be about e-commerce. I mean, we hear a lot about how performance sneakers have just struggled for many, many, many quarters now, thanks to the athleisure trend.
Well, you're absolutely right. I mean, I saw Brian's sneakers when I walked in. They immediately caught my eye because those are some really cool. But you know what? That's what it's all about right there. I mean, what he's wearing is totally on trend, but that's not for running. That's just fashion, and it's cool, and that's what people are buying. So sneakers are good when we talk about that casual side.
And I brought up sneakers. Can we get your take? I know you covered Nike very closely and all those other names. There is something going on with Nike, clearly. The CEO stepping down and that being announced on the same day as Kevin Plank stepping down from Under Armour. The full story there, I feel like, still has not come out, but that is just too big of a coincidence. And of course, Nike has had certain cultural issues in the last year that have been heavily reported on. Where do you see Nike right now and headed into the next year after Mark Parker steps away from the CEO reins?
Yeah, so I mean, Dan, it's very coincidental, I think, that the two things at Under Armour and Nike happen at the same time. Maybe there's a story there, but I think the important thing with Nike is, there's been a lot of talk about Nike in the news. We really look at Glassdoor very carefully. So the UBS Evidence Lab does a study of Glassdoor on a regular basis, and what we find is we look at over 70 companies in the apparel and footwear space and get employees' sense of satisfaction with their job. And you know what? Nike still remains at the top.
Okay.
So despite all these things that are going on, the feedback, at least on Glassdoor, still continues to be very positive and really no change year over year.
I just want to get your take on what's going on in women's apparel. I mean, I think there are a lot of things. I mean, as a consumer, I'm using Rent the Runway more, not buying as much. So what is your read on women's apparel?
Well, Julie, you just answered your own question. I mean, I think there's a lot of ways for people to buy apparel now that didn't exist 5 or 10 years ago, whether it's Rent the Runway or just buying, off a website like Rebag or something like that, or Fashion File, which is, secondhand goods that can be authenticated and that are strong. A lot of people are more comfortable shopping in the off-price channel. There's a lot of new, Amazon and ASOS and a lot of other competitors coming to the marketplace, there's just so many choices, and really all of them create deflation. And so people are buying fashion, but like they're looking for value, they're looking for bargains, and that makes the sales that we see when companies report earnings, look kind of lackluster.
And if I could ask quickly, do people care about malls? Because I just drove past the American Dream not so long ago, and I'm like, I don't know if malls are completely dead.
Right. And yet a new mall also opened right near me recently in Norwalk.
It's crazy.
A huge fancy
Maybe
mall.
it's just a Northeast
I couldn't
thing.
believe it. Yeah.
Yeah. Well, the American Dream's interesting because that's not really a mall. I mean, that's basically like Universal Studios with like high-end stores attached to it, right? I mean, otherwise, malls across America, they do face a lot of pressure because there's a lot of struggling retailers out there. So if there's about 75 publicly traded apparel and footwear companies, on this New York Stock Exchange, and 15 of them are making zero money. Right, and that represents about $30 billion in sales and about 12,000 stores. And a lot of those stores are in kind of the lower end malls that we have in the country. So those malls are going to be under pressure. Now, that doesn't mean a great mall. I think you're talking about the one in Norwalk, Connecticut, which is really cool, or the American Dream, which is super cool. Yeah. Right, there's still a place for them all. People still want to have stuff to do. They want to have fun. They want to go out with their friends. But it doesn't mean, but we don't need all the malls that we have. If we have 1,100, maybe we need fewer than that. But it doesn't mean malls are dead.
Yeah. And parking is just awful.
Oh, God.
That's
a whole other thing.
All right, Jay Sol, thanks so much.
Thanks,
really
Dan.
Good insights.
Thank you.
All right, coming up here on Wi-Fi AM, Merger Monday is back. We will talk about the stocks of 4 companies that are part of 2 confirmed tie-ups today.
For today's trending tickers, and it's a merger Monday. LVMH has officially announced that it has acquired Tiffany in an all-cash deal worth $16.2 billion. The luxury brand, which owns a portfolio of spirits like Dom Perignon, but also fashion houses like Louis Vuitton, Givenchy, and Fenty, says the Tiffany brand will strengthen its position in jewelry and expand its presence in the U.S. They expect the deal to close in the middle of 2020. And guys, they actually bid that price up from originally $120 was the original plan a few weeks ago to $133 a share.
Well, what often happens is the news comes out of the offer, and the news itself makes the stock go up, and now you got to raise the offer, which is always kind of ironic to me.
Right.
It's like, wait a minute, now we're worth
you
more.
want to
It's
get
like,
the
yeah, but you're worth more because
best
of our
possible
news.
price. It's not like you're going to come out, oh, here's my offer, done deal. Like, it's always going to be a
Well,
negotiation.
you can see the double bump right here, right? On Thursday when the initial news came out from Reuters, and then today when it's at. So, I mean, their premium
LVMH,
is still.
though, no bump.
Yeah.
Right, exactly.
I think what's interesting is Tiffany had been a long-standing, I don't know how many years, standalone jewelry brand. And you have kind of seen it kind of lose some of its luster in recent years, especially here in the U.S. And I think a lot of the play here, yes, you get some U.S. access, you expand your jewelry portfolio, but it's all about the Chinese consumer. That is where you're seeing a lot of growth, that rising middle class. They want to spend, they want jewelry, they want brands like Tiffany. So I think that'll be an interesting
what's notable
play
to
for
me
LVMH.
is that LVMH was saying this is a great way for them to increase their presence in the United States. So even though, yes, it is definitely part of the strategy to
Goes
try to take
both
Tiffany
ways.
international, it does go both ways as well.
And you know, look, iconic American brand that now will be French owned, but wants to reach the Chinese. It's just so interesting. One of many, many, many examples, and we're talking about multiple ones on the show today. You know, later we'll talk about Amazon partnering with Pinduoduo, but amid the U.S.-China trade war, a lot of companies, nevertheless, the most important thing for them is China. Back and forth. Under Armour doing huge in China.
They had a huge Singles Day in China. Yeah. I still want to understand, though, Tiffany's in the U.S. What's keeping them from being disrupted? I mean, you're talking, it's
Well,
high
there's lab
price.
grown.
I mean,
I don't think they do lab grown.
if you're buying a diamond ring, it doesn't like say, I guess maybe it does say Tiffany on it, or you get the box, but you can get a same kind of diamond for a lower price. I just don't understand.
With luxury, it's always about
Yeah.
the name, right? I mean, yes, you could get the same thing from
But
somewhere
like
else, but
David
it's not
Yurman just looks like David Yurman,
Right.
or other, I don't know.
If you know
Cartier
this
looks
stuff,
like Cartier. I don't know.
It all looks like rocks to me.
We'll see if LVMH can do anything with it.
Expensive rocks.
Yeah. But another ticker that we're looking at today, again on this Merger Monday, are shares of Charles Schwab, which is currently up only about 0.5%. But this is after the company made it official that it'll be buying TD Ameritrade in a $26 billion all-stock deal. Shares of TD, however, are up 4.75%. The news was originally reported actually last Thursday, but the company's waited until this morning to actually announce something. Schwab CEO Walter Bettinger will retain control of the combined company, as TD CEO Tim Hockey was already planning on leaving the company by the end of February. The deal will merge Schwab's 12.2 million retail brokerage accounts with TD's Ameritrade's 11 million accounts, which would create a Goliath in the discount stock trading platforms. Again, hard to say that this wouldn't have happened without Robinhood taking commissions to $0.
Oh, wait, right? I think this happened as a result of the zero commission race, but I don't necessarily give Robinhood all the credit for that. I mean, were they such a disruptor and were they such a scary competitor to all the big guys that the big guys said, all right, we have to go to zero too? Maybe, maybe not.
Well, and then now this is like, again, it's about scale. You're talking about $5 trillion in assets. I mean, the other one I think of is BlackRock, for example, with multi-trillions in assets. But maybe this is a part of a bigger story around this move we've seen to passive investing. From active to passive, we continue to see that. So,
hedge funds
I mean,
haven't even done that well.
it kind of, well, we're not wealthy enough to invest in hedge funds regardless.
Sure,
but
I mean,
they are
the case that in
managing
the last year,
pension
passive
foundations.
has done better, or active hasn't done as well
yeah,
as it should.
I mean, active
funds
stock
haven't-
trading has
I
not
mean-
done as well as it should, though some people would argue, look, you're going to need active. If everyone's going the way of passive, that's going to be a problem.
And this is a key point, too, is that Schwab, the actual retail brokerage business is a very small part of their business. They have a lot of wealth management and asset management lines of business that they offer. And I think that the game plan is to try to get those retail brokerages, which aren't as profitable now that the trade fees are $0, to try to get them into those other lines of revenue, right? So that is what Charles Schwab is trying to do with this acquisition here. The big actual competition that they have, I mean, you mentioned BlackRock, but really their main competition is Fidelity. Fidelity is the rival that really is to, facing this company.
So
and
we're going to have fewer players,
fewer,
bigger players.
Fewer players, but you need the scale, right? Because you're making money by selling order flow to the market makers. So that's how you're trying to make money in that brokerage. I mean, the margins are crushed.
Once you go to zero fees, got to have scale. And by the way, interestingly, just as with LVMH and Tiffany's, where the thing being bought is up much more right now than the buyer, same thing happening right now with Schwab stock versus TDA stock.
Yeah.
All right, coming up on the show, Amazon is teaming up with a Chinese e-commerce rival, and eBay is selling off StubHub. Welcome back to Wi-Fi AM at Yahoo Finance. Another big deal to discuss this morning. If LVMH and Tiffany's and Schwab and TDA weren't enough for you, this one is eBay and its ticket reselling service StubHub. eBay is selling off StubHub to the Swiss ticket seller Viagogo, which was founded in London. The deal is for $4.05 billion in cash. reportedly official now, according to the Wall Street Journal. Now, eBay bought StubHub in 2007, and the ticketing platform accounted for about 14% of eBay's revenue in the third quarter. Viagogo CEO Eric Baker was a StubHub co-founder, but he left before eBay bought StubHub, and he said, quote, "It has long been my wish to unite the two companies." Okay, so it sounds like it is very official if they are saying so.
Clearly investors are appreciating. If you look at the stock price for eBay, you have two formidable activist investors involved in this. You have Paul Singer's Elliott Management and Jeff Smith's Starboard Value, both activists who've been pushing for them to get rid of the non-core assets to your business. I mean, they acquired StubHub for, what was it, $300-something million?
310.
Yeah, talk about return on investment to sell for $4 billion.
But now they feel, I guess, they've wrung everything they can out of it.
I guess, but I mean, 14% of your revenues is not nothing, but I mean, clearly the activists see something with just focusing on what your core line of business is.
Well, and when the activists are pushing for it to sell off a big division, something it once acquired, you wonder if they're also pushing for further cuts. That's what I was curious about. That's why I said cutting coming. You wonder if that means that, okay, now we got rid of StubHub, and we're going to also have other cuts from eBay.
And eBay had initiated this review because of some of these calls from activist shareholders in March. So, I mean, that covers more than just StubHub. So it's definitely possible that could be the case. Haven't heard anything from eBay. But for what it's worth, we talk about how eBay had a nice return on investment on this. Imagine being the head of Viagogo. You founded a company, sold it for $310 million, wanted to reunite the company, and then paid $4 billion to get it back.
Yeah.
Man, he really wants that thing.
Right.
I mean,
and you wonder how much StubHub has really changed in the last 12 years. I don't know if it has
that. The scale is definitely much larger, but from a revenue-making standpoint,
in terms of what it does,
it's
the DNA of the company and the business. It is interesting. We mentioned that Viagogo, it's headquartered, it is Swiss in that sense, but it was founded by Brits in London. I think of it as a UK company.
Right. So back in Europe.
Right. Exactly right. Yeah. You wonder if you work in StubHub, if you work for StubHub in the US, what does this now mean for you? In terms of like the culture and the day-to-day.
Yeah, they still want to sponsor the Sixers?
Good question. All right, Amazon is looking to bring its Black Friday deals to consumers in China. To do so, it is teaming up with a Chinese competitor, the number 3 e-commerce player in China, Pinduoduo. Through the end of December, Pinduoduo will have Amazon deals on electronics, luxury brands, and more. Are you surprised, guys? And by the way, I would not expect to see Amazon partner up with like Alibaba or JD.com, but I feel like Pinduoduo, it seems like less of a direct rival.
Let's talk about Pinduoduo. It's one of the newer e-commerce play in China. It's only a few years old, and the way Pinduoduo works is they really focus more on those lower tier cities in China, which is an area that, as Alibaba talked about during Singles Day, that they're starting to go after. But that was their initial focus, was that, and using more social e-commerce. So like, for example, selling things in bulk, like you guys were all friends, we can communicate like, hey, there's some mangoes for sale, let's all go in on these mangoes. So it's an interesting play because Amazon really hasn't been able to, really get a footing in China. They tried, didn't really work out. You're going up against huge giants. I mean, you have JD.com, Alibaba, massive hundreds of millions of consumers using those platforms all the time. So I think it's probably a smart play. Yeah. You're trying out for a few months, 1,000 products.
You got 1.3 billion people there.
Yeah, and again, like the lower tier cities is where they're that's the new turf they're trying to go after. So, I mean, I think the stock was, for Pinduoduo at least, was reacting positively. They did stumble last week because they reported disappointing earnings. Also, just this month, I mean, go back to Alibaba. How much did they make for Singles Day? Or did they not make, but gross merchandise value was more than $38 billion. I mean, these are behemoths. So I think there's probably a lot of blank space still within China, and Amazon's got to look for other opportunities.
Bezos boost.
The bump right there. It's been up higher, though, this year. But I think one thing that's really interesting to me is that you have Amazon and Alibaba, which for the longest time, even through this year, have continued to maintain that they want their flags staked in their own domestic markets, basically. Alibaba saying, look, our priority right now, even though we just had a huge capital raise in Hong Kong, is to actually stay in China and focus on that market instead of world domination, whereas Amazon saying, we're focusing entirely on the U.S. market. Like anyone believes that. I mean, Amazon and Alibaba are on a collision course for pure competition.
I mean, this is probably a good way to test the water.
Absolutely.
Too,
you don't just go barge in there. I mean, so I think this is a good way to get that partnership going, maybe explore a purchase at some point, maybe just buy the whole thing at some point. Right now, too early to say. You want to collect the data first, see what that market looks like, dip your toes in before you ultimately just try it out. Yeah.
And as you're mentioning, I mean, even though Alibaba's saying, we're really focused on China, we've discussed on this show in the last 2 weeks the little ways in which the company company has sort of tried to start opening its doors to Americans. Just recently, both Tencent with WeChat Pay and Alibaba with Alipay, part of Ant Financial, which was spun off, have opened it up so that U.S. tourists in China can use their payment apps without a Chinese bank account.
Which I wish I had when I was there, to be honest, because it'd just be a lot more convenient because I was using physical yuan everywhere, and no one was taking my credit card, so yeah.
No. Coming up here on Wi-Fi AM, Elon Musk says that Cybertruck is selling. We'll discuss.
Welcome back. I'm Ines Ferre here with Tim Anderson. Tim, we've got the S&P and NASDAQ, which touched intraday highs this morning. It's a merger Monday. What's driving this higher right now?
Well, I think the merger certainly helped because anytime you have really big global mergers like TD Ameritrade Schwab and the Tiffany acquisition, right, that just shows a lot of optimism about the global economy going forward, that companies are willing to make that type of a commitment to expand their business line. Also, we have not had any negative trade headlines over the weekend, which occasionally we get them coming out of a weekend. And certainly we were potentially set up for that, given the bill that was passed in Congress near unanimously last week, which could potentially complicate the trade talks going forward.
And speaking over the weekend, we did get the news that Mike Bloomberg is going to be in as a Democratic candidate. And here on the floor, you've got a healthy mix of Dems and Republicans. When you look at Wall Street, regarding the Wall Street Dems, do you think that this is their choice as far as a Democratic candidate?
I would certainly think among the higher executive, the C-suite crowd on Wall Street, they would probably embrace Mike Bloomberg candidacy. Most of them are Democrats, I think. So you would have, they would find him much more palatable than almost anybody else on the field if Joe Biden's candidacy seems to be slipping a little bit.
And then looking at this week, it's a short week. We've got Thursday that's off, Thanksgiving. Right. What are we looking for as far as indicators? What are you going to be watching this week?
Just the momentum going in the next few days. Tomorrow's going to be a high volume day. You have MSCI indexes rebalancing. So that will not have a real directional push on the market, but we'll see high volumes tomorrow. And one of the most significant things I think going on right now is that the Russell 2000 is up 1.5%. It has failed numerous times just in the last couple weeks to get above the 1600 level. Still nowhere near a new all-time high, but if it could close above 1600 for 2 or 3 days this week, that could potentially show some rotation into the small and mid-cap sectors of the market going into the last month of the year.
Thanks so much, Tim Anderson, and make sure to stay with us. Wi-Fi AM continues after the break. Right now, we're looking at the Dow that's up 150 points. The S&P and the NASDAQ also higher, tech leading the gains.
Welcome back to Wi-Fi AM at Yahoo Finance. This weekend, Frozen 2 debuted at the box office. It brought in $127 million in the U.S., $350 million worldwide, breaking records for the biggest global opening for an animated movie ever. Joining us now to discuss, box office guru founder Gitesh Pandya. Gitesh, thanks for coming on.
Thanks for having me.
All right, well, let's talk about Frozen 2. I am going to see it on Wednesday with my niece. Oh, yeah, we
you're
had to
a
buy
good
tickets.
uncle.
I'm very excited. Well, it's not just for her. I love Frozen.
The first one was great.
It's great. I'm very excited. But man, we had to get tickets pretty far in advance because they were.
Well,
like
they had record-breaking advance sales. That's how you know you have a blockbuster on the way, when the advance sales, 5-6 weeks in advance, are at record levels. People are willing to pay for the tickets and the fees in advance. Then you know you have a blockbuster opening.
Wow. You know, recently we had someone on the show who was criticizing the idea that Disney, it seems like right now, is all about old stuff, whether it's sequels or remaking a classic with live action, or even this person was arguing, I can't remember who it was, that continuation of Star Wars franchise, continuation of Marvel, it's all things that have already been around. It's nothing new.
Right.
Do you buy that? I thought that was kind of a stretch argument. Like, it's working fine for them. It's making tons of money.
A lot of money.
So, okay.
Yeah, give me more Star Wars all day long.
Yeah, I guess it's a matter of do you want profits? And if the answer is yes, then you're going to keep making what the people want. And so the real challenge is mixing original films, because some original films can really sell as well, and there's a lot of demand for that. But also the franchises, the properties do very, very well, not just here around the world. And so you do see the remakes, the reboots. A lot of other studios have been messing up that. Charlie's Angels, Terminator franchise didn't work. But 2 years ago, there was a Jumanji film. And if you ask before that, does anybody want a Jumanji movie? And if you make a good film, it's going to sell.
Did that do well with The Rock and Jack
It did
Black?
$950 million, and now there's a sequel coming out in a couple of weeks. And actually, just this morning, China release date got moved up by a week. So it's opening next week, 1 week before the United States. And it did gangbusters in China, so it'll do that again.
I didn't even know you could beat the original Jumanji with Robin Williams.
If you put The Rock in something, it just does huge.
I want to talk about Frozen, because I remember when it became a thing and everyone was singing the song and all their kids were singing the song. I didn't watch it until it was out, not in the theaters. Was it in the theaters the original time? And how does the first one compare to this one?
Well, creatively, the sequel is a sequel. It's not as good or as magical as the first one. Having said that, it does give you what you're looking for: the songs, the characters. People have been waiting for these characters to come back. So you get more of Olaf, the sort of the funny little snowman.
Little snowman, yeah.
I think they knew that people liked him so much. There's more of him in this film. But the first one played for a long, long time. It had great legs, not just here, but around the world. In Japan, it did gangbusters over there, record numbers. And now for this one, they opened most of the countries, including Japan and China, on the first weekend with the United States. That's how you get this record $350 million. And I see it easily breaking $1 billion and maybe challenging the $1.28 billion of the first Frozen for the all-time record.
Okay, so let's go to another universe. Star Wars: The Rise of Skywalker coming out soon. You mentioned China is a huge market for it. Is that going to be another one of those gangbusters, as you mentioned?
Well, what's interesting is that Star Wars does not play as well in China. So the numbers over there are, most action films, China's the number one by a mile international market. Star Wars, not so much. The last few films have been just doing medium numbers over there. Having said that, it's always been a very American brand to begin with. The splits between U.S. and international have always been, skewing very heavy on the U.S. side. So that we know. But overseas is still very big. And this one, they are marketing as the finale. Not just the finale of this trilogy, but the 40-plus year Skywalker saga.
So they
say. So they say. I'm sure we'll see them again.
I cry when I watch the trailer. I
get emotional from the trailer too.
I get really emotional.
It's the end of an era.
And also Carrie Fisher, the end of an era there as well. So you'll see massive business, of course. The last real Star Wars film, Last Jedi, kind of had a big dip from the previous Star Wars. So it left a bad taste in the mouths of some fans. I think you'll see this one jump back up again, which is just what the first trilogy did. You have Star Wars, and then Empire Strikes Back went down this way. Return of the Jedi bounced back up again. I think we'll see the same thing with this trilogy.
Very quickly, one other random movie out right now I want to ask about is Ford versus Ferrari.
Right.
Because somehow I didn't hear anything about that until suddenly it was in theaters. I feel like there wasn't that much buzz, and yet it's getting good reviews. It's the kind of movie that I feel like years ago would have been like a mega hit. I mean, you've got Christian Bale, Matt Damon, and yet no one's really talking about it right now. Is that fair to say?
Well, I saw it a few weeks ago. It's a solid film. It's very much about the acting. I think Matt Damon does a very good job. Christian Bale is just phenomenal. He just commands the screen in every single scene. I think an Oscar nomination at least could be in the works here. But yeah, it is an adult skewing, mature skewing film, drama. Some of those are harder to sell these days. And so Having said that, the opening weekend was actually quite good. Over $30 million for this type of a film is hard to get these days. And it's holding pretty well, and I think it'll be an adult alternative against Frozen and Star Wars and some of these things over the weeks ahead, although there will be competition coming up too.
Right, tough competition. I love Christian Bale. I think he's awesome in everything.
Great actor.
Amazing.
He's fantastic in this one. You got to see it for that.
All right, Gitesh, thanks so much for joining us.
Thank you.
Great guest. We'll have you back on soon.
Absolutely.
That is box office guru. Okay, the Cybertruck got mocked when it was unveiled, the Tesla Cybertruck, but it is selling. It's got orders, and that is today's Musk Minute. Elon Musk tweeted out that Tesla has received 200,000 pre-orders for the Cybertruck. Customers can reserve one of the vehicles with a fully refundable $100 deposit. Prices start at $39,900 for a single motor version of the pickup, with most orders reserving the triple motor option. That one goes for almost 70 grand. That is according to Elon Musk. Production for the pickup trucks will not begin until 2022. So these people that have reserved one, they're not going to get it for a long time, but they want it.
Their minds.
I always get so nervous whenever Elon tweets a number.
Yes, totally, totally. And it's funny. We showed only the update tweet. The first one was he tweeted enthusiastically like 146K in the first 24 hours. Wow, big demand. And then he just updated by just tweeting out 200K.
So keep it vague. Keep it vague.
A lot can change in 3 years. That's all I can say.
And let's remember that hilarious demo where the guy came out and he said, "Now watch this, the windows won't break," and he chucked a metal ball.
OMG.
Yeah.
I mean, the media went nuts over it, right?
Yeah.
So, I mean, that kind of helped their case. But look, I think at the end of the day, anyone who argued that the Cybertruck wasn't appealing to either truck drivers or anyone else is maybe not correct. I mean, people love Tesla. People love Elon Musk, and people will go out and reserve these cars. I think that the numbers are fine. Like that 146,000 in the first 24 hours, I can believe that. But the problem, though, in my head, is I don't know how they can make a margin on a truck that has bulletproof glass and is apparently...
do we know how much it is to make?
That's a good price point that they're selling it for because, I mean, trucks are expensive vehicles regardless. So I wonder, like, how many people who are supposedly signing up were actually truck drivers before? Did they have a Dodge Ram? Did they have an F-150? I mean, I doubt it.
It looks
also,
ridiculous
you better have some extra windows and spare parts because you're going to have some jerks chucking some rocks at those cars to see if they're real.
Yes, that's the other thing. I really believe that if you drive this thing, anyone who recognizes what it is going to be like, oh,
let's throw a rock.
Our managing editor, Sam Rose, said that Tesla should sell the metal balls.
Well, no, you know what'll sell those? The other company.
The other could do that.
What is it? The Boring Company,
Yeah.
Some flamethrower and balls.
I am interested in a truck, having just moved out to the suburbs, but not that truck. Not that truck. Coming up here on Wi-Fi AM, we will have this week's Small Business Monday segment, so stay with us. Welcome back to Wi-Fi AM at Yahoo Finance. Markets right now in the green. All three major indices are higher. Now it is Monday, and that means we're taking a short break from Wall Street to find out what is happening on Main Street with some of these small business owners across our country. Today we have the owner of Paralee Boyd Salon in Detroit, Dana White. Dana, thanks for coming on.
Hi, thank you for
All
having
right,
me.
let's talk about the company. Why did you start the brand, and what do you think is your sort of brand? What do you guys stand for? How do you stand apart from other salons?
So I started Paralee Boyd because women were tired of making appointments, being in the salon all day, and paying a premium. I was working overseas, and I too was having a hard time navigating appointments and when to be there and when not. So I decided to come up with a walk-in only hair salon that was open 7 days a week so women can come in and go and get them out in and out in a certain amount of time.
No appointment.
I think this is really important as a woman who has to deal with this as well. So talk to us, how do you do that? What are the economics of it? How do you get there?
Yeah, so I used automotive principles from Ford, GM, and Chrysler, lean manufacturing principles. We're actually a very data-driven salon. So in order for us to operate walk-in only, we have to keep a certain amount of data to know how many people are coming within 15-minute increments so we can manage that flow properly and get women in and out in a certain amount of time.
So you're ready to franchise this business, as I understand it. So what does that expansion strategy look like? And why are you picking franchising as opposed to managing your own new branches?
That's a great question. So I think this is a problem that women are faced with everywhere, as she said. And I think the best way to reach women everywhere is to franchise. We're looking at multi-city unions, and that would make me one of the first African-American female franchise salon owners in the country. So it was a better fit, this model, as opposed to company-owned. Company-owned takes time, right? And a franchise model is rapid growth, and we can reach more people quicker.
When you do franchising, I guess the concern always is consistency, right? We talk about this with food chains like Chick-fil-A. I mean, you want every location, even if it's owned by someone else, to match the same feel and culture and efficiency of your original business.
Absolutely. And so we have very lean standard operating procedures that can be replicated. And that's the core of any franchise. If you can't duplicate it or train it, then you can't franchise it. So we can, and it's proven. We've been in business 7 years, and we've got 2 locations. So it works. I was like, the operations work. I'm sorry.
You know what busy women like? They like convenience and they like saving time. So how does it compare from your experience before, just going to a salon as a woman, versus now? What kind of time are you saving?
Oh man, so before I'd make an appointment weeks in advance, I'd get there at, let's say, 9 o'clock. I wouldn't leave till 2 or 3 o'clock in the afternoon. Yeah, sometimes 1, 2, or 3 o'clock. Now, if you walk in our salon at 10 o'clock on a steady day, our metrics have you in and out anywhere under 2 hours. Quickly. Yeah.
That is good.
Now, from a labor standpoint, I mean, sometimes at barbershops, for example, if you go in during a really low time, I mean, you'll see like 3 to 4 or 5 barbers just kind of sitting there waiting. How do you make sure that the turnover is kind of even so that you have people coming in, but then at other points in time, you're making sure that people aren't waiting out the door?
Again, that's the data, right? So having been in business for so long, we know within 15-minute increments how many people we should expect between 9 a.m. and 9:15, 9:15 and 9:30.
And you staff accordingly.
And we staff accordingly, yeah.
Let's wrap this way, Dana. I know that you guys are in Detroit. Love to have a business in from Detroit. Give us a read on what is happening with small business in Detroit, because for years the story was the city's still bouncing back after everything that happened with the car industry, and now what you hear is that things are really starting to boom again.
Absolutely. I lived in New York and decided to open this business in Detroit. Detroit is, I won't say it's just not only coming back, Detroit is back. Detroit is home to one of the largest communities of African-American women business owners, if not business owners in the United States. So if you're looking to start a business, all the programs and grants and just the resources available to help business owners get started, you're not going to find it any better than the city of Detroit.
Wow.
I love that. That's awesome.
Let's go do Wi-Fi AM from Detroit. All right, Dana, thanks so much.
Thank you for having me.
Really
nice to meet all of you.
Coming up on Wi-Fi AM, the inventor of the World Wide Web issues a plea to Facebook. We'll discuss. Welcome back to Wi-Fi AM at Yahoo Finance. Last night was the American Music Awards, the AMAs, and the biggest winner was Taylor Swift. She took home 5 trophies. She was named AMA's Artist of the Decade. Swift performed a medley of some of her biggest hits, including those songs at the heart of her rights dispute with her former label and Scooter Braun. That, of course, has been a big business story, and some of the night's other winners included Billie Eilish and Lil Nas X of Old Town Road, my favorite new song. Jem Aswad is senior music editor at Variety and joins us now to break it down. Hey, Jem.
Good morning.
Thanks for coming on. What did you make of the night? And I guess one good way to get into it, if I wear my skeptic's hat, I feel like I didn't hear as much about the AMAs this year. Is that fair to say? Is the buzz as high as it's ever been?
I mean, on the show in general, possibly not, but Taylor's drama amped it up big time.
Yeah. And how did the night go?
The show itself was as it usually is. It just lots of performances, lots of the year's hits all pulled together. But everybody was waiting to see what, if anything, she was going to say about the controversy, and she kept it subtle, but it was there.
Oh, what did she say that was subtle?
Well, it was more when she came out to perform her medley of hits, which she did indeed perform, older hits. She was wearing a coat that had the titles of those albums on it.
Oh, I see.
And the dancers, sort of ripped it off, as if to symbolize, like, it's a new day. And there were, a couple of statements about artist rights and things like that, which is at the heart of this whole issue.
Right, and I was going to say, obviously, all the focus on Taylor Swift, but for other artists, were there anyone's kind of making points about the issue that she's been having with Scooter Braun, or at large, just about the way that the music industry is structured right now?
Well, yeah, Halsey made a very barbed comment toward the Grammys because both she and Taylor later referenced Halsey's speech. A lot of people feel they were shortchanged in Grammy nominations, and that's not really anybody's fault, because it's voted on by a large number of people. But the thing is, I get the feeling that at least in Taylor's case, people at the Grammys may have been thinking, she already won Album of the Year twice, she's got enough, because these things are voted on by human beings. So.
Right. Now, in terms of just other artists, right? Who else took prizes last night?
Billie Eilish got a huge look. I'm not sure exactly how many she won, but it was a lot. She was on that podium at least 2 or 3 times. And, it's one of the refreshing things about the Grammy nominations last week is the fact that it's like a whole new generation came in. Mm-hmm. Billie Eilish is 17. Lil Nas X is 20.
Khalid is.
Yeah. Khalid is very young as well. But Eilish and Lil Nas X were the big winners the big nominees, along with Lizzo, who was the biggest of all. And
did she get shut out?
No, last night she performed. I don't know if she won any AMAs. I was talking about the Grammy nominations.
Okay. Yeah, Lizzo.
But Lizzo had 8 Grammy nominations, more than anybody, and most of the people had not heard of her last year.
Wow. I gotta be honest. I used to grow up like watching all the award shows, and I just am like, another award show. Like, I don't know if it will ever change. Maybe it's just me. I don't know how others feel,
but
I
watch the CMAs.
Will it ever kind of have? Lots of glitz and glam there. But will it ever have its cachet back, or maybe I don't know.
We've seen a lot of them, so it gets to be really familiar. But there are also just more and more and more of them, and they become more streamlined, and more similar because the audience demands are pretty similar. So believe me, I spend like 30 hours a year watching award shows. My posterior feels sore just thinking about it.
And are the AMAs kind of catching up to the Grammys are still the bigger thing, right?
Yeah.
The Grammys are the Oscars of music. Yeah. But the AMAs, being this much in the spotlight with all the Taylor news, does that kind of raise its profile for next year?
A bit, maybe, but they're in the second realm. They were catching up in the 80s and early 90s. It was just like a new sort of upstart show that was more daring than the Grammys were, which weren't daring at all at the time.
Right.
But they've become more so, and the AMAs have sort of, just sidled into a comfortable number 2.
It's like I think of it as AMAs are the Golden Globes and Grammys are the Oscars. Is
That's
that fair?
pretty much it, yeah, because they're both sort of...
nailed it.
They're both basically prequels in that way. Yeah.
All right, Jem Aswad of Variety, thanks so much for coming on.
Thank you.
Well, the creator of the World Wide Web is now calling out Facebook. Surprise, surprise. Sir Tim Berners-Lee issued a personal appeal to Mark Zuckerberg to ban targeted political ads before the 2020 presidential election. Berners-Lee said, "It's not fair to risk democracy by allowing all these very subtle manipulations with targeted ads which promote completely false ideas. They do it just before the election and then disappear." So just add Tim Berners-Lee, who is a huge name, if you know about the history of the web, to the growing list. but I don't think that will really change things.
Yeah.
Facebook has decided, here's how we're going to play this.
You know, I don't know what's going to ultimately move the needle for Facebook because I don't see a movement yet that's going to really take hold. We're going to actually see people like log off. I'm done with Facebook. I'm done with like all Instagram, WhatsApp, or whatever it is. But at the same time, these companies can't just sit there and be complacent. They need to proactively engage. And also the governments can't be complacent also. We're going to have to see some sort of action.
For me, I think it's hypocritical because we've heard Facebook management try to belittle the amount of revenue that they get from political ads anyway. So what do you have to lose by not taking that money? Right. So I don't really understand. Now, getting at the issue of trying to figure out what is a political ad in the first place, I think is a whole nother issue. That's a very thorny problem, very difficult. But as far as taking ad revenue from political campaigns, I don't understand what Facebook has to do.
Turn off that faucet.
I thought, just going back to last week, Sacha Baron Cohen's speech was the speech to watch, and I thought he hit the nail on the head when it comes to the Facebook ads, the spending. So maybe, that seems to me to be the one that really caught people's attention.
Yeah, that was at the ADL.
The way he analogized it, you're like, wow.
Yeah. I suggest everyone find that speech. And by the way, everyone framed that correctly as him slamming Zuckerberg and Facebook, but he also came down hard on Jack Dorsey.
Yeah, the Silicon Valley Six.
Everyone caught a little bit. Everyone caught a little bit.
That's right. Really good speech.
But these are important issues.
Really important. That is Wi-Fi AM for today. Thanks for watching. We'll see you right back here tomorrow. But don't miss On the Move. That show starts at 11. That's in just 2 minutes. So stay here on YahooFinance.com.
It's 11 a.m. here in New York City, about 90 minutes into the trading day. Stocks are trading higher, and in fact, we are seeing records yet again for the major averages. Merger Monday on Wall Street as Charles Schwab makes it official with TD Ameritrade. Billions more exchanges hands in 3 other major deals. Say cheerio to Uber, the latest as the ride-sharing company loses its license to operate in London. And giving in on IP, China makes concessions as it looks to finally get a trade deal done with the U.S. Welcome to On the Move. I'm Julie Hyman.
And I'm Adam Shapiro. It's good to have you here. It is Merger Mania Monday with big deals in brokerages, luxury retail, even pharmaceuticals. Here are the numbers. Charles Schwab's going to buy TD Ameritrade for $26 billion. LVMH is buying Tiffany & Company for $16.2 billion. And Novartis is acquiring cholesterol drug maker The Medicines Company for $9.7 billion. So let's introduce our panel for the hour. Yahoo Finance's editor-in-chief, Andy Serwer, and Yahoo Finance's editor-at-large and co-host of The First Trade, Brian Sozzi. Also joining us is Brian Chung. And where to begin on all of this? I mean, you've got a huge company from LVMH that's going to be, formed with the acquisition, not formed, but with the acquisition of Tiffany. You've got the pharmaceutical, but they're buying the medicine company for one drug, essentially a cholesterol-lowering injection. And then, of course, you've got the news that we knew about.
I think the underlying point is that the markets are robust and money is cheap, and growth is dear. Hard to find growth, easy to get money, and we're looking to expand, and I think that's kind of the common denominator for all these deals.
Yeah, I mean, as Andy mentioned, financing is cheap. Interest rates are at all-time lows, so it's easy for companies to get the financing that they need to try to build scale at a time when companies might be worried about what the next few years are going to look like in the macro picture. But, when we talk about Schwab and TD Ameritrade, Adam, you mentioned that that's one of those stories that we actually had known about already. It was previously reported last week that this merger was going to happen. But look, this is a humongous story in terms of scale in the retail brokerage industry. When you consider that Charles Schwab has over 10 million or so brokerage accounts, and TD Ameritrade with the same amount, over 10 million, which means that they'll have the scale to take on Fidelity, which is the big private player in that space. Look, at the end of the day, this is a $26 billion deal, and this is kind of hard to decouple from the trend that we've seen in the retail brokerage industry with commission fees going down to zero. That's something that Robinhood initially started, and then you saw the race between Interactive Brokers, TD, Charles Schwab, Fidelity to get zero commission fees as well. In an operating environment like that where margins are so squeezed, you got to build scale.
Yeah,
go ahead.
Well, I would just say there were some people getting at me on Twitter, is this a sign of a market top? And I would say no. Yes, money is cheap, growth is slow, but these are deals because of there are structural changes in the industry. You look at Tiffany, they have struggled for the past couple of years, evolving to the new consumer. You look at what Schwab is getting with TD Ameritrade, structural changes in the industry. Most recently, the move to lower fees. So this is not a sign of a market top. This is not a buying frenzy. These are just deals that make logical sense.
Tiffany's play is Asia. 50% of their sales are Asia. But in terms of the brokerages, Interactive Brokers, I pulled them up right now. Their stock is trading higher. It's up 3% today. I mean, we're going to see more consolidation, don't you think?
Yeah, well, the big loser was really E-Trade. A lot had actually speculated after the fees went to zero that maybe E-Trade was going to be the target, and maybe not from Schwab, maybe from Fidelity, who knew. But E-Trade ended up missing out on the party. You do wonder to what degree maybe Charles Schwab had approached them in a possible merger discussion as well. Ultimately ended up landing on TD Ameritrade, which is actually a bigger prize, to be honest. So when we think about the idea of these brokerages consolidating, these are much larger players with much smaller players now. That gap has even widened with this potential merger. Again, still needs to be cleared by regulators, but if it does go through, I mean, there's a huge difference between Fidelity, the merger of Schwab and TD, and then Interactive Brokers, E-Trade.
Right. And then there's another deal that we haven't talked about yet, and that is StubHub being sold by eBay to Viagogo, I think is the name of the company. Yeah. And you recently talked to somebody from StubHub.
I did, and this deal has also been talked about for a long time. eBay have been looking to find the right combination, and I spoke to the head of the company, Sukhinder Singh Cassidy, and got her take on where things stood a couple months ago. Take a listen. Now, the company's not without some controversy. I mean, first of all, you have an activist investor, Elliott Management, who's coming in, rattling your cage. So I want to ask you about that. And then also, this whole independent ticket brokers thing, and then the state and federal laws that people say is being arbitraged. So I want you to address both those things. First of all, what's going on with Elliott Management? They want it to be spun out of the company. They want board members, all that. You guys, the company's responded to an extent.
Yes.
Where does that stand?
So to be fair, Elliott Management is an active investor in eBay, which is our parent company, and has made a number of public recommendations to eBay, including a strategic review of its portfolio, which includes StubHub. That's going on right now. They also joined the board, and I think came to agreement with eBay on the actions eBay would take. And so I think it's been constructive and it's ongoing. So strategic review ongoing.
Is the company going to be spun off?
No answer, no conclusion, nothing to share right now. But an agreement that eBay would do a strategic review. In terms of where we sit in the ecosystem, look, I think that people love to look at ticketing as this controversial thing. And obviously when StubHub started, it was.
So that's Sukhinder Singh Cassidy, the president of StubHub, owned by eBay. And so for now, right. And so it'll be interesting. I mean, this is another, business has been roiled by technology and globalism, sort of along some of the lines we've been talking about with these other deals we've been talking about this morning as well. So that's another big trend. And, technology is changing a lot of these companies, a lot of the businesses, getting back to the brokers. I mean, there's a lot of new players in that space as well. So we talk about consolidation there. But then remember, all the fintechs are coming on stream and offering trading eventually as well. And I think it's interesting also with regard to Tiffany and how that company is, struggled, as you guys say, particularly in Asia. But, the way that LVMH has treated those brands, the maisons, as they call them, looks like probably a good home for that company going forward.
Right, a portfolio of those different brands.
Yeah, of maisons. That's what they call them.
I like it,
Yeah.
houses.
Yeah.
All right, let's move on to Uber. It's been stripped of its license to operate in London over fears for passenger safety. Yahoo Finance's Tom Belger is in London. So Tom, what happens now? There looks to be a lengthy appeals process, right?
That's right. Uber's vowed to appeal this decision to cut it out of one of its biggest markets in the world. Its CEO's come out saying this is just wrong as a decision and that they fundamentally changed and addressed the safety concerns regulators are worried about. But the London Mayor Sadiq Khan said today, and the transport officials confirming 14,000 Uber journeys have involved fraudulent drivers uploading their own photos to authorized drivers' accounts. Putting passenger safety at risk. Those were basically uninsured trips with strangers. And so the transport officials are naturally saying that's unacceptable, how easily manipulated Uber's systems were. That issue has now been fixed. Uber is able to continue to operate while it files its appeal. But interestingly, the backlash has already begun, with Uber UK tweeting messages of support from customers. We saw last time round when the ban was first announced or mooted a couple of years ago, Uber had launched a petition that had now almost 1 million signatures. Potentially they could revive that. And a union is warning this will be a hammer blow to tens of thousands of London drivers for the company. Potentially some of them could find work, though, with other companies in the UK. There's certainly, analysts say, no shortage of rivals to Uber, really lapping at its heels. And a big scramble potentially on the cards if Uber does crash out. We know Ola and Via Van have both had licenses granted fairly recently. Uber's share price did sink naturally on this announcement, but you can't write them off just yet. They've got 3 weeks to appeal, and even the authorities do acknowledge that if Uber get their act together and resolve some of these issues, they may sway the magistrates, the legal magistrates in this case, their way and get the decision overturned. It's also worth saying this battle's been rumbling on for more than 2 years since a ban was first announced and then overturned 2 years ago. And pretty much it's been business as usual for a lot of drivers and for passengers. So nothing's going to change overnight.
Tom, we appreciate that. And as you pointed out, this is under appeal. But it does look to the fact that Uber faces all kinds of headwinds. You've got the fraudulent driver issue in London. But here in, for instance, New York City, one of their largest markets, the Taxi and Limousine Commission actually limits the number of drivers that one can be active, but two, the companies like Uber and Lyft then limit who can actually go on the road. So if you're a driver, you can't just say, I'm in business today. You got to wait till it's okay.
And that's one of the, I think, the bigger problems here. You'll see that what could be them not operating in the UK, and does that roll across the other EU cities and certainly within the US? There is a lot of concern, or growing concern, on congestion problems. And even more broadly, if you're CEO Dara Khosrowshahi, how much longer can you just continue to watch these negative headlines before you do something? This market has completely ignored his call out on the last earnings call for profitability by 2021. I don't know where the bad news stops here.
Well, and the company is going to have to throw some money at this particular problem in London. It already has, because effectively what was happening was spoofing, right? Is that you would get one driver to pick you up, and then another one would come and get you,
right,
because they would somehow hijack. I don't understand, honestly, exactly how it worked, but they would somehow hijack the account.
Well, that's exactly right. But what's so difficult, you guys, really here is that you're a disruptor, number one, but then you're dealing with entrenched incumbents. Say a TLC, I love the TLC, Taxi Limousine Commission here in New York, in various cities with all sorts of different rules and regulations. So it's extremely complicated from a compliance standpoint to try to understand and mitigate what's going on in cities across the world like that.
Well, and by the way, you know, there's this view when you're a disruptor that these systems need to be disrupted.
Right.
Some of these rules are not a bad thing,
No,
right?
100%.
If they are indeed designed, like if you want your driver to have insurance so that if they get into an accident with you, you know, if you're driving, if they're trying to protect your safety, like not all.
Yeah.
But
and then
what
they're
about-
not customers.
what about
they're not employees.
What about rules,
right?
though, that are driving up the price of actually using an Uber or a Lyft? Because Uber drivers, talk to them, Uber or Lyft drivers, the companies themselves, to comply with certain TLC, that's the Taxi and Limousine Commission regulations, they're no longer allowed to say, you know what, I'm just going to go drive today. The app will not let them book passengers because there's a limit as to how many during different times that they're allowed to put on the road.
Well, I've seen the cost of my ride go up significantly this year, at least 25, 30%, depending on what location I am. So not only will this impact their bottom line, also impacts their revenues too as well, or could impact their revenues too as well. They will have to be forced to probably raise prices even more.
Even more.
Awesome. All right. Canopy Growth got the green light, to operate a beverage facility in Ontario, Canada. Those shares are trading higher by about 2.5%. Inez Frey's on the floor of the New York Stock Exchange with more. Inez?
Julie, Canopy Growth says that starting today, they will start producing 11 cannabis-infused beverages in that facility. Of course, this is all part of that strategy of going into Cannabis 2.0 derivative products. These are vapes, beverages, and edibles, which were recently legalized in Canada. We're watching Netflix this morning, not moving too much after being downgraded at Wells Fargo to underperform from market perform, with the analyst note there saying that the cost to acquire new subscribers will be more expensive than what investors realize. And going into Black Friday, Frozen 2 dolls may be a hit for Hasbro. This is according to a UBS note, with UBS upgrading the stock to a buy from neutral and a price target of $117, with analysts saying there that they've seen an uptick in November, and specifically in their doll segment and also their action figures. Julie, Adam.
Inez, thank you. The United States and China may be one step closer to a trade deal. Wish I had $1 for every time I've said that. Over the weekend, China said it will raise penalties on violators of intellectual property rights. Now, it will also look at lowering the threshold for criminal punishment for those violators when they break the law. IP is one of the big sticking points in talks with the United States. Andy, legitimate step forward or more of the same?
If they say it, who am I to argue with the Chinese state media outlet that said, contrary to negative media reports, I guess they got the fake news memo, China and the U.S. are very close to phase one of the trade deal. You know, listen, I mean, this was the harder part, was the IP protection. And, you know, people like Hank Paulson had long suggested that this would evolve naturally, because once China started to get its own IP, then it would want a level playing field and want to protect IP when it comes to its own stuff. So, you know, is this happening? I don't know. But, you know, you have to ask yourself, why would China be saying it if it wasn't? I'm not sure what the answer to that is, but you maybe take them at their word. I have no idea.
I mean, there's got to be some sort of enforcement mechanisms in here, not just on the part of the Chinese, but I don't know, overseeing mechanisms on the part of the U.S. Like, are they really enforcing this more?
Or is it just,
Yeah,
it's always been that in the past.
Well, you would think that would be a key sticking point in this too as well. But you also have to be somewhat encouraged if you're trading this market, you see the market reacting favorably to this. Reports over the weekend that they're already potentially looking at a phase 3 deal. That seems like a long ways away.
They get to phase 1.
But at least it's
I got a bridge to sell you, Brian Sozzi.
Speak to the traders out there.
Phase 2 and phase 3.
Okay, but on the flip side, actions speak louder than words. Who's been buying soybean? The Chinese. From who? Brazil. Not from our farmers.
Right. Well, you know, I mean, they need soybeans. And so to the extent that we've been making it difficult, it's hard. Now, supposedly the floodgates are open, but, you know, once you set things up with Brazil, maybe you don't want to go back. And, you know, like, because if you go back, you're just going to get whipsawed by our president 2 months later, right? So people want consistency. And so you can understand them being reluctant to get whipsawed coming back here for our beans.
Pretty extraordinary when the political situation in Brazil is providing a more stable situation than that in the United States.
Yep, you said it.
All right, coming up, Age with Dignity. Mayor Pete's big plan to shake up the retirement system. Plus, a lot of analysts predict below average returns in the coming years. We'll explain why and why maybe they're not right.
Welcome back to On the Move. I'm Jared Blickery. We got the Dow not at a record high, but the S&P 500 and NASDAQ are. Dow is almost there. It is up 115 points, about 0.4%. The S&P 500 up about 57 basis points. Here is today's price action, up and away, gapped open to at or near a record high along with the NASDAQ here. Russell 2000 really outperforming today. We can see it's up 1.8%. In fact, if we take a year-to-date look at it, we can see it's bumping up against resistance from the beginning part of the year. It is up 20%. Also going to take a look at the Dow Jones Transportation Average. That is up 1.4% today, up 19% for the year. And we can see it too is testing highs from earlier in the year. If these two markets break out to the upside, we would probably see considerable follow through in the S&P 500 and the other indices. Also taking a look at the VIX. Now we see this is down 1.5% or 17 basis points today, and it is testing that 12 level that it held all year long. So if we do launch from here, we might see a little bit of a downdraft in equities. Finally, 10-year T-note yield. Now this has been up earlier, but now it's down 1 basis point. We've been talking about the correlation between the value and momentum factors. When it's down, we tend to see money move into those growth stocks, into those momentum stocks. We can see it is up 5.3% year to date. Also, taking a look at the NASDAQ 100. So we have Insight up here. That is up 5%. NVIDIA at a 52-week high, that's up 4.4%. In fact, if we take a look at the year-to-date, we can see it is up 64.88%. To the downside, we do have a few stocks in the red here. Comcast is off about 2.5%. NetEase down about 2.4%. T-Mobile, when is this deal going to finally happen? We get new news on this every day, but T-Mobile is down about 0.7%. And then finally, if we take a look at the sectors here, we can see that tech, consumer discretionary, healthcare, and industrials, all of those are outperforming. And we're going to be right back.
Democratic presidential candidate Pete Buttigieg unveiled a detailed plan to overhaul retirement. A new entitlement for long-term care is at the core of the proposal, along with more money for Social Security and targeted benefit increases. Joining us now from Washington with more is Jessica Smith. So, Jess, is this the most detailed among the various candidates out there for retirement?
Yeah, it's definitely one of the most detailed plans that we've seen so far from any of the 2020 candidates. And in a statement, Mayor Pete Buttigieg said, "I am determined to usher in a new era for older Americans, one that empowers them to age and retire with dignity, one that equips them and their families with a sense of security over their futures, allowing them to see it as a time filled with possibility." Now, here is a look at exactly how he plans to do that. His plan would establish a new long-term care program that would give certain retirees $90 a day to help with the cost of long-term care. His plan would raise the payroll tax cap to put more money towards Social Security. This is a popular idea among Democrats. Buttigieg's plan would put additional Social Security taxes on individual income above $250,000. He also wants to expand benefits for unpaid caregivers, so people who stay home with a child or with a relative will receive credits toward their Social Security benefits down the road. road. And finally, the plan calls for a public option 401k. Workers could opt in to contributing 1.5% of their pay to a rainy day fund, and that would trigger an employer contribution of 3% to the workers' retirement account. But one expert that Yahoo Finance spoke with noted that that 3% will probably come out of the workers' wages at some point. Adam and Julie.
Jess, thank you. Are we in the midst of a secular bull market? While most analysts are predicting below average returns in the coming years, BMO's Brian Belsky is an outlier and says annual returns could actually balloon from here going forward. Joining us with more is Timothy Chubb, Gerard Chief Investment Officer. And Timothy Chubb, it's good to have you here. Got to ask you, one of the things that was in this morning's morning note at Yahoo Finance was the fact that we had a secular bull market, from 48 to 68. What would you say to people who think we might be back in that kind of scenario? What might they be missing?
Yeah, I think there's a lot of credence to this argument. You know, we have had very low growth over the course of this most recent economic cycle. Cumulative GDP is, the lowest it's been in any cycle in U.S. history. But we're entering a period where there's really two things driving this economy. Population growth has been very low. Productivity growth has been very low. But if you look at where we are headed moving forward, we have a global economy that's coming into mass affluence. An aging population. These new technologies are coming during a time where the millennial generation, all 80 million of them, Generation Z, all 75 million of them, are ultimately going to be entering their peak earning and consumption years in the not too distant future. So I think the secular bull market and growth story holds a lot of water. And there's a lot of exciting investment ideas coming online at the same time when 5G, autonomous vehicles, machine learning, and artificial intelligence are all about to make their appearance in a variety of industries.
And so, Tim, it sounds like you think things are going to keep going, but maybe not. A rising tide isn't necessarily going to lift all boats. So are you putting your biggest bets on technology and on some of those transformative technologies at this point?
Yeah, I think right now in this environment, you have to be really selective. There's a lot of thorny geopolitical issues right now that, while in the short term are impactful, I think long term, are going to be things that we'll be able to get through, and some of these larger trends are going to take hold. So our current strategy is sector neutral, but within that, we're looking to find a lot of investment opportunities with asset-light businesses that have strong balance sheets that are going to be able to take advantage of that secular growth story. So I think if you're trying to trade some of these more cyclical industrial stocks or hoping for this reflation event as a result of the trade war, it's going to be a great way to make money. It's going to be certainly one where you have to be more tactical. But if you kind of take a step back and look at what businesses are best positioned to take advantage of this long-term growth story in a lot of these industries I just mentioned, and I think that's where a lot of investors should be spending most of their time.
Tim, some of the premiums on these deals out this morning, Schwab, TD Ameritrade, Louis Vuitton, Tiffany, have surprised me. These are very rich multiples being paid for these companies. Is it a sign to you that this bull market is significantly undervalued?
I wouldn't say it's significantly undervalued, but I think a lot of businesses are taking a step back and saying, okay, we've got a lot of cash on our balance sheet. We're going to be entering this period where technology is going to be a major disruption. And they need to take advantage of that rather than, sort of resting on their laurels or having, sitting on their hands, deciding to pay fatter dividends or buying back a lot of stock. If they don't move quickly and either, growing their market share or reinventing their business or reinvesting back into their business, then they're going to be left in the dust. And, a lot of these consumer staple names are really a perfect example of that. We've seen, numerous companies that are old consumer brands that a lot of the Americans are comfortable buying from. However, we've seen a lot of other opportunities come into the consumer staple space and some smaller, organics. Many of these companies have missed that trend, and rather than paying premium multiples for some of these fast-growing companies that really can move the needle from a revenue perspective moving forward, they've decided to pay dividends and buybacks. And so I think what you're seeing is a lot of companies realize that now's the time to move if they want to be setting themselves up for this next 10 years rather than what's made them successful in the last 10 years is holding true moving forward.
All right, Tim, you talked about this being a global trend, but are you looking to invest that way, or is it best to just stay in the United States, which has, obviously been in the vanguard when it comes to growth, or should you buy U.S. companies that have international exposure?
I think it's both. You're right. I mean, if you look at the MSCI All Country World Index, about 43% of it is companies that are domiciled outside the United States. The S&P 500 alone, about 49% of the revenue actually comes from outside the U.S. So I think it's important to have a global outlook, both in the equity and fixed income side of things. There's a lot of exciting growth stories. Some of the largest businesses in the world are in China right now, whereas that wasn't the case, 10 years ago. So I think that to look, just here in the U.S. for a long-term investor, you're going to miss out on a lot of growth stories and opportunities that exist in Asia in particular. However, right now we maintain a little bit of an overweight developed, U.S. in particular. Although the valuations are a bit more heightened here, we think that we're the sort of clean shirt in a pile of dirty laundry as far as growth is concerned, and the outperformance of the U.S. may be here to stay for the short term.
Timothy Chubb, Gerard Chief Investment Officer, thank you for being here on The Move, and have a happy Thanksgiving, by the way.
You too. Thanks for having me.
Coming up, as more states raise the minimum wage, are businesses feeling an impact? We'll tell you the surprising answer, what that impact is. Plus, take a look at some of the winners on the Dow. Right now, we've got Intel leading the pack, up about 1.5%.
All right, we're coming up on 11:30 in New York City. We're 2 hours into the trading day, and stocks are much higher. You can see right there, we're starting the trading session on this shortened work week in the green. Also, take a look at what's happening with oil. We've been keeping a watch on this one. Oil now flat at $57.79 a barrel. Bloomberg goes all in, but does the former New York City mayor stand a chance this late in the race? Not so costly wage hike, why higher pay is not leading to the job cuts some people once feared. And avoiding holiday hell. The top travel mistakes you need to avoid this week, and we got approval from management to say holiday hell, so it's okay. Welcome to On the Move. I'm Adam Shapiro.
We're so edgy here at Yahoo Finance. I'm Julie Hyman. I'm avoiding it by not going anywhere. As we head into the holiday season, Americans will not just be shopping online, they'll also be banking online, of course. JP Morgan Chase has nearly 52 million active digital customers, and it's investing $11.5 billion by the time this year is over to advance payment options and gifting for Chase clients. Bill Wallace is Chase's head of digital. He is with us here now. Thanks for coming in, Bill. Good to see you. So that's a staggering number of clients who are now doing things online.
Thank you for that.
There we go, Andy, sir. So what has that done to your business model? Has it brought costs way down? Talk to me about how it fits into this sort of Chase ecosystem.
Sure. Certainly, we're part of an omni-channel strategy, so we have our great branch network. But certainly customers want to experience digitally all the things we can offer. So it helps drive down cost for sure, drives calls out of the call centers. But we know, based on customer research, our customers really want to have an interaction that includes the branch environment as well.
Does Jamie Dimon ever ping you and say, hey, the app's not working well? It's working great?
He certainly has. Usually he just calls me, however. But
Right.
yeah.
A couple of questions, and this is coming from not technologically a Luddite, but I'm still one of those people, I like getting the paper accounting every month. So no matter what bank, when you get the option, I like to have the dead trees. What happens to somebody who doesn't do that, and doesn't want to download that? I mean, you still provide that.
We absolutely still provide that. And my view is there are customers that represent that persona in every age demographic. So I call them responsible record keepers. They want to have that information.
Aren't you nice to him?
But as
without
Very
that,
diplomatic.
is there recourse without that if, God forbid, something would happen to the client whose account might get something bizarre? Without that paper statement, what recourse to that?
Well, we certainly archive all that data, and we're required to regulatory-wise. So we have all of that stuff on file for you if you need it, and you can get it right from inside the app.
What do your data protection plans look like for next year? Are there any new efforts you're really hunkering down in?
Yeah, so we're really focused on, I would say, around identity federation, but more importantly, probably.
What does that mean?
Yeah, it means the ability for us as a trusted party, we have to know our customer, so we vet you, obviously, as you come on as a client. Allowing us to then, and allowing you as a consumer to provide that to another third party where we're providing surety that you are who you say you are. I think you're going to see a proliferation of that in 2020. And for us, we also have a feature inside the app called Account Safe. So when you decide to provision your data to, let's say, Mint, you'll be able to see where you provided your data, and you'll have control to turn that flow on or off from inside the app.
And what is the most important feature going forward into 2020 for your customers? What are you hearing from them that they want more of?
Yeah, I think you're going to see a lot about personalization. So, 5G, the expansion and proliferation of 5G-enabled devices plus 5G networks, plus real-time AI as a service and its maturation. You'll see Chase Snapshot, which is really something that allows us to provide bite-sized, personalized insights to you. Not something you're just going to see by looking at the paper statement ideally.
And what kind of insights are you talking about? Like, you could save such and such this month by doing X, that kind of thing?
So we have a whole suite of Chase offers in the app, and we provide those through Snapshot. But more importantly, if you're a debit card customer of ours, a retail banking customer, and a credit card customer, we might show you where you're spending category-wise across all of your payment products with us. But I really like the feature around you just got paid. And we know 40% of Americans don't have any, a proper emergency fund, if you will. When you get paid, we can prompt you to turn on an auto-saving rule.
Well, you already have that. You have the auto-saving now.
And we're integrating it into Snapshot because it's contextually providing that insight to that consumer so they'll take action, and not making it scary is really important.
So let me ask you this, because, okay, you convinced me I will go paperless. I'm hearing that you archive it. No, listen, I had a friend who had an issue, but that's another issue.
Yep.
Real-time payment. One thing I've noticed, and I love the feature where I take a picture of the check, it deposits. But some days it can be, with Chase it's usually within 24 hours, but I have noticed sometimes things can take a little bit to clear. When does that day end? When do we truly get the check is there, the money's there, boom?
Yeah, it's great topic. Real-time payment as a service, I think across 2020, you're going to see more and more banks. We are already live on both send and receive. And I think as more banks come online, we'll be able to clear those things immediately. So it'll be an immediate, irrevocable payment. We'll post it to your account, and away you go. And I think you'll see much more of that in 2020. Use cases like gifting, charitable giving, things that drive the having to write that little paper check out or having to deposit that, you're going to see that continue to decline with the rollout of real-time payments.
So I mentioned at the top that you have 51.8 million active digital customers. 36.5 million of those are on mobile. What percentage of that is that, first of all, is that US based? And what percentage is that? And what percentage do you think it will grow to, say, by the end of 2020?
Yeah, it's all US based, and we grow roughly 10, 12% a year. I think we'll continue to see that growth, obviously, as customers come online.
And how much of your overall customer base is that?
Yeah, we have about 70 million, some odd 80
proportion.
million total customers, something like that, yeah. So we'll continue to see that grow, I think. And remember, we've got small business clients that are using the app as well and using the website. So those clients may have one or more, employees, if you will, that are using the services within the app or within the website. So.
Bill Wallace, thanks for being here. Chase's head of digital. Appreciate it.
Thank you for having me. I appreciate it.
All right. Happy Thanksgiving, by the way.
Happy Thanksgiving.
The fight for fair pay, the debate over minimum wage is hitting every industry.
Bill.
As of July, 14 states, plus the District of Columbia, raised minimum wage to above $10. But unlike some had predicted, job losses and price hikes to compensate for the uptake haven't happened yet. Yahoo Finance's Kristen Myers joins us now. And that's not the only finding. The states that didn't raise are suffering some job losses.
Yeah, so what we are finding, we always heard, right, with that fight for 15, right, that was coming out a couple years ago, Bernie Sanders obviously famously leading the charge for that. A lot of economists came out and they said, listen, if you hike that minimum wage to $15 an hour, you are not only going to see job losses in all of the states and in all of the areas that do that, you're also going to see these businesses pass along those prices to consumers. And frankly, that just has not borne out in the data. And there's actually a couple of studies that have come out to prove that. So there was a recent report, Axios actually did an analysis using Bureau of Labor Statistics data, checking job growth in a bunch of different states. And they actually found that, look, actually in states that actually hiked the minimum wage, they are experiencing job growth. States that don't necessarily raise that minimum wage, to your point, they're not necessarily doing as well. You would think that the job growth there would be increasing more than in the states that raise those minimum wages. That's actually not true.
So the question is then, where is that money? It has to give somewhere, right? So if you, as an employer, are paying more to employees, one of a number of things is happening, right? You're hiring less people, fewer people, or your margins are smaller, or you're growing enough that you have room to make up for it. Do we know which of these things? It sounds like the first option's not happening. You're not necessarily hiring fewer people.
Right.
Although anecdotally, I think we all know examples where perhaps that's happening, but not on a large scale. So which of the other two things is happening?
So I think there's definitely those stories, right, that you hear all the time. You do hear some businesses saying, look, I can't hire as many people, or I've had to cut hours for some of my workers. That absolutely does exist. But right now we're in an economy that is a very tight labor market. Right now there's just not enough people out there for some of these jobs. And so employers are having to go out there regardless to pay more money to some of these folks. And so they're finding, you know what? Hiking the minimum wage, we're paying more money, we're able to get more workers inside the door. But here's the thing, when it comes to that long-term picture, it's still a little bit unclear as to what's going to be happening. So which one of those specific answers? I don't think that there's a very clear answer on that as yet right now.
Yeah, it's kind of a mixed bag, I think, Kristen. I mean, you are seeing, revenue growth make up for it. I think you're seeing squeeze margins. It sort of depends on the business. But it's really interesting. I mean, to my mind, this is this trope you hear from economists with a certain political orientation. Oh, it's going to kill job growth. And it's just not the case. And they haven't raised the minimum wage. This is the longest period that they haven't raised the minimum wage. And by the way, the states that haven't raised the minimum wage, which is to say they hew to the national standard, are red states. And, and they're slow growth red states, by the way. There are a lot in the southern part of the United States. And, those states are falling behind. And the economies where they're raising the minimum wage happen to be faster growth states, then you can understand why, because then there's more pressure in the labor market there. So it sort of makes sense.
So it's really interesting.
If you ask me.
Well, it's really interesting because every time I feel like I've talked about this topic before, people have said, listen, the United States obviously is comprised of many different states, each of which has their own different economies. Some states are growing faster than others. You cannot apply minimum wage as a, like a one size fits all standard for all of the states in the United States. But there was a really interesting study that came out a couple of months ago out of Berkeley that actually decided to examine those lower wage states and those rural areas to see, hey, if we did hike the minimum wage to $15 an hour, are those states going to suffer the way that a lot of critics said that they would? And the answer is no, that they actually won't suffer. They actually can afford to raise the minimum wage to $15 as the floor.
Yeah, $7.25 an hour is not a lot of money.
Not enough.
You get the last word. Coming up, you thought Jersey Transit was bad. Travel nightmare. The travel tips you need to take to avoid chaos this Thanksgiving. Plus, Brian Sawsey will explain why brands matter in retail. This you don't want to miss.
Let's take a look at some big movers in today's session. One up, one down. Let's start with Plug Power on the upside, maker of fuel cell products. B. Riley FBR, the analyst over there, coming out with a street matching high price target of $6 a share for this stock. They say the adoption of the company's products, quote, continues to ramp quicker than we thought. Those shares are ramping indeed in today's session. On the flip side, we've got a Canadian gold miner called Kirkland Lake Gold. It's going to buy a smaller rival called Detour Gold for $3.7 billion. Yet another deal today. Some analysts are saying the premium was too high that Kirkland is paying, and that is sending those shares lower in today's session. We'll be right back. Well, as storms are expected to hit parts of the U.S. throughout this week, 26.8 million people are expected to fly this Thanksgiving holiday. That's 1 million more people than last year. Mark Stewart, business and aviation journalist, joins us now. And even without the storms, this ain't fun.
Well, we were just talking about our horror stories that we've all endured in the New York airports.
And the ones that we're bracing for.
And that are to come. Listen, my number one piece of advice is download the airline apps on your phone. If you are stuck, if your flight is canceled, if there is a delay, the airlines will already provide options for you. And I've experienced this. It's worked out pretty well. It's good news because you don't have to be on hold for endless hours. In addition, the airlines don't have to deal with you on a one-on-one basis. It's all on the app. Delta offers a live chat feature, so that makes things easier. And United is trying something new. They're calling it Connection Saver, where they will look at flights where connection times are tight, and they will try to hold back some flights where they feel there's some wiggle room. So the airlines are investing in technology, and for the most part, it is starting to pay off. People do feel comfortable with these options.
The real tip, and this is every year we talk about this, I think the statistic is this year 26.8 million. You should fly not on Wednesday, and yet you are.
We all are. We're all busy.
Why is that? Why did you go Tuesday? Would it make more sense to have gone Tuesday?
We have obligations.
We have to. Okay.
Yeah. You are the boss.
That you can blame yourself for, Andy.
Right.
Here's the thing. Thanksgiving Day is usually the best day to travel. I've done that for many years, and there's actually a whole open row of seats available. Also returning on Sunday. That's traditionally the busiest day. That's all. Yeah, I know. I know. I'm hearing you as well. Monday is also a good time to return. But not only is it just for convenience sake, if you've not booked a ticket yet and you want to go somewhere for Thanksgiving, consider leaving on Thanksgiving Day and then returning on Monday. You may actually have some luck.
What about driving? We're showing our pictures now of all the cars on the road. Is there anything people can do time of day? Is there anything they can do to mitigate that misery?
I mean, just like the airlines AAA is expecting record volume, I think as silly as this sounds, pay attention to the weather. I know out west this big storm is coming. That can lead to actual road closures. I lived in Colorado for many years. The interstate is shut down when there are bad conditions, and that just turns into a ripple effect. So I know that sounds simple, but it's true.
You know what the simplest thing to do, though, is, Mark?
And what's
what she's doing.
Stay home.
She's staying home.
I mean, of course, I'm cooking the whole meal, so it has other costs.
Yeah, but cooking.
Wait, we got a question from Brian.
Yes, Brian.
How bad will LAX be, given all what we've seen with the ride-sharing changes they've made?
Well, so it's interesting. LAX is trying something new. They've basically consolidated their ride-sharing, like many airports have done.
LGA did this.
Yeah. One thing I know that LAX is doing, I mean, they have cameras positioned, they have different metrics. I mean, they're trying to make it as strong as possible. I mean, the airport officials there insist this is something that they have studied.
Looked like a disaster so far.
Well, I think that at a lot of airports, this is a real balancing act, how to deal with this rise in ride sharing. You know, I was flying to Boston Logan not too long ago, and you have to leave the terminal and then go to a separate area.
Right.
Meantime, at the time, there was a torrential downpour.
Horrible.
People weren't so happy.
And then there's LaGuardia with the buses at LaGuardia with the construction. I mean, it's unbelievable.
And especially if you're compromised in
To
any
get
way,
to a
either
ride share
sickness,
or cab.
elderly people, children, it becomes
But what
a real
they're doing,
challenge.
what makes sense though at LaGuardia, and I think they do this in
Nothing
LAX,
makes sense.
you sign up for the ride share,
Exactly.
but you don't get the car until you're in line, and then it moves. You get a code, and the first car that pulls up, it moves it much faster. It's actually more efficient.
Yeah, at the Delta terminal, that's something
They don't
that
even let the cars get
LaGuardia's
near
been
there,
trying.
Adam.
Yeah, they do. No, they.
Not where I was there.
All right, guys. Wherever you end up, I hope you enjoy
get on a
yourselves.
bus.
Mark Stewart, thank you for coming in, business and aviation journalist.
Coming up, Navy
nightmare.
Secretary Richard Spencer resigns after Defense Secretary Mark Esper fired him for going behind his back in talks with the White House. Plus, plans to keep taxes low on legal marijuana products in California go up in smoke. Defense Secretary Mark Esper fired Navy Secretary Richard Spencer, who actually resigned Sunday. Spencer was negotiating a controversial deal with the White House regarding a disgraced Navy SEAL. President Trump and Secretary Spencer dispute over the Navy SEAL became public, showing discord between Trump and military leaders. Billionaire Michael Bloomberg, now officially a candidate for president, the 77-year-old former mayor of New York City, issued a statement saying, quote, "I am running for president to defeat Donald Trump and rebuild America." Forbes estimates Bloomberg's net worth at $54 billion. Bloomberg plans to spend $30 million on a TV ad blitz this week. Pro-democracy candidates in Hong Kong won a huge majority of seats, 389 out of the 452 up for grabs in local district elections. Now, analysts viewed the election as a referendum on the pro-democracy protests that have rocked Hong Kong for several months. California plans to raise taxes on legal marijuana products January 1st, and increase in some areas could be as much as 50%. The California Cannabis Industry Association, they oppose the tax, and they say, quote, "Widening the price gap between illicit and regulated products will further drive consumers to the illicit market at a time when illicit products are demonstrably putting people's lives at risk." That's a reference to the vaping problems. We'll be right back.
Party in the USA.
Hey, it's time for Word on the Street, where we check in with our panelists and find out the stories they're watching. Andy, you wrote about this. Redskins owner Dan Snyder.
Yeah, and it's not a surprise that Dan Snyder has been not a great owner for the Washington Redskins. But I decided to really sort of dig into it a little bit, because if you think about it, you guys, and maybe it's axiomatic, but bad owner, bad team, and it lasts for a really long time because these geniuses think that eventually they're going to turn things around. We have the Dolans here in New York City with the New York Knicks, same kind of thing. And, Donald Sterling for the Clippers. And when I mean bad is I'm talking about not only incompetent, but also deficiency of character. And in some instances, some of the people I mentioned run afoul of the law, or they have Me Too issues, or racist
Sue their own
issues.
fans.
Right, exactly. And so I think that Dan Snyder has created a toxic environment in the city. He's owned the team for 20 years. He just turned 55 on Saturday. And he conceivably could own the team for decades to come, even though Jeff Bezos has been sniffing around. And I was just thinking, if Jeff Bezos owned the Redskins, I bet you the team would be a lot better.
Maybe. I mean,
no, I know so. I would guarantee you, there's no way of knowing, but maybe he'll buy it and you'll see.
What's always fascinating to me, too, is when you have a public figure like this who is loathed, is it safe to say, by the fans? You could say that of the Dolan family as well.
Yep.
And, what do those guys think? They must know. Do they think, is it sort of a badge for them that they're hated by the fans?
I think that
or do they not care? Or do they... I don't know.
They don't care. I mean, there's a picture of the game on Sunday, and by the way, I should point out the Redskins did win. They're 2-9, so they barely beat the hapless, toothless Detroit Lions. But a giant sign that people had made by arranging themselves, I think, with colored pieces of paper, "Sell the team," and he's walking there. The stadium's empty except for a giant "Sell the team" sign. So I don't know how to answer your question, but that's sort of heading that way.
Can I just add the Wilpons in here too? The New York Mets?
Throw them in.
Throw them in, please.
Yeah, that's right. You're a Mets.
I'm a Yankee fan, but I just got to throw them in.
Well, that's why he's
All right,
so bad.
so let's talk about something maybe less controversial. That's LVMH's buy of Tiffany, which I know you're watching closely.
Yeah, so to me, I think it speaks to a lot of that iconic brands in retail still matter, and they might be undervalued. You look at Tiffany, certainly a very iconic brand. I think a lot of retail stocks, I look at a Ralph Lauren, iconic brand. I look what Tapestry owns with a Coach and Michael Kors, and I would say that is an iconic brand. A lot of these stocks continue to be or trade well off their highs, their all-time highs, on this thesis that Amazon is going to destroy everything and bring this massive deflation to every single sector, and then that's not necessarily the case. Out of those brands I just mentioned, I would say Ralph Lauren is an iconic brand.
Ralph has been doing pretty well.
Ralph is very involved with the company. At some point, when does he say, you know what, I want this brand to no longer be a public company, let me hand it off to somebody else before I retire?
Oh, you mean take it private?
Would be though? I mean,
it could be.
Take it private?
Take it private.
So, private equity is always
right, but I wonder who he would trust as
Why not Louis Vuitton
of the company.
Why not Louis Vuitton? It's another luxury brand.
Right.
Certainly, I think Ralph Lauren plays a little more downscale than a Tiffany Co., but something like that would make sense.
Brian, what about the China overhang with these brands? I mean, isn't that an issue as well?
Well, Tiffany, I would argue they have not lived up to their potential in China. They have tried to expand, and more broadly with the Tiffany too, they have not succeeded with retail stores. They put a front and center on the press release. They have 300 retail stores. The traffic into those stores has just not been where it needs to be.
One next to Trump Tower, that has not been.
And the one down on Wall Street too. I still have yet to see anybody walk into that store. I remember it opening I think in 2008, almost near the market, by maybe 2009, at the bottom of the market, and the traffic has just not been there.
I guess the traders down there aren't buying those little blue boxes.
Yeah. Spending their bonuses somewhere else.
Cheapening out on
All right.
right?
Andy Serwer, thanks for being here
Thank
this
you.
hour. It was fun. Brian Saz is going to stick around, and coming up, we'll talk more about this merger Monday and break down those 3 major deals that have hit Wall Street and what they say about deals this year. Uber fighting for survival in London after the company suffered a major blow. We'll be right back.
Almost noon here in New York City, 2.5 hours into the trading day. Stocks are trading higher. We're going to keep an eye on that for you. Take a look, though, at what's happening with the 10-year Treasury yield. Last week, we were approaching 2%, but then we fell back, and we are still trading down on the yield, 1.76%. Merger Monday on Wall Street as Charles Schwab makes it official with TD Ameritrade. Billions exchange hands in 3 other major deals. Say cheerio to Uber. The latest is the ride-sharing company loses its license to operate in London. And smashing debut, Tesla shakes off its troubled unveil as pre-orders for its Cybertruck, they surge. Cost you $100 and someone paid it. Welcome to On the Move. I'm Adam Shapiro.
And I'm Julie Hyman. Thanks for joining us. You can call it mergers and acquisition mania today. We've got big deals in brokerages, luxury retail, and pharmaceuticals. Let's run down the numbers, shall we? Charles Schwab is going to buy TD Ameritrade for $26 billion. LVMH is buying Tiffany for $16.2 billion. And Novartis is acquiring cholesterol drug maker, The Medicines Company, for $9.7 billion. Also, not to mention, eBay is planning to sell StubHub, $4 billion looks like the price tag on that one. We're going to talk about it all. We're joined by our panel for the hour. Yahoo Finance editor-at-large Brian Sozzi still with us. And we're joined now by Tendai Kapfize, LendingTree's chief economist, as well as Bob Profusek, Jones Day Global Chair of M&A. Bob, it's good to see you. I want to start with you because we have had this flurry of activity. And it hasn't felt like we've had this kind of flurry of activity in a little while. What do the dynamics of the market look like to you right now? And does today tell us anything?
Well, it's always hard to extrapolate, and there's never a reason for any of this stuff. There's a lot of reasons, and so picking it out is kind of hard. The last 2 quarters have been slow. There was a lot of activity, especially in the so-called big deal space. It's kind of odd that we'd call the StubHub deal kind of an afterthought. It's over a $4 billion deal. That's pretty big. But, it's been a combination of factors. I actually think, despite the fact that the macro environment is good, it's a combination of nationalism. It's a big issue to do a cross-border deal, and forget about it if it's a so-called national champion on the target side. Just not doable in the real world. There's been a lot of pushback by activists on buyers in big deals. I mean, think about Oxy and Icon and AT&T and Elliott and all that. And lastly, I think the market was a little tired. There was so much activity from 2015. It takes a while to digest and reload.
Okay, so when you talk about nationalism, activism, and digestion, let's go to activism. For instance, we're watching what Icon is trying to do within our own borders with HP and with Xerox. Are these necessarily, when the activists are pushing this hard, is it necessarily in every shareholder's best interest, or are they really, it's about Mr. Icon for himself, isn't it?
There's no question it's about Mr. Icon himself. And the irony is, when they take on these big deals on the buy side, well, who in the heck's pushing them all on the sell side? It's the activists. In fact, StubHub is a bit of a activist story in terms of that divestiture. It's actually a very successful business. They bought it for less than a tenth of what they're selling it for, yet they've got activist pressures to do something, return capital. So, I think that doesn't mean that activism doesn't serve a useful purpose in some circumstances. I think it can. But in general, it's all about the activist.
Sure.
Well, I think the activists in this case, look what they have certainly shook the tree over at AT&T. What was it, a week ago? AT&T sold the Game Show Network. Who knew that they owned and operated the Game Show Network? So hat tip to you, Elliott Management over at AT&T. And you look at eBay, they sold StubHub today for $4 billion. Jesse Cohen, which is Paul Singer's right-hand man over at Elliott, he's still on the board. So expect more change there. Why is eBay still operating StubHub? Their user interface still stinks. They shouldn't be operating a company like StubHub. So in this case, activists went out.
Brian has a lot of opinions. I want to ask you about valuations, and this is something Brian brought up in the last hour. Where are we in terms of valuations? Obviously, there's still a decent amount of cheap money out there because of where interest rates are. But when you see people buying, when you see more of a pickup in buying, does that tell us anything about where we are in the market, at the top of the market, in the middle, et cetera?
I think it really depends. I mean, you look at the Schwab deal, there's $2 billion apparently of synergies in that deal. Not surprising. This is two people who do basically the same thing. All of a sudden, they're not charging at all for their main function, which is, brokerage activity. Well, you better find some savings someplace, or where are you going to get earnings? So combine, synergize.
What about the layoffs here? A couple people I talked to this morning, there could be significant layoffs. $2 billion in synergies. Where are these people getting jobs?
Synergies is a kind word, mostly for layoffs. That's what it is. It's the way it goes. But this is a capitalist system, and creative destruction is part of the program.
So I noticed something, and I'm wondering if it means anything. So the Schwab deal was stock, and then the other deals where it's basically European buyers were cash. The Tiffany deal, they're borrowing at like 1-2%. Does that mean anything that in Europe they're trying to deploy their cash given low rates over there, and in the U.S. the deal was a stock deal?
It may, but and I think it's a good point. I should have thought of it first, because it's kind of odd to see stock deals right now when people are buying back their stock so much so that it's a political issue. That you can't. It's hard to imagine. But I think it's pretty much case by case. And this is, even for a big company, Tiffany's still a big swallow. So doing it in a way that's pretty conservative, I'm sure that's what they concluded made the most sense.
Bob, thanks for coming in to talk us through all of this. Bob Profusek is Jones Day Global Chair of M&A. Thank you.
While M&A activity is heating up, it has been the consumer driving the U.S. economy. The National Retail Federation expects holiday sales to increase about 4% this year. But with a late Thanksgiving this year, the holiday shopping season is actually going to be cut short compared to last year. So let's talk about what this means or could mean for investors in the retail sector. Simeon Hyman, ProShares Global Investment Strategist, joins us now. And very simply put, what does it mean? And then you have options for people in the forms of ETFs on how to play this.
Indeed. Well, I think the shortened season for the very late Thanksgiving typically doesn't mean too much. I mean, the news is pretty good. Remember, compared to last year, we're in a lot better shape. The stock market was selling off. The Fed was on the wrong foot. The tariff situation was more heightened. So if you look, say, at the NRF is forecasting about 4% increase in sales this year. That's in line with the 5-year average. But importantly, also, the forecasts are for 3 or 4 times that growth in online sales. So a good season overall, but continued growth in online retail is continuing to grow market share.
And you guys have some interesting ETFs that track different parts of the retail sector. We're showing the online retail ETF right now, which predictably has things like Amazon, but also Alibaba. So not just a bet on U.S. online spending. You've got the death of the mall ETF, I believe, or the death of bricks and mortar retail. But then don't you also have a bricks and mortar product? So talk me through how people can sort of look at these going into the holidays.
We thought it was important to first split up the world. Online retail and legacy brick and mortar retailers, even though we know some of them are doing sort of okay moving online, those are still 2 different buckets with very different performance profiles. So what we did at ProShares is we launched 2 ETFs. One is ticker ONLN. To your point, that tracks the online retailers. It recognizes scale is important. So the biggest pieces of that puzzle are Amazon and Alibaba, but it's of course a global business. And then the downside of the underperformance of the brick and mortar side, we expressed most prominently in our long-short ETF, ticker CLIX, which is long the online retailers and short the brick and mortar.
How do you let's look at 2 major retailers, brick and mortar, Target and Walmart. We know that their e-commerce has grown, but they don't tell us what percentage of total sales that represents. So I'm curious, one, for overall holiday sales, what are we looking at online for overall holiday sales? 23%, I think, is something I've heard. And then with these 2 traditional brick and mortar, where do they really stand in the e-commerce?
So I mentioned overall probably have 4 or 5% growth in total retail sales. It will likely be more like 12 to 15% online. And remember, that base is much lower than people really realize. Today, only in the low teens, 12, 13, 14% of sales are online, so we're much earlier than people think. Now, it is true that Walmart's had a nice run of growing their online business or omni-channel.
41% last quarter. That was what they told us. And Target was like 30-something%.
But here's what's interesting. It's still tough. It's better than the alternative, but it's not as good as things used to be. The margins are shrinking. If you look at Walmart's earnings release, they use the euphemism price investment, which always kind of makes me giggle. Price investment means they cut price. And even if you look at Best Buy, also similarly having a decent year, but their overall margins went from 3.8 to 3.4%. 40 bips when you're under 4% is a pretty big slide. So even as these legacy players, some of them are succeeding in growing their online businesses, it costs money.
Do you think we're looking at a potential blowout 4-day period from Black Friday to Cyber Monday. You have 6 fewer days out there shopping. The consumer, by all accounts, is pretty healthy. Do you think the numbers could surprise the upside?
I think so. There's going to be a catch-up because it's so late. So I think that's a pretty fair bet. If you're an old retailer, you know when a month is a 4-week month or a 5-week month and all these goofy things. But the bottom line is we're 5 days, more or less 5 days later than usual for Thanksgiving.
Can these stocks still trade higher? Can these retail stocks still trade higher?
I think you can have upside. Now, remember, some of those legacy brick and mortar folks like a Best Buy, Walmart, and Target, they've already had some runs, even in the face of their shrinking margins. So additional upside will be a little bit of a challenge, but you could get that pop as people cram in a little extra buying earlier in a more compressed time period.
Yeah. So you're splitting online and brick and mortar. The old way to split these things used to be luxury and discount and the other sectors. We're just seeing a big deal in the luxury sector here. How are the prospects for the holiday season by those old ways that people used to split retail?
By the old metrics, I think it's going to be reasonable across the board because we're in such a better place for the consumer than last year. Obviously, the wealth effect from the stock market being up, 25% this year as compared to down last Q4 is a big deal. But we also know that unemployment's very low and wages have picked up even a little bit, such that the staples side should be fine as well.
As we say thank you, I just want to make sure I heard correctly. So online sales for the holiday season total will be about 15%, maybe a little bit less, but it's not more than 15%.
Something in that range, yeah.
Simeon Hyman, thank you very much for being here from ProShares Global Investment. You're a strategist, and it's good to have you here on The Move.
Thanks so much.
Thanks, Simeon. Shares of NVIDIA are surging after an upgrade and price target increase in Morgan Stanley. Inez Frey has the details from the floor of the exchange. Inez?
Julie, NVIDIA hit a 52-week high this morning after that upgrade from Morgan Stanley to overweight from equal weight and a price target of $259, with the analyst note saying that NVIDIA is very well positioned given the expected acceleration in gaming and data center in 2020. Hasbro is seeing a pop this morning. This is after UBS upgraded the stock to buy from neutral with a price target of $117, saying that they've seen an uptick in Hasbro in November, particularly the doll segment. Remember that Frozen 2 just premiered, and also their action figures. And then just staying with toys for a moment, Funko is under pressure. This is after a price target cut at Piper Jaffray to $24 from $30. The analyst said that she made an adjustment based on the meeting that she had with Funko management. You'll recall that they have now a new CFO, and she's expecting to see more expenses for the company. However, she does say that she is encouraged by the initiatives to diversify their revenue streams and is maintaining her overweight rating on the stock. Funko, though, under pressure today.
Inez, thank you. Uber has been stripped of its license to operate in London over fears about passenger safety. Yahoo Finance's Tom Belger is in London and tells us what's going to happen next. Tom?
Uber says it's extraordinary and wrong that they've had this ban at all, or potential ban. They're saying that they have fundamentally changed to address safety concerns that regulators have, but crucially they're planning to appeal the decision, which would see them stripped of their license in one of their biggest markets in the whole world. London Mayor Sadiq Khan came out today. He said that there's 14,000 Uber journeys have been taken involving fraudulent drivers uploading their photos to authorized drivers' accounts, putting passenger safeties at risk. That is quite a remarkable statement from Khan and the authorities about the level of number of uninsured trips effectively happening in the capital. Uber can continue to operate, though, while it's appealing that decision. And it's interesting that a backlash has already begun. You've seen Uber UK retweeting customers' dismay at this decision. A union's warning this will be a real hammer blow to 45,000 London drivers, self-employed drivers who rely on their work with the firm. And you could even see potentially Uber reviving a petition they had about 2 years ago when they were first banned in London, which got nearly 1 million signatures, around 900,000 signatures. But some of those drivers potentially could find work with some of the other companies that could step in. A lot of analysts saying this is a real opportunity for other players in this competitive space to nip at Uber's heels if they do crash out. Ola and Viavan certainly were granted licenses recently. Well, having said all that, Uber's share price may be down, but you certainly can't write them off. They have 3 weeks to appeal this decision, and even the authorities grant that if they change their behavior, they may be able to sway that decision their way and keep on being able to operate. It's worth saying, finally, this battle has been rumbling on for years now without much change in practice day to day for drivers, for customers, because of that ongoing appeal process. So while it's a huge decision, there's nothing that's going to change overnight.
Tom Belger in London, thank you. Let's talk more Uber with the panel now. Interesting situation here where these companies come up against regulation. I mean, in this case, it sounds like it was not great abuse of the platform on the part of some of the drivers.
Yeah, I mean, I think a lot of the tech companies, they do this, right? They create an innovation that maybe the current law isn't designed to address. And then they deal with the regulators on the back end. So, it looks like the case is going to continue for several years, and nothing has changed on the ground so far.
Yeah. But at the end of the day, the regulators hold all the cards, do they not?
They sure do, at least in the case of Uber. I will add this too, just a little different take from the other hour. Lyft stock is up almost close to 5% on this. And I think in Lyft's case, you're really starting to see that separation between these two companies start to be reflected. Lyft has come out and said when they'll reach profitability, the market believes it. Also, too, Lyft is a smaller operation, much more U.S. focused, and it's really being seen as the winner here.
Interesting. Yeah. So being the pure play was maybe the better move.
They don't operate in food. They're focused on scooters and ride sharing. And for them, that might be the winning model for at least for right now.
All right. Well, coming up, breaking into the market, a less than stellar debut does little to impact pre-orders for Tesla's new Cybertruck with cracked windows. Plus, take a look at some of today's trending tickers on Yahoo Finance.
Welcome back to On the Move. I'm Jared Blickery, and we got the Dow heading to record territory. S&P 500 and NASDAQ Composite already posted their record highs, intraday highs for the day. We can see the S&P 500 up 0.6%, NASDAQ up over 1%. That is leading, but the Russell 2000, check it out, 2% to the upside here. This is the price action we've seen during the day. We gapped up, got to session highs right around 11 a.m. and are just cooling off a little bit. Also checking the Dow Jones Transportation Average. Similar story there. That is up 1.27% as well. And all of this happening while the 10-year yield is falling as well. So we can see it's down 1 basis point, had been up 2. Just a reminder, anytime we see the yield falling off, we tend to see rotation into momentum and out of value. So that's the opposite of what we were seeing a few weeks ago. Also checking on crude oil here. Now that is down 0.2%. We've seen it basically in a trading range over the last 2 weeks. To the upside, we have about 58, 59, and to the downside we have 55 here, still settling into that range. And then we're going to take a look at the Dow Jones heat map here. We can see lots of green. Technology is the leading sector of the day in the S&P 500. Apple is up 1.2%, Microsoft up 0.75%, and JP Morgan up 0.2%. What all these stocks have in common, at or near record highs right now, JP Morgan especially. Goldman Sachs is also up 1%. And meanwhile, we have Walmart. That is down 0.7%. 4%. Let's check out how the IPOs that we've been tracking in 2019 are doing. We can see Uber is down 1.3%, got an adverse ruling in the City of London we were just talking about. Zoom Video, that is up 2.3%. Lyft is up 4%. And Datadog is up 6%. Let's see what's happened over the last month with these these IPOs. And we're going to sort going back 1 month. So Peloton is in the lead, up 34%, right, Brian? And then we got Datadog up 27%. To the downside, Pinterest is the real loser here, 26%, and RealReal also off about 25%. Finally, going to check in on the sectors here. We can see healthcare, tech, and financials and industrials. This is over the last month. We've really seen healthcare take a nice comeback here. Also, tech doing well as it has for the last several years. So on this note, we're going to be right back. I'll be with you in a few minutes.
UPS is changing the drone delivery game. The company recently received approval from the FAA to expand its flight forward service. UPS now partners with CVS to make drone deliveries to some private homes. Bala Ganesh is the vice president of Advanced Technology Group at UPS, and he joins us to talk about the future of drone delivery. Good to have you here. You have more than 1,000 revenue generating drone deliveries already. That's key because you've already been paid for this. So let's talk about the thing that gets a lot of people excited. I can call CVS and then it'll come to my home. We're not quite there yet. Why not? Because you've already done a delivery that way.
So we are in the beginning of a journey, right? So there's three things that need to come together to make this reality. The first one is technology, a safe and sustainable technology that can be deployed. Number two is the regulatory environment that puts some guide rails around it. And last but not least, you need the customer needs. So we need to put all these together to get to a future where this can happen over time. Now, what we are starting off is in the beginning process of a journey which says, what are those critical use cases for those customers that would be a good fit for this technology and would fit into this regulatory framework? And so that's where we're beginning in the healthcare space.
And when you look ahead and for future planning at UPS, how important a part of your business is this going to be? Do you have any kind of projections as to what percentage of deliveries, for example, will be made this way?
I think we're looking at, it's very early days. So first of all, let me kind of caveat it that way. There are two pieces we are looking at. The first is as a growth engine, what are the new revenue streams we can create? And the second is what are improved efficiencies we can create for our existing business. For a growth engine, we are looking at the healthcare movements within the B2B or the campus model that we call, which is moving specimen samples between hospitals and labs. We think that's a really good use case because it's life-changing. And then the second is the urgent kind of same-day model, which could be either to businesses or to consumers, like the example we started recently.
Bala, have other retailers approached you about using this technology?
It's going to be a process, right? So yes, we've had a variety of conversations, both with other healthcare providers and also with other people from other industries, not just retail, but also industrial, high tech, et cetera. The question is, what is the right fit at the right time for the use case? Because the cost curve over time is going to come down, and the regulatory environment is going to expand, and we have to fit in the right customers at the right time at the right place.
So picking up on what Brian just asked you, though, you pioneered the B2B delivery with the medical space with WakeMed. You expanded to, I believe, a hospital campus in Utah. Who else is in the pipeline? Because I know you're talking to several different medical centers, and nobody else is doing what you're doing in that regard. So who else? Can you share names with us?
So let me kind of make sure that we don't jump the gun, right? So there is conversations going on with the FAA to figure out how do we expand from here, right? So there's still a regulatory framework that requires flight path by flight path approval as we expand. So we are having conversations. While we have announced publicly University of Utah is interested in doing with us, we are figuring out the regulatory framework for us to go and deploy it there. That's still a work in progress. In addition, we've also publicly announced companies like Kaiser and AmerisourceBergen, whom we are having conversations with as we move forward. In addition, we have a pipeline with about 50 plus customers that we're working with, trying to pull through into this environment. However, again, I'll make sure you understand that we have to work hand in glove with the FAA and DOT as we move forward, because it's still a framework that's constrained by what we can do within the regulatory framework.
And last question for you. Help us understand the time frame. I mean, how many years out are we from a day when this will be not a news story, that CVS is sending me the pharmaceutical or whatever via drone? 5 years, 10 years?
So let me kind of give you some real specific dates that'll give you a flavor. So we're working with the FAA and DOT, this really cool program called the Integration Pilot Program, or IPP. So the way I look at that program, it's a two-way symbiotic kind of relationship where the FAA helps us learn, operate within this environment, and we give back data, we contribute data back to the environment so they learn about what's working and what's not. Now, this program is going to continue till October 2020, where it'll end. And from there, it's going to take some time where they're going to publish some permanent rules going forward from there, which will then potentially come around 2021, which will then start putting some guardrails and roadmaps to what can be done in what part of the country. So that'll give you some specific dates that'll help us move forward.
Bala Ganesh is the Vice President of the Advanced Technology Group at UPS. And we wish all of you, because I know it's going to get real busy in just a few days for the next month for everyone at UPS. So thank you very much and all the best to your team.
Thank you.
Just 3 days after its launch, Elon Musk took to Twitter, stating that Tesla's new Cybertruck has received 200,000 orders. Yahoo Finance's Pras Subramanian joins us now to talk more about this. It sounds very impressive, doesn't it? But you only got to put down $100 to put in an order on this thing.
Yeah, and to be clear, it's a pre-order fee, not an actual order, which Elon...
You get the money back?
Because they're what? Not making the thing, not starting to make the thing till 2021?
Yeah, the end of 2021.
Yeah.
So, it's still a good sign that, hey, there's some interest here. It's a $20 million loan, interest-free loan, if you think about it, for Elon Musk. It's a good sign for them. Now, this is going to translate into the kind of mass scale that they want for this truck? I'm not sure yet. But they have time to sort of change some of these issues that people are having. The design looks kind of crazy. There's no windshield wipers or side view mirrors that are mandated by law, right? These things need to happen. So there's time for Elon to kind of get it together with this truck. But and this good indication of interest here from across the country. But I think there's a lot of questions as to what's going to finally appear in 2021.
Yeah.
This thing doesn't even have windshield wipers, and that $100 people are paying, you can get roughly, you can get 16 six-packs.
I never noticed that. There's no wipers?
There are no wipers.
Or side view mirrors, which are mandated by law. Yeah, exactly.
And are you going to sign up for one of these things?
Well, I might. We used to have a weird truck called the Hummer, which I think sold like 300, 400,000 units over its lifetime.
Yeah.
And people used to see that and say, who would buy this thing?
Right.
And they sold, they sold a lot of them.
Yeah.
This actually reminds me somewhat of the Hummer. The whole thing about having the bulletproof glass or whatever.
Yeah.
Who needs bulletproof glass driving around?
But the story of the Hummer, though, that was after Gulf War I. It was designed and built for the military, but after Gulf War I and the popularity of that action, the Hummer was then introduced to the private market, and people did buy it. I don't know if it'd be so hot today. The Hummer, it's a gas guzzler.
Yeah, back in those, the H2 was the civilian model.
The small version,
that people liked. Yeah, there's a use case for these kind of extreme, people want to, they want to cosplay as military people, get this hardcore truck.
Or Mad Max in this case.
Yeah, exactly. And so it's funny because Morgan Stanley had a note out that said that, 31% of investors polled thought that, hey, with major redesigns, this could be a pretty big hit. So there is some room there, aside from just the people that want to pretend they're badasses, you know?
I'm still stuck on the wipers. How do you keep the rain off your window?
You
don't drive it.
I'm caught up on the wipers.
Rivian's going to have its truck out next year. Ford has already got an all-electric F-150. I mean, okay, I'm a fan of what Mr. Musk is doing with the Tesla. My brother's had 2 Teslas, loves it, thinks it's the best thing he's ever driven, but still, he's late to the game.
And but they're all going to kind of happen around end of 2021, beginning of 2022. Like that's when all those trucks will be actually out for purchase. You know, Elon's promising a price below 40,000 for that entry-level one.
Yeah, right.
I'm thinking it's going to be more 50, 60, and that's around the price of the Rivian too. So
is the infrastructure even out there? Can they support all these electric trucks?
You know, whenever I test these electric cars out, it's always a struggle. I was out upstate. I was in Bucks County, Pennsylvania, and I had this car I was testing. I could not find a charger anywhere.
So what'd you do?
He drove around.
2 men enter, 1 man leaves. It's Mad Max, Thunderdome. Get your electricity.
It really is Mad Max. So that is a good question, though, for sure.
All right, Press, thank you. Well, coming up, another mayor enters the race. Mike Bloomberg jumps into the crowded Democratic field, but does he stand a chance this late in the election cycle? Plus, take a look at some of today's winners on Wall Street. Medicines company agreeing to be bought by Novartis. Those shares are spiking. Just after 12:30 p.m. here in New York City, 3 hours into the trading day, stocks continue to push higher, especially the NASDAQ, up more than 1%. Let's take a look at gold as well today to see if it's coming off as people put money into stocks. Indeed, it is. It's down 0.4%, $14.57 the ounce. Bloomberg goes all in, but does the former New York City mayor stand a chance this late in the race? Restoring Order, the creator of the World Wide Web, says he has a plan to save the internet. And it's beginning to look a lot like debt season, a staggering number of consumers who still have not paid off last year's holiday shopping spree. Welcome back to On the Move. I'm Julie Hyman.
And I'm Adam Shapiro. Let's talk about Mike Bloomberg. The former New York City mayor and billionaire has made it official. He's the 2020 Democratic in the race for president and dropped more than $30 million to purchase a TV ad campaign to kick off his candidacy. Joining us with more is Rick Newman. It sounds like Bloomberg is throwing the rule book out with his candidacy. He has $54 billion to his name. He can throw that rule book wherever he likes.
I'm not sure there is a rule book anymore. I mean, given what Trump proved in 2016. So a Bloomberg strategy apparently is going to be forget the traditional early states, that's Iowa, New Hampshire, South Carolina, and instead focus on the states where the most votes are. So California is now a Super Tuesday state, and California has 10 times as many delegates as Iowa does. So he'll be focusing on California and those other big states, New York, Texas. He's in the low single digits in the polls right now. But I think, this advertising campaign will get him up and maybe into the mid single digits. And then he has to connect with voters. And he can't just sit in New York and run ads. He has to get out and talk to voters somehow. And it's not clear yet how he's going to do that.
Right. I mean, Tom Steyer, another billionaire in the race.
Out there?
He's been throwing a lot of money at ads, too. Not the same amount, but he hasn't seen much traction from that.
He hasn't, but he did get on the debate stage.
Right.
So at least he made it that far. And but based on the rules for the debates at this point, Bloomberg would not qualify because one of the requirements is you have to have a certain amount of small level donors to show that you're catching on with people out there. Now, there could be different rules for the debates in 2020 that's set by the Democratic National Committee. We don't know what those rules will be yet. So maybe Bloomberg will somehow qualify.
Just got to tell you, America, having lived in New York City, it's worth it to hear the man speak Spanish. It's a riot when he tries to say things in Spanish. But I'm curious, Tim, what do you think? He's a billionaire. We got another billionaire. That's not going to resonate. He needs the Democrats to vote for him in these primaries. And billionaire is a bad word.
Yeah, but I think it's going to help him a lot being a billionaire because he's going to have to spend a lot of money. The strategy of skipping the early voting states, the reason that works because there's momentum, which basically turns into a lot of free media. So he's going to have to spend a lot more money to swamp that free media that whoever the front runner is going to be at that point in time. I do know one thing for sure. The voters, they're going to stop and frisk him, and we're going to see how he likes it.
Yeah, see, that could be
I wonder if anybody
stumbling block
outside
there.
the New York City or the East Coast even gets that joke, that was one of his unpopular policies when he was a mayor. What do you guys think?
African-American voters definitely get it.
They will know about this?
It's been years of, a lot of discussion around, the police and how they interact with the African-American community. And, Bloomberg is one of those people that, people know about, had this policy in New York, stop and frisk. Everybody has friends in New York, no matter where they live in the country.
Are we allowed to play a bit of the ad? Are we allowed to play? Yes. Let's show just a clip of the ad, and then let's react to this.
Mike Bloomberg started as a middle-class kid who had to work his way through college, then built a business from a single room to a global entity, creating tens of thousands of good-paying jobs along the way.
So my disclaimer whenever I talk about Mike Bloomberg is that I worked at his company for quite a long time. And to me, if he's going to resonate, if he's going to overcome this whole billionaire thing, it's by doing what that ad just did, which is unlike Donald Trump, he was not born with money, right? He came from a middle-class family and definitely built his billions from
terminals.
Not much, right? He built his own business. So it depends on whether that message, that idea of a bootstrap person can still has value in the American image,
I think it does, but I think what Bloomberg has to do is he needs to brand himself and market himself almost in the way Donald Trump does. So he needs to differentiate himself. Why is he different from Joe Biden? He's actually not very different on policy. So he needs to and he's also not very different from Pete Buttigieg on policy. So he's running as the sensible centrist. He doesn't want to, break up businesses and tax billionaires out of existence. He does say he favors higher taxes on the wealthy. He said higher taxes on wealthy people like me. But that's just policy. I mean, I don't think people are going to vote on that. So how does he actually get out there and tell people who he is and make some kind of a emotional connection with voters? Trump used Twitter to great effect, and he still does. The Bloomberg campaign, he just set up his Twitter account, and when I looked, there were like 6 tweets there.
No, he's had a
his
personal
campaign, yeah.
But he's had a personal.
He doesn't do it like
for years.
He doesn't do it like
he's
Trump
not.
does.
He doesn't do it in the same way that Trump does.
Nobody
No,
does,
definitely not. He doesn't do it in sort of a casual.
So
voice.
the way I think about it, if you think about, there are basically 4 top candidates right now: Biden, Buttigieg, Sanders, and Warren. And we kind of know their personalities at this point, right? If you've been following along, you know what you like about them, you know what you don't like about them. I don't think anybody knows that about Bloomberg except people who know him from New York City.
Who worked for him.
That's not many people.
Right.
I mean, it's 20,000.
When he speaks
company has
Spanish.
20,000 employees, but that's not
Google it.
America.
That's not enough votes to win a presidency. All right, a new way of framing finance for women. It's not a chore, it's a form of self-care. That's how we're trying to frame it, and important for your overall well-being. And it's critical that women become more involved in their own financial futures. That's according to our next guest. Holly Newman-Croft is Neuberger Berman Managing Director, and she's joining us now as part of our Women and Money series brought to you by USAA. So, Holly, thank you for joining us. This is an interesting way to frame it as a sort of self-care, because the self-care movement is big right now, so it makes sense. So how do you transform doing the finances of your home into that self-care from feeling like a chore, which it is for many people?
It's not as much fun as a massage,
right?
Or a facial
Exactly,
or something like that. I think it's really important for women to recognize that, statistically speaking, at some point in their lives, they're going to be responsible for their financial well-being. It's really easy to sit back and let your husband, your partner, your father, whomever take control of your finances. But women outlive men, statistically. We all know that. Divorce rates are 50%. We all know that. What a lot of people don't realize is that divorce rates among the 50-plus-year-old couples are rising. And so that all bodes for women sometime in their life will have to take control.
Don't women, and this might be, some kind of urban legend, but don't women actually wind up being better investors because while they're willing to take on risk, they're less willing as men would be to jump in and out and in and out?
Yeah, that's a really good point. So women have much less of a knee-jerk reaction, statistically, of course. Oftentimes men will go to a cocktail party and they'll hear about a home run investment. They'll call their advisor and say, I want to do it. They may not know anything about it. They may not know the risk profile, the return statistics, but they want to hit that home run. Whereas a woman is much more likely to digest it, learn about it, figure out if it fits into her overall financial plan. And if it does, then perhaps make the investment.
So I'm interested in the way you're framing it as self-care. I've read a couple of articles where they talk about where financial advisors are teaming up with mental health therapists, and it's actually a combination where you're working with these two professionals. The financial advisor is saying, hey, this is what you should probably do, and the therapist is helping you get comfortable with making those decisions. Is that what you're thinking of?
I would love that type of partner, but oftentimes I feel my role is dual, some part therapist, part financial advisors, because we're dealing with people who oftentimes are in a life change, whether it's divorce or death. It's unexpected, it's overwhelming. And so I have one client who came to me after a divorce. She was the breadwinner. She had created all of the family wealth. And this divorce just stripped her of all of her confidence. It took us 4 years to have a meeting where she didn't cry. And now every time we have a meeting, it's like a celebration.
I was at an event recently where I heard a woman who, not quite retired, but she was apologizing for her wealth. That blew me away. You rarely hear men apologize for anything, right? But and I wanted to say to her, you got nothing to be ashamed of that you're wealthy. Do you encounter that? I mean, we're talking about helping women grow wealth, but do you have clients who are embarrassed by the fact that they might have a seven-figure net worth?
No, I don't find so much that that's male or female specific, nor do I find that many of my clients apologize for their wealth.
Yeah, I wish everybody to have that problem, by the way.
Yes, exactly. No, that's not so much male, female. Women just tend to lack confidence, but like you were saying earlier, they are proven to be better investors.
And it's not just the confidence that you're talking about. You talk about the 5 lacks: lack of time, lack of confidence, urgency, perceived lack of knowledge, and lack of a trusted financial partner. What do you do about that stuff? Those are some pretty big lacks.
Well, so let's take them one at a time. Lack of time. Many women are working outside the house, even if they're not. They're CEO of their household either way. So sometimes you have 2 full-time jobs, one outside the house, one inside the house. So how do you find the time to take on this additional, what some would view as a burden or a chore? We try to get them to think of it as self-care, but taking responsibility for their well-being. They don't believe in themselves. Statistically, both men and women think men are better investors. That is proven not to be true. So what do you do to get ahead of it?
Right.
Start asking questions. Start talking to your friends, male or female. Talk to people who have similar philosophies, outlooks, risk tolerances. maybe the person who you go to the gym with or go shopping with isn't the person who you want to ask for a financial advisor, but it might be someone who has similar values and sensibilities to you. You don't have to have the answers before you go to the meeting. You know, I think oftentimes women feel ignored in meetings because the advisor speaks to often the moneyed or the wage-earning spouse, and historically that's not the female. But you don't have to have answers. You're there to learn.
Well,
so,
hopefully
and you're
that
the
is
client.
changing. Yeah. All right, Holly, thanks for coming in. Holly Newman-Croft of Neuberger Berman. Thank you.
Thank you.
Coming up, the internet feels the force of Disney. Why GIFs of the popular Baby Yoda character, they're disappearing online. Pay no attention to them. And as we go to break, take a live look at pictures from the White House. President Trump and Vice President Pence are seen here with the hero dog named Conan that was injured during that raid recently, which killed ISIS leader Abu Bakr al-Baghdadi.
We got some trending tickers from Yahoo Finance for you. Sorrento is a drug maker. Apparently rejected an unsolicited offer from two biopharmaceutical companies that said the offer was $3 to $5 a share. This is an immuno-oncology firm. Those shares up 85% in today's session. When we talked about the deal of the medicines company being bought by Novartis, we've got some other companies that are getting caught up in that. According to Jefferies, Arrowhead is one of them, one of the other companies that's developing a cholesterol drug that is using some of this same technology that is medicines company. So their shares up 17% in today's session. And Zscaler, web security company, Bank of America upgrading it to a buy. The price target there $68. You see it's just over 50 right now. The shares, though, have been down quite a bit since their July peak. That's one of the reasons that Bank of America is taking another look at this stock. And if you're following today's trending tickers, make sure you're watching the ticker. It's right here at 2 p.m. on Yahoo Finance.
Frozen food company Kid Fresh started as a physical retail store back in 2007 right here in New York City. Today, its frozen food offerings are sold at 10,000 locations across the United States. CEO of Kid Fresh, Matt Cohen, joins us now. And Matt, you know, the bottom line here is to get kids the nutritional value. Is it hiding the vegetables and the grains that they need, or is it just being upfront about this is really good stuff and it tastes good?
First and foremost, it's good stuff and it tastes good. Our number one priority is that the kids will eat the product, right? So victory for us, as for I think most parents, is an empty plate, right? So it needs to taste good for the kids. But then secondly, you know, only 1 out of 10 kids in the US today eat enough fruits and vegetables. So there is a big gap from a nutritional standpoint. And it's also very often a battle at the dinner table, right? So what we do is we enhance our products with additional nutrition coming from vegetables. So we hide them, we blend them, and we hope by doing that, you know, helping kids eat more vegetables, but certainly not replacing the real vegetables.
Why do you think that this niche wasn't necessarily being met in the marketplace, right? Because this is an ongoing challenge for parents, right, to get their kids to eat healthy food.
You know, I think it's been too easy for, you know, large food corporations to put licensed characters on boxes of junk and sell them. So why bother, right? But as an entrepreneur, I try to sort of change the status quo here and say, well, we can do better. You can have a great chicken nugget. There's nothing wrong with a chicken nugget as long as it's made with, you know, real chicken, good ingredients, and good stuff.
Why are frozen food sales continue to be so strong? We just recently talked to the Conagra team. They are dominating the frozen food section. Very strong sales.
Yeah, I mean, frozen food went through a decline, right? I would say about 5-10 years ago, it started to decline because it was really packed with junk, right? Packed with junk food, and you know, millennials coming into the marketplace were starting to become more picky, right? But today that has changed. The offering within the frozen food category has dramatically transformed, Kid Fresh being part of it. And millennials are very agnostic. You know, if it's convenient and good for you, they'll eat it.
How do you face the fact that kids have different taste buds? You know, the taste buds have not matured. They like sweeter versus, say, like a broccoli tart, although your kids love broccoli. How do you adjust for that? You don't add sugar, do you?
Oh, no, we don't. Absolutely not.
So how do you deal with that issue? Because their taste buds are not necessarily the same as an adult.
Yeah, I mean, first of all, we have a panel of children that taste our product. Moms also, very important. And it's a matter of sort of getting to a taste profile that works for the kids, but not compromising with nutrition. We don't add, absolutely, we don't add sugar. But, you know, we see some other chicken nuggets out there that have added sugar. You look at the bag and they have 3-4 grams of sugar. Why would you put sugar in a chicken nugget? You tell me, it beats me.
Having grown up on Fruit Loops now, but that's another generation. Matt Cohen, Kid Fresh CEO, we wish you continued success and good luck in your upcoming discussions.
Thank you.
Thanks. Another kind of food coming up, seafood style. Red Lobster gets into the holiday spirit with a sweater that has a special pocket to hold the company's popular cheddar biscuits and to keep them warm. Plus, take a look at some of today's losers on Wall Street. Kirkland Lake Gold falling after making an acquisition.
Take a look at the top trending stories on Yahoo Finance right now. General Electric named a new CFO, Carolina Dybeck-Happe. Shares of GE are in the green following the announcement. She is currently the Chief Financial Officer for AP and is expected to start her new role at GE in early 2020. Sweater with a purpose. Red Lobster is out with a limited edition black and red Cheddar Bay biscuit sweater. The sweater has an insulated pocket to keep the biscuits warm. While the sweater retails for $39, it's just one of the items available in Red Lobster's first ever online merchandise shop that will go live Tuesday. We'll be right back. Time for the Buzz Beat Around. 3 stories, 1 minute each, and we start with this. The founder of the World Wide Web, Sir Tim Berners-Lee, trying to save the internet. The scientist warned of a digital dystopia overrunning an online world, and he plans to announce his plan to save it. Can he save the internet, Tendai?
I don't know. I mean, I wouldn't bet against the guy who invented the internet, but the genie might be out of the bottle at this point in time.
I think he wants to sort of have a rules of the road kind of thing that he has with the Facebooks of the world. But yeah, I'm with Tendai.
I would say no. This is just the internet is a runaway monster at this point. It is the Wild West out there. I wish him well, though.
It's the wild iguanas that are overtaking Florida. There's an article on Yahoo Finance.
I mean, there's going to have to be some kind of reckoning, though, whether it's this guy or regulators coming in. Maybe the internet giants will see something like this as a savior to try to avoid regulation. Who knows?
But then you've got some kind of government control. Not that regulation is necessarily a bad thing, but then, that information, as you've said, is already out there.
Seems like potentially bad news or more bad news for Alphabet.
Yep.
Some not so jolly news. Meantime, a staggering 48 million Americans are still paying off credit card bills from last year's holiday shopping. That's according to a new survey. One way to avoid it could be to make a shopping list just so you stick to your list and don't get distracted and overspend. Sazi, you got any tips that you do for
go out there and spend? Everybody's worked hard this year. You have a couple extra bucks in your pocket. Go load up the debt. Buy yourself a new watch. Enjoy yourself. YOLO.
On.
Yeah, I think, make the list and stick to the list. Maybe, shop online and don't go into the mall or the shop and get tempted by stuff that's all around you.
Impulse buying. You want to decrease your impulse buying.
I'm trying to remember the name of the watch company. He said go buy a watch. They had the $25,000 watch here.
Those are the ones you wear. How do you forgot?
I wish I had that $25,000 watch. It was hot. I mean, I've got the $100 watch.
Well, maybe you should take on some debt in order to do so. According to Brian.
I'm glad I could be the voice of reason here.
But the real issue here is, okay, let's move on. We're going to The internet feels the force of Disney. Gifs of the Baby Yoda character from The Mandalorian were apparently removed from copyright issues, but have since been restored.
The internet loves this thing. Have you guys not seen Baby Yoda?
No, I didn't until the story.
Okay, so it's not really Baby Yoda.
It's just the same.
It's a Baby Yoda. So apparently it's very cute, as you can see, and gifts were all over the internet, and then they disappeared, and there was a lot of criticism of Disney.
Gremlins.
It's marketing. Why would you want to take it down?
Yeah.
And now they've been put back up.
Yeah, it sounds like they're getting a lot of traction from it. Probably some people who hadn't thought of seeing the movie are now like, oh, wow, this movie is around. Oh, it's not a... See? There you go.
I've never seen one Star Wars movie anyway. I'm
getting
really not
in
interested.
real time.
Pull that photo back up. Those of us old enough to remember the movie Gremlins from the 80s.
Yeah,
that's all this is without fur.
Why is the Baby Yoda wearing that Red Lobster sweater? Can we talk about that? That Red Lobster sweater is it's bad. I don't want to put one of their biscuits in my pockets. It's horrible.
But it'll be there a year later and you can delete it.
Don't want it. There we go. Don't want that at all.
Okay, Mr. Scrooge, bah humbug.
Awful idea.
Know what you're not getting for the holidays.
Okay, Brian Sozzi, thank you so much for being here today. Tendai, always good to see you. Thanks for coming in. Let's take a last look at the markets. Obviously, investors are feeling better about stocks today than Brian Sozzi's feeling about that Red Lobster sweater. They are buying, although we've got quite a disconnect today between the tech-heavy NASDAQ and the Dow, which is up just 0.5%. But I believe the NASDAQ and the Dow are both at records today.
All right, we still have plenty of time left in the trading session, and Wi-Fi PM is going to take you through the next hour of trading.
It is 1 p.m. in New York City, and the S&P 500 and the NASDAQ are hitting fresh record highs as tech stocks once again provide a boost to start the week. On tap for today, Uber taking a hit in one of its biggest markets. The ride-sharing giant loses its license in London over rider safety, why the company says the decision is wrong as it looks to appeal. Plus, despite mixed reviews for its new Cybertruck, Tesla CEO Elon Musk touting more than 200,000 pre-orders on Twitter, why the naysayers may be proven wrong, and getting paid to move. We'll chat with the Bay Area startup paying Bay Area residents $10,000 to move out of the Bay Area. The CEO joins us to update us on how many people have taken him up on that offer. All that and more. This is Wi-Fi PM. Good afternoon, everybody. Happy Monday. I'm Zach Guzman, and joining me on Wi-Fi PM today is Yahoo Finance's Brian Chung, along with Quidtum Director of Research Max Raskin, along for the ride. Good to see you guys. Happy Monday.
Hey.
We've got to check the market action first before we start the show, as always. And right now, as I mentioned, the S&P and the NASDAQ hitting record highs today. The Dow up 137 points. Right now, the NASDAQ maintains its lead, up 1.2%. We'll see what happens throughout the hour. But first, Uber is hitting the brakes across the pond. The ride-hailing company is gearing up for a showdown in court after Transport for London said Uber will not be granted a new license to operate in the British capital. Shares reacting today. You can see those off by about 0.75%. The regulator cited what it called a, quote, pattern of failures that can put passengers at risk. And Uber's CEO tweeted in part that this TfL decision is just wrong. over the last 2 years, we have fundamentally changed how we operate in London. We have come very far. Guys, apparently they think they haven't come far enough. We should note that in the interim, it won't change anything for riders in the UK right now because Uber has vowed to appeal the decision, so they get to maintain business practices for a bit here until a judge weighs in on the issue. But at hand is some of the fact that maybe security isn't up to what they want to see over there in London, which, of course, as we said, the stock getting hit today off of this.
Yeah, well, the problem at hand was that apparently some unauthorized drivers were able to upload photos to Uber accounts and then actually start driving around. And for the City of London, they were concerned that there was a security problem there because people are just hopping into people's cars, even though those drivers are not actually licensed by the city itself. A lot of cities, like New York City, have proper protocol for who can drive commercially people around the city. So some concerns there, but it's interesting to see Uber kind of push back as hard as they are right now, saying we're going to appeal this. For what's worth, London is a huge city for them. I think it's part of the 5 cities that really represent about 25% of their revenue. So I think New York's in that club. I think Sao Paulo in Brazil is in that club. London, of course. So, I mean, this is a huge city of interest for Uber, and they hope to get this ironed out soon, I guess.
I mean, I think it's interesting that it's London where this is taking place. London has always had I think some of the first taxi medallions in the world were issued in London in the 1700s. Parliament comes. I was looking this up. Parliament. I don't have that off the top of my head.
Sure.
That would be pretty cool if I did.
No, of course.
But Parliament passed the first act to regulate the taxi industry and start issuing medallions so that only licensed people could operate in the industry in the 1700s and in the 1600s, mid 1600s. And there's always going to be this tension between incumbents who are trying to disrupt a settled industry and those people who have the incumbency because of government.
And we've seen that. I mean, we've seen that here in New York City as well. When we talk about regulations to restrict how many drivers can be on the road at the same time, a lot of people saying that that's just New York trying to support its own taxi industry. Interesting to see the security issues come up, though, across the pond, since that's a little bit of a different lever to pull when we're talking about restricting some of these ride-sharing giants. But nonetheless, Uber right now potentially losing some ground as well to other competitors in London. We're seeing some other reports that some of those companies that do compete with Uber getting a boost here as people wonder if they're going to be able to get Uber rides, despite the fact that, as we said, business practices will continue ongoing for now. But while we're talking about cars and trucks, orders for the Tesla Cybertruck are apparently climbing. According to Tesla CEO Elon Musk, the stock getting a boost today off that news, up about 1.3%. Musk simply tweeted 200K yesterday after posting on Saturday that the electric automaker had received 146,000 orders so far for the Cybertruck. Guys, it comes after Musk explained in part what caused the demo fail, resulting in shattered glass on the new pickup last week in a test of strength. The car was hit with a sledgehammer before that happened, and a steel ball cracked the windows on the Cybertruck. So he says it was because the sledgehammer came first in the order of operations that dislodged the windows. I'm not sure if everyone's believing it there, but that's at least a piece of what happened.
I don't know. They got a lot of media attention for it, though, so I guess that was a double.
Not necessarily good media attention, perhaps you could say.
They should have used the flamethrower.
To try that would have been great.
Yeah, that would have been
solidify
funny.
the window. When we look at the success, though, or potential success of the Cybertruck, it is interesting because obviously 200,000 orders or pre-orders would be a substantial number to point to. But when we look at how people have been reacting to the demo so far, according to Morgan Stanley, 31% of investors think if a material redesign of the Cybertruck happens, it can be successful, which is not necessarily a vote of confidence here, because why would you say, oh yeah, if they redesign the thing they just announced, maybe that'll be successful? That's not exactly a vote of confidence in my book.
Well, this is sort of an interesting thing that takes place in the software world, is that a lot of these companies will release software and before it's ready to go in beta and in early phases, and then get feedback from users who end up fixing some of their bugs for them and doing some of the research for them. So this is sort of taking that software model and applying it to the hardware world.
Yeah, I mean, to the extreme. I mean, what we've seen, though, is that the pre-orders have been pretty impressive already. For Tesla, I think the bigger question is going to be how do you make margins on a truck that has allegedly shatterproof windows and also, doors that don't get dented in at a price point of $39,900.
Starting price.
A lot of trucks are priced above that, and if you're talking about the materials that you need to make this thing, I mean, it's hard to imagine that they're using the same materials on SpaceX in a truck, but we'll still be able to make margins on a price point that's that low, quite frankly.
They'll lose it on per unit, but they'll make it up on volume.
You think? Is that something
they
they
need to
would
have the
sell
production
investors? That's
capacity.
exactly what people are trying to think.
Yeah.
The other thing, too, is that when we talk about Elon Musk giving order numbers on Twitter, I was kind of surprised.
I get so nervous every time he tweets a number.
We saw what happened with the SEC when he had put out production numbers before.
His lawyers are probably a little nervous whenever he picks up that phone.
This is exactly
the
what...
The tweet just said 200K, so it was very vague. So I'm sure, like, if the SEC want to look at it, they're like, yeah.
Well, the other one said funding secured, and it could be referring to that could be referring to anything. It could be,
really could have been anything. But no, I mean, this is what we're talking about. In that agreement, the SEC did say that internal lawyers would have to approve things that were relating to material non-public information, including delivery and/or order information. So presumably they approved this update. Again, just sticking with the Cybertruck, though, one key piece that we need to also point out here. This was a piece of the video from Demo Day. Musk also tweeted out the video pitting his Cybertruck against Ford's F-150. Guys, we talk about a leader in the truck space just getting destroyed in a tug of war. Some people pointing out here that maybe the F-150 model was not exactly the same kind of strength model that we are seeing here in the Cybertruck, and that would kind of sway this tug of war. But nonetheless, clear what they're trying to say here, and that the Cybertruck's stronger than the Ford F-150.
I mean, this is obviously all marketing, but isn't that what a lot of automotive marketing is, really? I mean, there's so many other truck commercials even before the Cybertruck existed that show, oh, well, the Dodge Ram can haul this, giant truck full of chickens or something like that at a faster speed than the F-150 can.
Yes.
I mean, this is all, truck marketing. So
everyone's favorite payload unit of measurement, chicken.
Right.
I agree.
It reminds me of the I'm a Mac, I'm a PC ad campaign from back in the day.
Yeah.
Where they had the lame guy say he's the PC and the cool guy say
Justin Long.
Justin Long, yeah, that guy.
Yeah, no, it's very similar. But then again, when we talk about this, Ford has definitely hit back as the leader in the space. We talk about the success of the F-150. I mean, that will be, no pun intended, the truck that they'll have to make a dent in with here when we talk about stealing some market share. Whether or not that happens, we'll see. But nonetheless, 200,000 orders, presumably, if you believe Elon Musk. All right, well, shifting away from the automotive space, it is Merger Monday, with Charles Schwab officially announcing it will buy rival TD Ameritrade in a deal valued at roughly $26 billion. The stock for both companies, as you can see there, moving higher on the day. TD Ameritrade up more than 6.5%. Importantly, it'll be an all-stock deal, creating a brokerage giant with over $5 trillion in combined assets. And Charles Schwab, CEO, stated in part, quote, "We believe the combination of our two great companies positioning us to be competing and winning in the investment services business for the long run, the very long run." The move comes after Schwab kickstarted the race to zero brokerage fees by moving those all down to $0.
Yeah. I mean, it's hard to imagine that this would have happened without the commission fees going to zero. Robinhood notably being the first company to do that, and then all these brokerages trying to scramble to make sure that they can keep their clients by also bringing their fees down to zero. But when you bring your fees down to zero, obviously your margins are getting crushed. You got to make money some other way. A lot of these brokerages do it by selling the order flow to these market makers like Citadel or Virtu Financial to then make some revenue. But look, at the end of the day, Charles Schwab and a lot of the others in this space have just recognized that you cannot rely entirely on a revenue model that's generated entirely from these brokerage fees anymore. You need to diversify your business lines. So Charles Schwab, actually, the brokerage fees were a very small part of their business anyway. They have a huge asset management arm. They have a huge wealth management arm. So I think the idea is to try to take some of the retail brokerage accounts and then port them over to the other products that they also offer. So buying TD Ameritrade here is a way that they can kind of increase their scale, which is really the only way to survive in this space right now.
And then both of the companies are going to be able to take out a lot of back office costs, and it's going to be the idea is to have economies of scale and efficiencies from the synergies.
Yeah, and as we mentioned before, last week when this deal was first getting reported, that TD Ameritrade also had brought in more money on those commission fees as well. So when you see those cut to zero, obviously a chance to move in and be the big boy in the room. Charles Schwab deciding to pull that trigger, as we now know, $26 billion all-stock deal. All right, well, coming up, China hinting it's making a major change to the way it polices intellectual property theft as the trade war drags on, plus pressure for China mounting in Hong Kong as pro-democracy victories stack up in landslide elections. More on that when Wi-Fi PM returns. Welcome back to Wi-Fi PM. Today we're watching renewed optimism for investors when it comes to U.S.-China trade, that being because U.S. and Chinese trade negotiators are still hoping for a trade deal. And we're watching some positive developments on that front. New guidelines issued by the government yesterday. China said it will increase penalties on those who break intellectual property rights and will also look into lowering the thresholds for criminal punishment for those who steal IP. The release did not give more details on what those moves might entail, though, guys. Of course, though, cracking down on IP theft has been a sticking point for the U.S. as the Trump administration has continued to blast them for that issue. Again, they've raised the idea, this out of the U.S. Trade Office here, and we're looking at it, that it's closer to about $600 billion worth lost on the part of U.S. companies when we talk about IP theft.
Yeah, I mean, I think even those that argue that there's a pretty substantial negative impact of this China trade war would say that, I mean, it still is an issue that we need to address, the theft of intellectual property. So kind of two moving parts in the proposal here. One, to raise the threshold by which China would prosecute people accused of stealing intellectual property, and then also raising the penalty on those that are caught. But then the question naturally is, how hard will China actually enforce those rules, right? It's one thing to say on paper that we're being more stringent on people accused of stealing IP theft, but maybe they don't actually police it. So yes, it's a good step that we're getting a little bit more granularity on this. I think that that's something that was clearly missing in the discussion, at least publicly, about the China trade negotiations. But, you know, there's still a lot of other questions about how China will actually police these new standards.
I mean, we moved from a position of China denying that this ever happened in the first place, really. I mean, when you think about when President Trump launched this trade war, back then they were saying this isn't even an issue. And now, whether or not you believe they're going to actually enforce what they're saying here, they're at least discussing IP theft, which is something that was kind of off the table beforehand. That might lead a lot of people to think that, okay, progress is being made here, despite the fact we have no phase one trade deal yet.
Well, it's like if you want 5 cents, don't ask for 3, ask for 10. And so the idea is you set out your negotiating position in a certain way. I mean, the other interesting angle of all of this is the national security aspect. So companies that are operating in China, both foreign companies and U.S. companies, or both Chinese companies and foreign companies, have to give data over to an IP over to the Chinese government whenever basically they're asked. And the U.S. government doesn't like that very much and thinks that it poses a national security risk as well.
Yeah, and so I mean, if you're trying to resolve all those things, that is the idea that you'll get to those down the road. Use phase one first to kind of bolster, I don't know, good feelings here going into the next round of negotiation. But of course, we still haven't even gotten that phase one trade deal. So that's another thing to watch. You could be optimistic that some real change might happen down the road. But certainly you'd be less optimistic if you can't even get the easy things done.
Could be water under the bridge.
Could be water under the bridge, or under the coffee table, as the case may be. Meantime, though, as we're watching this unfold, there is that pressure when we talk about the trade war front. China also facing pressure, though, in Hong Kong, as demonstrators appear to have scored a huge victory in Hong Kong amid ongoing protests. Nearly 3 million people turned up to vote, with the majority of the district councils expected to flip now to pro-democratic control. Public broadcaster RTHK noted opposition candidates claimed almost 90% of the seats available. And it comes as China's foreign minister told reporters that, quote, no matter how the situation in Hong Kong changes, it is very clear that Hong Kong is part of Chinese territory. There, Brian, would be kind of a clap back at the success they saw in elections there.
I mean, I think this has been probably the most positive development for the pro-democracy protesters in Hong Kong over probably the entirety of the last few months. When you consider the fact that they were able to flip so many seats, and again, these are low council seats, so it's not like this is changing anything. The chief executive is still Carrie Lam, who many perceive to be continually pro-Beijing, but still, regardless, it shows that China is honoring the vote down there, and even some of the most polarizing pro-Beijing lawmakers in some of these council seats flipped. So in Tunmun, for example, Junius Ho was seen as one of the most polarizing pro-Beijing lawmakers in the city. He lost his seat last night. So I think that most of the Hong Kongers, which by the way are a very young base, it's the young college students that are really driving that pro-democracy movement. This is huge for them. But I think the remaining question is that, again, the chief executive is still in place right now. They've been demanding that she resign. That has not happened. She has no indication that that will happen. So I think that it will still continue to escalate, but I think that this is a major win for the pro-democracy protesters so far.
Well, we're talking about 25 weeks of protest, right? When we talk about how long this has dragged on, and now you're kind of getting at least a vote of confidence in those protesters when you look at the election results here. But of course, we heard from President Trump saying that he's both supporting the pro-Hong Kong democracy movement and then also
at the same
supporting
time
Xi Jinping on the other side. So I don't know how you kind of walk both sides here when we're talking about supporting both protesters and China on what has clearly become a very hot button issue in Hong Kong. I'm not sure how the president can really straddle both those sides.
Yeah, well, I mean, the statute is pretty clear that, I mean, Hong Kong is a territory of China, but that doesn't necessarily mean that China is in the right for trying to suppress the rights of the people in Hong Kong. But what we've seen is that because of the statute, it's really difficult for those in the international community to try to rush to Hong Kong's defense, kind of hence the double stepping of President Trump in trying to navigate this whole thing. But I think at the end of the day, we need to consider the fact that the protests are still getting quite violent out there. It's not that this is going to settle anything, but I think it is a step in the right direction. And maybe, you know, and the other thing too is that just the amount of people that actually went out to vote, it really increased the level of, you know, kind of civil engagement in the city because it's been such a polarizing problem. So that's
for
a plus.
sure. I mean, businesses continue to watch it too, as well. As we mentioned, Canada Goose had some struggles there in Hong Kong as well. Some of those high-end retailers who do business in Hong Kong, and one of those making big news today, that being Tiffany & Co. Tiffany stock is shining ahead of Black Friday after LVMH announced it's buying the luxury jewelry brand in a $16.2 billion deal. Tiffany shares, as we said, in the green, rising today. Following news of that acquisition, you can see there Tiffany shares up by about 6.3%. Guys, this will be a record maker when we talk about deals in the luxury space. What do you make of this one?
I mean, there's no one probably to get, no one better to be bought out by than Arnault. I mean, he's a total, he's a genius. He's one of the best capital allocators in the world. Some people, people call him Buffett in Cashmere. Or I guess you could maybe call Buffett the Arnault of Omaha. But just a fantastic capital allocator in Europe. He has a very American sort of capitalist mentality, and he's the exact person you want to help build your brand.
How do you see that working, though? I mean, how do you, in your mind, do you see all these luxury brands working in tandem, pairing Tiffany with all those other brands in its portfolio to really drive gains there, or is it better held?
Yeah, they're not huge on jewelry right now.
No, but so one of the interesting things about the jewelry space is something like 80% of jewelry is not branded. So there's a real large area, a lot of white space for branded jewelry. So Tiffany does internationally have a lot of room to grow, and LVMH is really like the top dog in being able to do that. They know how to pick companies, and they know how to pick brands that have real best-in-class storied histories. And
well, I mean, like Tiffany goods themselves, a pretty high price tag that LVMH paid for it. They were originally proposing, I think a few weeks ago, $120 a share. Ultimately ended up bidding up to $133 a share, hence why you're seeing shares of Tiffany trade around that point in time. But I mean, that's a pretty big premium for a brand that some people have said has actually kind of plateaued in the recent years.
Yeah, I mean, the question is, do you think there's going to be room to grow internationally? And just with all that white space, I think there certainly is.
Yeah, especially in the luxury space. When we're talking about brands specifically tied to a luxury consumer, obviously LVMH has a pretty strong pulse on what they're feeling. Some have raised that Tiffany, with the U.S.-China trade concerns there, that they might be impacted by that, especially if there's a slowdown in China. What might that mean for some of these luxury retailers? But nonetheless, another big deal in the luxury space. But just after the break, how billionaire Michael Bloomberg, looking to drop more than $30 million in political ads, is changing the landscape of the battle for the Democratic nomination in 2020, and why his media outlet is saying it won't cover him during that process. Wi-Fi PM is back in 2. Welcome back to Wi-Fi PM. We're checking the market action we're seeing right now, and it's green across the board. As you can see, the Dow up by about 150 points. The S&P and NASDAQ notching new all-time highs today as tech stocks continue to give the broader market a big boost. Tech, the leading sector on the day so far. We'll see if that changes throughout our hour. Well, Michael Bloomberg is putting his money where his mouth is. The 2020 Democratic hopeful and billionaire will reportedly spend at least $37 million on television advertising over the next 2 weeks. That's according to CNN and data firm from Cantor Media. And Yahoo Finance's Kristen Myers joins us now to discuss how that might shift things in the 2020 race. $37 million is a lot of money.
Yeah, nothing to sneeze at, especially because when you consider TV ad spending, the next candidate, Tom Steyer, also fellow billionaire, is the next biggest spender at only like 1.2 million. So
Wow.
I mean, it's a wide gap that you're seeing.
But is that just because he's so far behind in terms of getting his name out there now? I mean, he's got to catch up some ground here.
No. I mean, he's been spending a lot of money and always has, even really prior to really like his candidacy. And I don't think it has anything to do with the fact that he's behind in the polls and he says to himself, oh, I need to spend, a lot in TV advertisements in order for people to know my name, because you haven't really seen him move the needle when it comes to the polling, with the advertisements. You have like Bernie Sanders, they're only spending like $400,000 on TV ads. Now you're seeing a lot of digital ad spending, like on Facebook and stuff like that. The numbers are much, much higher there. But with TV spending, $37 million for Michael Bloomberg is massive.
So an interesting wrinkle, though, is that in order to qualify for the next debate, you need to have a certain number of donors. It's not just about the aggregate money that you spend. So it sounds like Bloomberg won't be like, great, you got $37 million, but that won't necessarily earn him a spot at the next debate.
Right. So that's a really good point. So the DNC for this election particularly, and we've talked a lot, right, about grassroots like fundraising, those small dollar donors. The DNC actually decided to make that small dollar fundraising a critical part of making it to the debate stage. Who knows? I mean, depending on how much interest, it kind of coalesces around the Bloomberg campaign, if the DNC decides maybe we should include him on the debate stage. I don't know if
they do have the discretion.
I mean, it's not. I mean, whoever gets on the debate stage is up to their discretion. I mean, ultimately, like, I don't think that this is like a
law.
It's not a law, right? There's no law that says that in order to make a debate stage to be the president of the United States, that you have to have raised a certain amount of money or have so many donors. So, I mean, you might see him hit the debate stage. I'm imagining a lot of other candidates would be very up in arms if they allowed him to do that.
Well, I mean, it's basically, obviously at this point, a fact that he's not going to make the next one because there's not enough time to hit 4 polls in time.
Yeah.
So he's off the table for that one.
Honestly, when it comes to, there used to be a point in time where I'd be able to tell you when it came to politics that things went a certain way. I feel like we're in a new era now. I mean, you really can't make that. You really can't make that assumption anymore.
So with Bloomberg, how about his policies, though? The ad I actually saw, he had one on 60 Minutes yesterday, primetime TV. Seemed like he was leaning heavily into the fact that he was mayor like around the time after 2011 or 2001, 9/11. I mean, how is he introducing himself to those outside of New York City, and what platforms are going to be important?
So it's really interesting that you bring up him leaning into his, I guess, mayoral experience, because traditionally mayors in New York City haven't necessarily done very well when they tried to transition from being the mayor of New York City onto the larger stage. As we saw, it has not worked well for Mayor Bill de Blasio at all, by any stretch of the imagination. What you are seeing, because he is a billionaire and because the Democratic field, he's right, obviously he's running as a Democrat now, just for those who might be a little bit confused about, Bloomberg's politics. He was a Democrat, then a Republican, then an independent, then went back to being a Democrat. So he's like flipped among all the different parties. Because the Democratic field has kind of leaned so far left and gone more progressive, he's actually coming out with advertisements saying, I want a higher wealth tax. This is something that a lot of viewers are very concerned about, to have another billionaire in the race, especially when the Democratic field is supposed to be very anti-Trump, so to speak, and very anti-wealthy candidates going out there and trying to buy the election. Bernie Sanders did come out and say, listen, we need to stop letting these billionaires come out and just spend money to circumvent politics, because he's worth over $50 billion. That's 17 times more than Donald Trump. So He's got a lot of money.
It's your billionaire's billionaire.
Without donors, he's got a lot of money to be able to spend on advertising, on his campaign. He's going to be able to go toe-to-toe with Donald Trump, at least when it comes to just pure finances.
Yeah, and we're seeing that already. 37 million being out there for TV buys, so we'll see what happens if he can make that debate stage.
We'll see how progressive he gets. I think he's the candidate that tries to build himself as more centrist, someone that can unite both the Wall Streeters with the very progressive left. I know, Brian, you're making that face.
We'll see.
Yeah,
we're going
to
see how well he does it. I think that's the way he's trying to come off and the way he's trying to build himself.
Not sold
a unifier.
Yet. Well, wouldn't that be nice? All right, Kristen Myers, thank you so much for breaking it all down. Appreciate it. Got to take a quick breather, but we're back with the market's biggest movers on Wi-Fi PM right after this. All right, let's check in with Scott Gamm on the floor of the New York Stock Exchange. Scott?
Hey there, Zach. Keeping an eye on shares of Tiffany. The stock is surging today, up over 6%, making it the best performing component of the S&P 500 as the company agreed to be acquired by LVMH for just over $16 billion. That amounts to $135 a share. Now, with today's gain, the stock is trading just over $133 a share. The company expects the deal to be closed in mid-2020. Now, when you have these big M&A announcements like this one, and we've had a few others today, that tends to, give off some broader optimism for the rest of the market. And you're certainly seeing that action today with the Dow Jones Industrial Average back over that 28,000 mark, being led by stocks like Intel, United Health, and Caterpillar. Those are your three best performing components in the Dow right now. Now, the Dow is not at a record high right now. We're about 10 points shy of the record high we reached exactly 1 week ago today. But also helping things today are some positive trade headlines, especially reports that China will raise the penalties for violations of intellectual property theft. This has been a big wrinkle in the trade war, so the markets are liking some of those headlines today, Zach.
That's Scott Gamm on the floor of the New York Stock Exchange. We'll check back in with you later on in the show. But next on Wi-Fi PM, the Bay Area startup offering Bay Area residents $10,000 to move out of the Bay Area. The CEO of Main Street joins us for more on the innovative incentive to boost talent in the suburbs and rural communities. We'll have more on that. We're back in 60 seconds. Good afternoon and welcome to Wi-Fi PM. I'm Zach Guzman, and joining me today is Yahoo Finance's Brian Chung, along with Quidtum Director of Research Max Raskin. Guys, good to see you. Happy Monday.
Happy Monday.
Happy Monday right there. It's a very enthusiastic Happy Monday. And right now, we're seeing a lot of enthusiasm in the markets. The Dow up by about 137 points. The S&P 500 and the NASDAQ both hitting record highs to start the week. The NASDAQ maintaining its lead up by 1.2%, the biggest gain so far on this very fine Monday. We'll keep our eyes peeled on the market action throughout the hour. All right, well, calling all California residents, if someone offered you $10,000 to leave the Bay Area, would you take it? Well, it's not a hypothetical question any longer. That being because a Silicon Valley startup called Main Street is launching this initiative amid the state's housing crisis. And joining us now to discuss is the co-founder of Main Street, Doug Ludlow. Doug, it's good to see you. I want to start why you're offering this $10,000 incentive for people in the Bay Area to move out.
Sure. Well, our mission, or Main Street's mission, is to help create jobs and opportunity in suburban and rural communities. And we want to do that by linking the talent that lives in these communities, right? There's a lot of smart, talented people that live in places other than the Bay Area, other than New York. And this $10,000 incentive is really a way to capture people's attention, capture people's imagination, and let them know that, hey, there are other places to live where you can have a fantastic job that isn't the Bay Area, that isn't, a densely crowded, very expensive urban area.
And a couple caveats to note, too. The $10,000 incentive expires at the end of the month, right? So there's that, and then also they need to stay with the Main Street career provider or employer that you guys line up for a year, right? So there's a couple things tied to that offer.
That's right. Yeah, so this is an incentive to kick off our company, to let people really introduce us to the general population and those who might be interested in Main Street. And yeah, once we connect you with a company and once you decide to move or work remotely with a company in an area outside of the Bay Area, you do need to be there for a full year, just to make sure that the role is working out with you and the company that you were hired with.
Got it.
Which areas in the United States do you think are the most exciting outside of Silicon Valley? I mean, there's in the past, Pittsburgh used to be kind of like a Silicon Valley. Is there a place in America right now that you're particularly excited about?
Well, so I grew up in a rural area, Modesto, not too far from San Francisco. So I think there's opportunity everywhere. The first few places, the first cities we're going to are Sacramento, Tulsa, Salt Lake, and Portland, which are smaller cities than, let's say, San Francisco or New York, where there's already a huge amount of remote work happening. There's a huge amount of talent. That's going to be our first jumping off point. And then our vision is to be in roughly 500 to 1,000 cities by the end of the decade. So we're starting off where there's a lot of interest and attention, and we really hope to be everywhere in every main street across the country.
Hey Doug, Brian Chung here. So it's funny that you mentioned Tulsa. I was reading up that Tulsa has their own program where they'll actually pay someone $10,000 to relocate and then work from home in that city. So are they doubling up on that in that case? And how many other cities are you seeing those types of programs being put in place such that it's not only you being paid to leave the Bay Area, but you also being paid to enter a city that might be needing more labor?
Yeah, so we know the people behind the Tulsa Remote program really well, and really inspired by what they've been able to do. They've been able to attract hundreds of people to Tulsa to help reinvigorate the economy, to help bring remote jobs. And this is something that that our company actually plans to work with, right? That these incentive programs that are not unique to Tulsa, as you mentioned, really just about, there are hundreds of cities across the country that actually have incentive programs to help bring jobs, whether it's through, cash incentives, whether it's through office space, whether it's housing assistance. There are communities all over the country that are really, really eager for something like this. And our mission and our vision is really hope to work with these people to help bring jobs to the community, not to compete with them in any way.
A couple questions here, Doug, in terms of that vision down the road. I mean, for starters, how many people have you seen apply to take you up on your offer for the 10K so far as we close in on the November deadline? And then also beyond that, would it be fair to say that you're kind of setting yourselves up here to kind of be a WeWork for talent or some sort of headhunter agency that really draws out the best talent that the Bay Area has to kind of redistribute across the country?
Sure. So as of applications so far, it sounds kind of silly, but 1 out of every 1,000 households in the Bay Area have applied.
Wow.
So we've had, yeah, I know, it's crazy. It's thousands of applicants, just because people are looking for opportunities. And it's very rarely about the $10,000 incentive. It's about, I want to afford a home for my family. I want better schools for my kids. So the response has been great. And long term, you asked, are we planning to be a WeWork for remote talent? And no, I mean, we think that providing a community for remote workers is vitally important. And part of that is, a space where you can work alongside other people, other talented, interesting people. But our goal is not to be a landlord. Actually, we're much more of a platform that brings together cities and talent and people and space itself. So we hope to work with co-working spaces. We hope to work with cities. Maybe we'll work with WeWork someday. But our goal is to be the facilitator of this, not the landlord for these spaces.
All right, Doug Ludlow, breaking it all down. Congrats, at least, on attracting that many people looking to buy into this incentive here. Thank you so much for joining us. Appreciate it. All right, well, after the break, the mobile-only coffee shop co-founded by former Uber employee number 25. Why Bandit Coffee is looking to undercut Starbucks with expedited coffee that doesn't come with expensive storefronts when Wi-Fi PM returns. Welcome back to Wi-Fi PM. Today we're talking about a company on their grind. It's a new coffee shop that can go from a vacant space to fully operational in just a few hours' time. Bandit is a mobile-only startup that's utilizing empty spaces around New York City and says it can serve a caffeine kick for 25% less than the average shop. And joining us now to discuss is Bandit CEO and founder Max Crowley, along with Bandit co-founder James Gallagher. Guys, thank you so much for being here.
Thanks for having us.
Max, it's interesting. We were talking before this. You're Uber employee number 25, or were Uber employee number 25, I suppose. This kind of harkens back a little bit to the tech savviness of an Uber to kind of solve a problem. How is Bandit doing it differently than maybe a giant like Starbucks is doing?
Yeah, absolutely. So, I think at Uber, we saw what sort of a mobile app or technology can do to an everyday occurrence, like getting a ride or going somewhere. And so we wanted to bring that same magic to getting a cup of coffee. And so there's nothing more everyday than drinking coffee. 65% of the country drank a coffee in the last 24 hours.
Yeah.
So, the market's huge. And we think that, with being app only and having people come in and request via an app, we can give them a new type of convenience that just doesn't exist today.
So explain to us exactly how it works for someone that wants to get a cup of Bandit coffee. Where do they go? How do they find where it is? And why Why was that part of the business model? Is it because the overhead for a brick and mortar permanent location is just so high, especially in the cities like New York?
Yeah, I mean, retail is changing a lot right now. One of the things about Bandit is that by having a mobile app and requiring all of our customers to download the mobile app, we're actually building a digital relationship with our customers. And that's really important. It's something that actually brick and mortar retailers are desperate to do right now.
Mm-hmm. I mean, when we look at it too, we hear the same kinds of things from Starbucks now, even kind of pitching themselves as a tech company, a digital company, more so, you could say, than a coffee company now. So I mean, how hard is it to do that when you guys are starting out from square one and they already have all the locations, unless you look at those locations as actually a negative?
Yeah, I mean, so that's where we want to innovate, from the consumer perspective. So that's the mobile app and being mobile app only. It's still a low percentage of their transactions that are actually order ahead. It's like 13% last quarter, where for a Bandit, it's all of our transactions.
Yeah.
But we're also innovating on the coffee shop itself. So we actually build our cafe units in a manufacturing facility, and we ship them to New York, and we can have them up and running in just a few hours.
That's the interesting piece of this too, the 11 by 11 platform here.
Right.
That's what
so
Brian
in terms
was excited about.
it's exciting because it's so easy to set up. You could put it in a lot of small spots too. So you're opened up in New York City for right now. I mean, in terms of expansion strategy, because this is kind of something I imagine you could probably scale pretty easily, what's the plan from here?
Yeah, definitely. We're going to be, our aim is to launch a few more locations over the next couple months. And then before the end of Q1, we're going to be testing outside of New York. Because it is so scalable, because it is so quick to launch, it's really appealing to landlords as well. It's not just good business for Bandit to be able to open in, a couple of hours or really, from soup to nuts, 30 days or less, but it's actually good business for landlords because vacancy is expensive.
Yeah, how do you pitch that when you go into this meeting? Hey, look, we have this plan. It only takes 11 by 11, but here's how we're going to get ourselves into.
We can be flexible partners, to landlords. It's about the partnership model. Being able to activate 2,000, 3,000 square feet of space or 500 square feet of space is really, it allows us to fit into a number of locations, vacant retails, lobbies, a number of different types of formats. And being modular and constructing in a factory allows us to tailor that very quickly to the space.
And to scale really quickly, I imagine, as well. But for everyone watching this, I suppose it all sounds nice and you want to buy into the idea that tech could drive some of these costs down too. But unless the quality product is there as well, and I know you brought some in, right? This is how does that all tie into it in terms of driving costs down, and where do you want to be price point wise compared to some of the other competitors out there?
So we want to be more affordable than what exists today. So this is like super high quality coffee.
That is high quality coffee.
All right.
I'm not exactly
I'm gonna reach over here.
I'm not a coffee connoisseur,
you-
by the way. I just started drinking it maybe a couple weeks ago.
Really?
Very new to the space.
Okay, nice. So what you're drinking is a single origin, single estate coffee, so super high quality beans. We work with a roaster locally, so they're actually in Red Hook called Pulley Collective. Super awesome concept. It's this space that two guys started. They have big, roasting facility. They've got multiple roasters there, and we work with them. They actually have a farm in Nicaragua that they source for us on our behalf. So, the key here is it's super high quality coffee at a price point that's lower than Starbucks.
Yeah.
And if you talk to most people that go to Starbucks, I mean, the quality is, it's iffy at best. So that's the difference that we want to bring, sort of high quality to the masses.
Yeah, for sure. All right, Max and James, thank you so much. Bandit Coffee out there now, and I appreciate you bringing in the caffeine boost.
Yeah, this is
great.
great.
The show
So
also
much.
very good. Thanks, guys. Good luck.
Thank you.
Thank you.
All right, well, coming up, more than 50 million frantic Americans have called the Butterball hotline in Turkey turmoil since its inception. So what disasters are actually most common? What should you be avoiding? We're talking Turkey with Butterball right after this. Welcome back to Wi-Fi PM. We're checking the Monday market action we're seeing right now, and you can see the Dow up by about 135 points. The Nasdaq maintaining its lead, up about 1.2% as the S&P 500 and Nasdaq both notch new all-time highs. Well, Thanksgiving is just a few days away, and if you're already stressing over how to cook your bird, fear not, because Butterball is offering Americans turkey tips through their national and toll-free turkey talk line. And joining us now is Butterball turkey talk line expert Carol Miller, who joins us in studio. Carol, thank you so much for being here.
Hi, guys.
You have worked on the Butterball hotline for quite some time here.
Yes,
right?
36 years when I was a sweet young thing.
Well, I mean, I'm not saying that you're not now. So, I mean, when we look at this, what do Americans call most about, right? If you've been there for 36 years, have things changed? Have we gotten smarter about turkey?
You know
or are we
what?
just as inept as always?
You know what? The top question since 1981, when we took the first call, was how to thaw the turkey. People don't realize that this big, giant 20-pound turkey takes days in the refrigerator.
Yeah.
So Thanksgiving morning, you can do a knock-knock joke on the turkey. So think ahead. You need 1 day for every 4 pounds of turkey.
Okay, wow, 1 day for every 4 pounds.
Yeah.
Okay, so I already learned something.
Yeah, I mean, listen, I don't want to talk turkey, but
you got it in.
But yeah, I got it in. The TV show West Wing, there's a famous scene where the president calls the Butterball hot. Is this true?
He is so serious. I loved West Wing, and I loved that episode. And the sweet young woman, or I think she was a little not young, she called to warn us the day that they were promoting it that he was going to call that night to talk to us.
Oh, that's...
I know.
It's a fair heads up. I mean, you guys get a lot of calls, not just from the president and West Wing, but also 10,000 calls on Thanksgiving Day alone. So how do you feel? Because it's only 50 people, right?
Yeah, and you know, we don't just do calls. We also do email and live chats and text and Facebook and it goes up and up and up as technology increases.
So, in terms of the staff that you have, what's the credentials that you're looking for in someone that can help out on the hotline? Do you have a test to make
You
sure
know
that these
what?
people are qualified?
Yeah, we're all food professionals. We have dietitians, educators, chefs. We have a guy who actually worked for Butterball who was a food scientist, so he knows it from a whole different angle than we do. We go to Butterball University.
You teach at Butterball.
I teach at Butterball University. All of our freshmen, sophomores, and juniors come and they go into the test kitchen. Each one is assigned a turkey, and just like on Thanksgiving, they have to get it to the table at a particular time. And then we all walk around and we look at the results so that when the phone starts ringing, you've seen that turkey that's been cooked in a cooking bag or in the microwave or whatever.
Yes,
I would fail that class so fast. I would fail that class.
Let me ask one quick question. What is your favorite way to eat turkey?
Yeah, because some people
Oh, that's good.
And deep frying is like what we
You know what?
we deep fry it.
The millennials are taking over.
So
Not the whole world, but for Thanksgiving, you pass on that tradition.
Yeah.
And they are deep frying their turkey. They're smoking their turkey, grilling their turkey, cooking in the air.
The air fryer.
Air fryer,
So which one do
way.
you say?
I like to barbecue my turkey. Thanksgiving is not the only day for turkey.
Absolutely not.
4th of July. on the grill.
I say it's good all year round. Brian does not agree, but Carol Miller, thank you so much
Oh,
for
thank
joining
you,
us.
guys.
Appreciate it.
Thank
Good
you.
luck. Good luck with this year's questions. And a reminder to stay tuned to Yahoo Finance tomorrow as I partake in the world's most expensive Thanksgiving dinner that cost over $180,000. There's a turkey covered in gold paint, gold dust, and gold flakes, Dom Perignon, and even a cruise to exotic locations. And that is just the beginning, ladies and gents. You will not want to miss it on tomorrow's Wi-Fi PM. All right, well, Max Raskin and Brian Chung, thank you guys for sticking along for the ride. Good
Thanks.
times. I thought that went well.
It was a lot of fun.
We're headed to the New York Stock Exchange, though, in 60 seconds, right after this. All right, let's check in of the New York Stock Exchange. Scott?
All right, Zach, thank you. I am joined now by John Mayer, the Chief Investment Officer at Global X ETFs. So, John, markets optimistic about a trade deal. How do you view the situation?
Well, I'm generally optimistic about a trade deal. The markets are at an all-time high, and when that happens, Trump has a tendency to take advantage of a market that's at an all-time high to try to use it as a leverage point. So that's a little concerning to me in terms of a trade deal. On top of, you have the Hong Kong protests, the pro-democracy council that was voted in Hong Kong. So a little nervous, but generally feeling pretty good.
Meaning President Trump likes to tout the success of the stock market, and when we're at record highs, maybe he has less pressure to make a deal with China.
That's right, Scott. So much less pressure because he ties himself to the stock market. Stock market's at an all-time high. That's a leverage point. I have more leeway to negotiate with China.
When President Trump says that, China wants to make a trade deal more than he does, do you buy that, or what do you make of the dynamic between the two nations?
Well, I think China right now certainly could use a trade deal. America could use one a little bit less than China. What's going on right now is something that really needed to happen. Whether you agree with Trump's tactics or not, this is a bipartisan thing in many senses because China has been taking our intellectual property over time. So in a sense, this has been a positive. The actual routes, that can be argued.
When we have stocks at record highs like they are now, let's say we get a phase one deal before the end of the year, what does that kind of news do to the stock market?
Without a doubt, you're going to see a pop. I don't know if it's 2 to 8%, but I expect a pop before the end of the year if there is some sort of skinny deal with China. That being said, where do you deploy money? Well, interest rates are very low, so there's this tremendous need for income. There's also some need for growth as well. So high quality stocks with good cash flows, I think, make a lot of sense, especially in a very low interest rate environment. And I expect that you'll see a lot of value-oriented investors out there.
So I guess the trajectory of the market for the rest of the year largely depends on that trade deal, or do you think there are other factors at play?
Well, the broad markets are up about 27% so far. How much more can you really push it without some sort of catalyst? So I think you need that catalyst for the market to go meaningfully higher than current levels over the next month. So that'd be correct.
All right. John Mayer, thank you so much. Great to see you. Zach, we'll send it back to you.
All right, coming up, Uber receiving a blow to its operations across the pond. The details on that next. The ticker starts in 2.
Good afternoon and welcome to the ticker on Yahoo Finance. I'm Akiko Fujita. We are breaking down the biggest stocks to watch today, and we are seeing that risk appetite return to the markets today on some trade optimism as well. The S&P 500 and NASDAQ hitting fresh record highs. The Dow is up 135, the S&P up 18, and the NASDAQ up 101 points. Let's start with our big three tickers of the day. A stunning decision by regulators in London is taking the air out of Uber. Tesla is climbing into the green as Elon Musk details orders for that new Cybertruck, and eBay will be making a pretty penny after announcing the sale of StubHub. First, though, to Uber. Shares there are selling off after the ride-hailing company was stripped of its license to operate in London. The company says it's now appealing the London transport regulator's decision, saying in part, TfL's decision, this is the regulator, not to renew Uber's license in London is extraordinary and wrong, and we will appeal. TfL found us to be a fit and proper operator just 2 months ago, and we continue to go above and beyond. Jared Blickery is with me at the Wi-Fi Interactive board. So, Jared, just to clarify, Uber can still operate in London as it appeals this decision, but this is something that they have seen before back in 2017. Now here we are 2 years later. How is this decision different?
Well, this could potentially be a debacle for them. And as you said, they have the right to operate as long as this is proceeding, and they are appealing it. And in theory, this could be take several years to clear out if all the appeals go up to the highest court there. But really, Uber has a couple of problems working for it. There's a survey that went out by the Transport for London, and they found about 14 or 15,000 cases where drivers were actually not the correct registered owner or the registered driver for Uber. And so this creates a security issue, and this is what it's based on. And you're right, 2 years ago, Uber was in a similar situation. They appealed and they eventually won. And in the meantime, they were able to conduct their business. And I'm sure Uber really, really wants to work this out with the authorities over in London. But this could affect 40,000 jobs if Uber doesn't win this.
40,000 jobs, That's pretty significant. I saw that note out from Dan Ives today from Wedbush calling this a seismic blow. He says 3 to 4% negative impact to ride-sharing revenues if this appeal process doesn't result in Uber moving forward and continuing to operate in London. What's the timeline we're looking at right now?
Well, the first appeal could take a matter of months to settle. And again, if Uber loses this, they could take a number of years to go to the highest court in the land. I mean, if we take a look at what the stock price has done, it's not the most flattering picture, although they did pare some of their losses after the open today. And let's go to a max chart so we can see what it's done since the IPO that took place in about May of this year. And we can see it's been a steady slog down here, just hitting new lows in November. Not really a pretty chart, down 30% from its May highs here, or June highs. Overall, you can compare them to Lyft, which is more of a pure operator, really based in the United States, doesn't have that much operations overseas. Lyft isn't going to be exposed to this the same way Uber is. But you think about the litigation risk alone, and also the fact that these gig economy drivers in California recently won the ability to basically become full-time employees or become treated like them. And that's not happening just yet, but that really could take a bite out of its bottom line if it does come.
Okay, thanks so much for that, Jared. We are also watching Tesla this afternoon. CEO Elon Musk says orders of that new Cybertruck have already climbed to 200,000 despite its less than stellar debut. You may recall last week the window shattered during the big reveal. Melody Hom is with me from Los Angeles. So Melody, I guess we should take this with kind of a grain of salt, right? $100 refundable deposit for the Cybertruck is not a whole lot for riders to put down if they want to at least hold their place in line. Do we know where all the demand is coming from?
Exactly, Akiko. And let's keep in mind, pre-orders are not actual sales. And even with that refundable deposit, we know that manufacturing of the Cybertruck doesn't start until 2021, at the end of 2021, which is a full 2 years from now. So very likely, whether it's 50% of these quote unquote pre-orders or more, they could end up pulling those requests. I want to use the Model 3 in 2016 as an example, right? Elon Musk famously tweeted that they got 180,000 in pre-orders in one day after that accessible Model 3 was announced in 2016. But then people got impatient. I think Tesla has a famous predicament of not understanding how to make sure that demand is met. I don't think Tesla for a long time has had a demand problem. It is trying to understand how production can actually meet that number. So to your point, it's a great headline, it's a great tweet, and I'm sure Musk will continue to tweet out updates through the course of the day. But we know that Musk has a very strong cult of personality. So regardless of what he unveils, whatever quote unquote mishaps we end up seeing, ultimately I think there will be this hub around him that will want to support him no matter what, whether that's with a flamethrower, a Boring Company hat, or a Cybertruck.
He always keeps things interesting, right? Speaking of tweets, we've seen Elon Musk maybe trolling Ford just a bit. I wonder if we can pull up this video. He showed this Cybertruck pulling Ford's F-150, a truck. They're saying that it has the same strength. He also, though, took to Twitter to explain that big mishap of the window breaking during that big reveal. What did he say about that, Melody?
Yeah, Kiko, this actually has some sound context to it, because if you think about it, they actually demonstrated the sledgehammer being hit against the door right underneath that window. And right after, they ended up throwing that metal ball against the window. And therefore, Elon Musk's defense was essentially that when the sledgehammer knocked the door, it ended up cracking the bottom, the base of the window, and made it a lot weaker and vulnerable for anything to hit it. So as you can see here, Franz von Holzhausen, who's the chief design lead at Tesla, doing the demo pretty much scratch-free. Granted, you see the towel underneath it, you see a little bit more protection prior to the live demo, but I think it was just too much stress for a car to endure for all of those demonstrations and balls being thrown at it simultaneously. So that was Musk's defense. I also want to point out that we see Tesla shares up today, this on the heels of that Morgan Stanley note, basically pointing out that, yes, we understand it's weird, the demand might kind of be manufactured at this point, but ultimately 31% of survey respondents that Morgan Stanley actually reached out to, which is the investor class, say that the Cybertruck can be successful with a material redesign. The same percentage, 31%, say they're extremely disappointed and think it's a failure, which is a very interesting dichotomy there. Of course, 9% are undecided and 29% find it moderately disappointing, but still not an epic failure. I do want to point out, though, that 0% of respondents actually think it'll be a success in the current form. Akiko, of course, full caveat. This is a survey, a very snap survey of around 65 people who are institutional investors. These are not necessarily the people who are Musk adorers and aficionados to the point where they would be signing up for those pre-orders right away.
Yeah, interesting to see how the design can be so polarizing. Thanks so much for that, Melody. Let's move on to our third ticker of the day. That is eBay. The company announced plans to sell StubHub to Swiss ticket rival Viagogo for roughly $4 billion in cash. The combined entity will sell tickets across 70 countries. Now, this comes after Yahoo Finance's Andy Serwer spoke with StubHub's president earlier this year about a possible spinoff.
Elliott Management is an active investor in eBay, which is our parent company, and has made a number of public recommendations to eBay, including a strategic review of its portfolio, which includes StubHub. That's going on right now. They also joined the board and I think came to agreement with eBay on the actions eBay would take. And so I think it's been constructive and it's ongoing. So strategic review ongoing. Is the company going to be spun off? No answer, no conclusion, nothing to share right now.
Okay, Inez Ferre is with me here at the desk to delve further into this deal. So we knew that eBay was under pressure from activist investor Elliott Management as well as Starboard Value. Viagogo isn't exactly a stranger to StubHub, right?
No, that's right. So the founder and CEO of Viagogo actually was the co-founder of StubHub when he was in business school, helped start this company, and then left the company before it was sold. And his dream has always been also to combine these companies, because as you said, it will operate now in 70 countries. So it is something which is, StubHub is not necessarily something that Viagogo is unfamiliar with. This makes sense. It would make sense that they would acquire this company.
And looking at where this leaves eBay. Now, one of the arguments from Elliott and Starboard was for eBay to be more focused instead of diversifying, which is why they spun off StubHub. But where does that leave eBay? Because it has tried to diversify. That didn't work.
Right.
What is it left with, and what's the turnaround story here?
Well, really, the story with Elliott Management is that they have been wanting a revitalization of the marketplace, to just focus slowly on marketplace, to get rid of StubHub, to also sell their classified business. And this is part of the reason why as well. Of course, you saw their CEO, Devin Wenig, who stepped down back in September. He didn't want to sell the classified business. It was really going head to head with the board there. But this is a win for Elliott Management. This is a win for the activist investors who had been pushing for this type of change. What are they left with? I mean, StubHub was actually comprised of 11% of the total revenue for eBay in the third quarter. So this is significant. Of course, they bought this property for $310 million back in 2007, this company. So they are getting a great deal by getting $4 billion for it. But this is more of eBay just going straight towards this marketplace. They have tried to revitalize the marketplace. When Wenig was there, he tried to make it so that younger customers would shop there, so that also they included some AI to be able to compete better with Amazon. But certainly this tells you the kind of strategy that they may be taking forward.
Yeah, and we're seeing eBay get a healthy pop on the back of the news. Coming up, why investment advisors may have a lot to fear from Charles Schwab's acquisition of TD Ameritrade. We will have the details there next. It is Merger Monday, with Charles Schwab officially announcing it will buy rival TD Ameritrade in a deal valued at roughly $26 billion. Shares for both companies popping, although TD Ameritrade, take a look at that, up more than 6%. It will be an all-stock deal, creating a brokerage giant with more than $5 trillion in combined assets. Joining us now is Dryden Pence. He is the Chief Investment Officer at Pence Capital Management. Dryden, your take on the deal?
Well, I think that it was executed actually brilliantly by Schwab. I mean, they basically found the vulnerability that TD had was the biggest piece of their revenues. Big piece of their revenues were commissions. They were able to drive those down. That pushed the price down, and they were able to kind of force it into a bargain. So from a technical deal point, it was actually quite smart, very brilliant on Schwab's part. Now, having said that, there's a lot of other things that come from that we have to deal with.
Like?
Well, I think that
one of the concerns that have been raised is, what does this mean for the investment advisors themselves?
It means a lot for the investment advisors. It also means a lot for the industry as a whole, because what I fear in this is that people get really tied up over the free trade issue. You know, a free trade is very expensive if it's the wrong one. And if we're in an environment where everybody is incentivized to trade a whole lot, this hyperactivity actually becomes more of a game than investing. And I'm not sure people want to be doing that with their retirement.
What do you mean by that?
Well, you see a lot of people, because it's free, Now they're going to start trying to trade their own retirement plans or do those things. It becomes almost recreational. And I think people have to decide whether doing this is an investment or recreation. And I think that before, people didn't trade quite as much because of the incremental cost. Now, when you make that free, I think you may incentivize a lot of people to make this more of a game than as serious as it really needs to
What
be.
does that mean from the investor standpoint? There's a lot of concern about whether you can maintain service quality, especially when you talk about this game, quote unquote,
Exactly.
that this can become. What does it mean for the investor themselves?
Well, for the investor, people need advice. This shouldn't be a free-for-all. For a lot of people, this is their retirement. This is the wealth for the rest of their life. And I'm not sure that everybody needs to be out there sometimes running with sharp objects because they can get caught up in trading speculation, or they can get caught up in the deal of the day, and then very, very susceptible to headline activity. So I think that what we really need to do is recognize that this takes some of the advice out of the market, and I think that's risk for people as a whole.
I want to talk about your broader market outlook,
Sure.
because you say there's a chance that things could get worse before they get better, and you're talking specifically about the trade issue. We're seeing the market up today on some trade optimism because what China is reportedly doing on the IP issue, but it sounds like you still think the December 15th tariffs are still going to go through.
Well, the president has found his weapon of choice. Tariffs are the president's weapon of choice, and that's been effective. And so I think that in this case, if they're not able to get to some kind of deal, I think you're going to see a lot of headline activity around that, whether he imposes them or not. But it's a way of forcing the Chinese into actually moving forward on some of this stuff. So I think the November the 15th becomes really important as we move through these next rounds, because if he has to impose those things in December, you're going to see some probably volatility and panic, and some of this stability that's been brought back into the market could fade. So I think that's why it's important. It's a headline risk, but long term, I think the trade things subside over time.
How much of that risk has actually already been priced in, you think? You look at where the market's moving today, we're talking about more records again for the S&P and the NASDAQ. I mean, it doesn't seem like investors are actually putting December 15th on the calendar, or is the volatility already priced in?
Well, what's interesting is every time we get to one of these highs, then we get some sort of headline activity that creates volatility, then feeds upon itself, and people tend to panic through these things. So I think that you could see some of that, but many of the other things that were driving the market in terms of driving this volatility have really subsided. I mean, Fed's pretty much off the table. You've got a variety of other things. You've got a budget impasse pretty much off the table, it looks like. So all of these things have kind of subsided. So we're moving into the end of the year, where the big thing is this tariff issue, and that's probably the last big news item that could create some external volatility into the markets.
Dryden Pence, great to have you in studio today.
Absolutely. Thank you for being here.
Coming up, Novartis announcing a major acquisition that is sending shockwaves throughout the pharma business. We'll explain coming up. Welcome back to the ticker. Let's do a quick check of the markets right now. Green arrows across the board. We've had our eyes on the S&P and the NASDAQ as we've seen both of those hit another record high. Let's head out to Scott Gamm on the floor of the New York Stock Exchange. He has an eye on the Dow. Scott.
Hey there, Akiko. Well, yes, the Dow is up a little bit more than 140 points, but we're still about 60 or so points shy of last week's record high in the Dow. But our viewers will notice that the Dow is back above that 28,000 mark, which we first hit about 10 days ago. Now, the gains today in the Dow are being led by names like United Health, Intel, Dow Inc., and Caterpillar. You have a perfect storm for a rally today. You have some M&A activity. Those headlines tend to help the broader markets. You also have some positive trade headlines, specifically with reports that China will be raising the penalties for intellectual property theft. That has been a big component of the trade war that we've been in for about 2 years now. The laggards in the Dow today are some of the safer names in this market, the higher yielding names. We're talking about stocks like our parent company, Verizon, ExxonMobil, and McDonald's. These are some of the highest yielding stocks within the Dow, and that tends to be the case. You see a rotation out of some of these safer names and into the higher growth names on days like today when you have a pretty risk-on environment. Akiko.
Okay, thanks so much for that, Scott. Well, turning to the pharma industry now, Swiss drug maker Novartis is acquiring The Medicines Co. as it looks to challenge cardiovascular medicines from competitors like Amgen and Sanofi. The $9.7 billion takeover deal also gives Novartis, the biotech company's new cholesterol drug, inclisiran. Yahoo Finance's Anjali Kamlani is with me. So, Anjali, let's start with the price tag, because that's raising a lot of questions about this big price tag for a drug that's not going to start generating revenues until what, 2021?
It still has to. So they've completed the phase 3 clinical trials, and they're waiting now for the FDA process. And this drug has shown promise with cutting down bad cholesterol or plaque buildup in the arteries in patients within like 18 months. And so what they're looking at is the buyout on that. So there's some analysts saying that they estimate this drug could peak at $4 billion annually, which in the trade-off for $10 million isn't so bad. And they're talking a lot about, like you said, Amgen and Sanofi are the only competitors out there. So it really puts them ahead of the game because they have drugs that they're marketing, but they don't have as favorable, coverage.
You also pointed out that this company under CEO Vas Narasimhan, I think I'm saying his name right, has been quite acquisitory. This is just the very latest. What's the broader strategy that Novartis is building right now?
It looks like, for a while Novartis was known as this really big oncology company, and once that went off patent, it looks like they're really expanding. And so this is proof of that. Within the last 2 years, Novartis has made 4 big deals totaling $24.4 billion, including Medicines Company. There was also Avexis, a gene therapy company, for $8.7 billion, and then 2 oncology companies for roughly $5-6 billion. So it kind of shows a little bit of diversity there.
Okay, thanks so much for that. Anjali Kamlani with me here at the desk. Coming up, how U.S. politics could shake up the S&P 500 next year. We have the details on a new outlook from Goldman Sachs. Goldman Sachs is forecasting the S&P 500 index could rise by 5% to 3,250 in early 2020 as the U.S. bull market enters its 11th year. But the bank also warns that rising political and policy uncertainty will likely keep the index range-bound for most of next year. Now, Goldman says that means 3,400 at the top level if there is one clear political party controlling Washington, D.C. The bottom level, 2,600 if the government unifies across party lines. Joining us now is Dan Wątrobski. He is the research director at Janney Montgomery. Scott and Dan, it's interesting when you look at the headline of this note, united we fall, divided we rise. It's usually the opposite, right? What exactly are they highlighting here, and do you agree?
Yeah, so I mean, look, it's always tough to give these projections for the year ahead. And in our environment right now, I think even doubly so. We have a ton of macro and geopolitical uncertainty out there. And really for a lot of 2019, based off that macro and geopolitical uncertainty, our market's really below the S&P 500 and Dow making new all-time highs. The rest of the markets have mostly been range-bound. If you look at the Russell 2000, which is doing very well today, or the small cap 600, these are benchmark indices that have been trading sideways through most of this year. So really what we saw was a concentration in U.S. large caps. And again, it comes back to that geopolitical and that macro uncertainty that exists. It's building a tremendous wall of worry for investors.
Dan,
I think headed into
For much of the last few months, we've heard from a lot of analysts who've come on the show who say, look, don't trade the domestic political risk. As you point out, it's all about geopolitics. But now we're getting into the heart of the 2020 race come January. What do you see as the biggest political risk to the bull market if we're talking just the domestic headlines?
Well, I think it'll be a binary shock if you have some of the Democratic front runners moving up the ranks in terms of sentiment and voting popularity. And I think that could provide a little bit of volatility to the U.S. markets. But again, in looking at the history of the markets, one of the key functions that powers bull markets has less to do with our political process and more to do with big underlying drivers. And regardless of who wins the House next year, these drivers are still very much a part of this cycle here in the U.S. So beyond 2020 and any volatility that presents itself, we have big plans for the S&P 500 in this bull market. We think there is a very distinctive demographic cycle underneath this system that is powering the U.S. We think valuations are decent here. Stocks are not ridiculously expensive as they were in prior cycles. We think the credit markets and the financial system is functioning properly. And we think our central bank stands ready, willing, and able to supply this market with liquidity. And that's key. We always say, America runs on Duncan. We always say, U.S. stocks, the stock markets run on liquidity. When the Fed provides that, it is a tremendous tailwind, in my opinion. So you have the Fed backstopping the repo markets. You have a Fed that comes out and says, we are going to be accommodative where need be in terms of rate policy. And I think that could be tremendously beneficial to the U.S. market. So if we do have some election volatility next year, we're going to be looking at that as really a buying opportunity in a broader secular expansion here in the U.S., a broader bull market.
Dan, one of the big concerns from a corporate standpoint has been the pullback in investment. The Journal out with a story today talking about pullback from spending on equipment and other capital investment because of the uncertain business environment. We're talking about names like Harley Davidson, AT&T, and Target, all joining small businesses and putting the brakes on investment. What are you seeing on that front? We've heard on the one hand that, look, we're not hearing as much about trade, the word itself, in some of the most recent earnings calls, and yet that still seems to be the cloud hanging over a lot of these big names.
Yeah, absolutely. And so you bring up a good point. And again, it all circles back to liquidity, right? Liquidity can be provided to the markets via the private sector, and that's through all that CapEx spending. In any secular expansion, in any stocks bull market, that liquidity provided through CapEx spending from the private sector, that typically tends to be the best source. When there is macro uncertainty, geopolitical uncertainty, that private sector pulls back, because they don't know the future. They don't know how to plan for it. That is typically when the public sector comes in through monetary policy. See, that's what the Fed is doing here. On that pullback in CapEx spending, which I realize that article is today, but actually if you look at U.S. small business CapEx spending, that actually started drying up last summer, in the summer of 2018. And I think that was really one of the things that propelled elevated volatility in the U.S. small cap stocks. So with the Fed being that backstop, I think once we get past elections, U.S. corporations are going to be able to plan and be able to reinvigorate that CapEx spending. They were doing it at a good clip before last year. I think they are going to return to it once we get past some of this election uncertainty.
Good to get your insight on that. Dan Wontrowski, appreciate you joining us today.
Thank you very much.
Coming up, China reportedly ready to crack down on IP theft. The move seen as a trade war compromise, but does it go far enough to seal a deal with Washington? Stay with us. Some fresh trade developments between the world's two largest economies as China attempts to address one of the sticking points in trade talks with the U.S. Beijing now says it will raise penalties on violations of intellectual property rights and aim to reduce violations by 2022. The guidelines will lower thresholds for criminal punishments for those who steal IP, but Beijing didn't elaborate on the specifics. Joining us is Kim Katakis. He is head of strategy of Legg Mason's Martin Currie affiliate. Kim, great to have you on today. How big of an olive branch is this when you consider that it is presented alongside a reported demand on the Chinese side to roll back on all the tariffs as well?
Yeah, thank you for having me, first of all. So it is clearly an olive branch. I think where we are in the trade war is where we should not expect any deal that gets signed on the back of this as being the final deal. We should not expect a happy ending, frankly, because I think structurally both countries are now embarked on a confrontational approach, and that's not going to change. I think the best thing we can hope for here is the Chinese are looking for a way to give the Trump administration face, to give them an exit, an off-ramp that shows that they've won something, which is especially important given that this is an election year coming up. So far, I don't believe we've really achieved anything, whatever your standpoint was on the trade war. And there are no off-ramps. So what this represents is the offer of a face-saving off-ramp. I think the mini deal that will come, the best outcome I think we can hope for is one where they go back to buying around about $15 billion a year of soybean, for example, and some of the tariffs that have been put on over the last 2 years start to get rolled back. But let's not be under any illusions. I don't think this is the end game, and I don't think that there's any likelihood that materializes anytime soon.
So if in fact this is a Chinese push to try and allow the U.S. to save face, is that going to be enough for D.C., you think?
Look, I guess you'd have to ask the guys in the big White House there, but myself, I don't believe it is, because I think, unfortunately, this approach would seem to me, an outsider who's a foreigner at that, it would seem to me to have brought us to a point where there is no off-ramp. It's not easy to say you've won the trade war because you haven't got anything to show for it. And it's not easy to say you've brought China to their knees, because again, there's not much evidence of that either. So I think we need some kind of resolution, some kind of pause so that the election can be run. And I think this is the best possible outcome from the position that we're in, which is, I have to say, suboptimal.
Kim, we're now, more than a year and a half well into this trade fight that began between the U.S. and China. There's a lot of other things aside from trade that have kind of muddled the discussions. One being the issue of Hong Kong. We, of course, saw that big election over the weekend, a landslide win for the pro-democracy front. How do you see this issue complicating the discussions? And I wonder if you look at how the market has responded to every positive trade headline, do you get the sense that maybe investors are getting a bit complacent about all the other factors that could really result in more tension between the U.S. and Chinese?
You know, Kiko, I think you raise a really good point there. I personally think that investors are getting very complacent about two things. One of them, the issues that you're pointing out, and I'll come back to in a second. And the other one is they seem to be treating the trade war like some kind of storm. You know, you get a warning, the storm's coming, the storm's here for 3-4 days, whatever, a week, and then it moves on and everything's fine. We're not going to go back to the world that we had pre-2015 when, you know, every supply chain or value chain, as we call it, you know, in the world was honed for and optimized for cost, reliability, quality control, and all the rest of it, because now we've injected politics in it, and that's not something that's easy to quantify. So we're not going back to that perfect world. Corporate profitability has been undermined, and it will continue to be undermined on a structural basis for the foreseeable future. But the things that you're alluding to here, you know, bringing up the kind of what you'd call peripherals, but geopolitically speaking, are really big elephants in the room. Those are inconveniences without a doubt. Now, China would like to stick to just discussing trade, but in the same way as the circle of advisors around the US president would appear to have shrunk, and there would appear, at least from an outsider's perspective, to include less people willing to argue against the line. The same thing's been happening in Beijing, because at every step of escalation, those in Beijing who were arguing for a softer approach or a, you know, less confrontational retaliation have basically been sidelined because their approach would not have borne fruit. So you're now getting to hardcore people on both sides. They would rather just discuss trade, but in Beijing, because of that hollowing out of the difference of voices, they're now convinced that this is not about trade. This is about China growing in importance and the US not liking it. So they have taken a different approach to this. So Hong Kong is an inconvenience to them, but they're not, I don't believe they're ready to go in and send in the troops or anything. I think they're just going to let it fester on the sidelines. And economically speaking, Hong Kong is so much less important to China today than it was at any point in its history.
So Kim, very quickly, from a strategy standpoint, I mean, what you're saying seems to suggest a long road ahead between these two countries, and a bumpy road at that. What does that mean from a strategic standpoint? You're an investor in the market. Do you stick to some of the more, you know, domestic plays, knowing that any exposure to China is still going to be lead to more volatility?
Yeah, look, I mean, I think what you try and do is you get yourself out of the way of the runaway train. You know, you get off those tracks. So fortunately, China's position is that there's nothing they make for export to the US that they can't export anywhere else. So they're growing their trade with other countries. They have a number of avenues to do that. One of them is the big trade deal called RCEP, which encompasses around about 40% of global trade as we speak today. The other one is the Belt and Road Initiative, which has narrowed journey times down between China and Europe to 17 days from 8 weeks that it would have been before. And other things that are going on at the same time is that Asia itself is home to the biggest growth in middle-income population in the world, and probably what we've ever seen. So 1.3 billion people are going to join middle-income groups in Asia in the next 10 years. And that's according to the Brookings Institute. So, you know, if you're the CEO of Alibaba, you really couldn't care less what's going on in the trade war, because it doesn't affect you at all.
Okay, Kim Kataikis, good to get your insight today. I appreciate you joining us.
Thank you very much for the opportunity.
Coming up, Frozen 2 is melting records at the box office. And it's not just Disney reaping the windfall. We'll have the details next. Welcome back. Let's get to our next group of tickers. Tiffany and LVMH announcing a landmark deal that's shaking up the luxury market. Frozen 2 is scorching box office records for Disney, and it's not the only company reaping the profits. And one major Wall Street bank is predicting a major turnaround for Nvidia next year. First, though, Tiffany stock shining ahead of Black Friday after LVMH announced it's buying the luxury jewelry brand in a $16.2 billion deal. Jared Blickery is back with me. Jared, we know LVMH has been looking to increase its exposure to jewelry. What does this mean for Tiffany?
Well, this is a pretty good deal for Tiffany. Stock price is about $135, or that's the offering amount, and we can see it's pretty close to there right now. In fact, this deal was first broke about a month ago, and that's this huge upswing we see here. This is actually 65.75% year to date. That's not a bad return. Tiffany's has kind of been flagging or lagging the general market, and LVMH presents a unique opportunity for them. They have a history of turning brands around, similar to the way they did that with Burberry back in 2011. That was another one of their acquisitions. So Alexander Arnault, he's France's richest man. He also is the CEO and founder of LVMH, is going to make this another one of his turnaround strategies, he hopes.
Okay, thanks so much for that, Jared. Our sixth ticker of the day is NVIDIA, and shares there are jumping after Morgan Stanley upgraded the chip maker to a buy. The bank predicts a return to solid growth for NVIDIA. Inez Ferre back with me. So why the bullish outlook?
Basically, two segments. One is gaming and data center, which is expected to accelerate in 2020. So Morgan Stanley in this note is saying that NVIDIA is very well positioned going into 2020. Even with tough competition within the semiconductor space. And what they said is that this year, both segments came short of expectations, but the stock has done well. It's up 65% since June. And as far as the gaming segment's concerned, this is where I think it gets really interesting. They talk about ray tracing technology, this rendering technology, which is basically a very, very realistic lighting, realistic shadows. And when it comes to computer graphics, when it comes to games, this is huge because analysts are saying that this is what's going to be driving gaming going forward. And they also have teamed up with Microsoft for to do this for Minecraft, which is one of the best hits of all time games. And it requires, though, this type of rendering requires a lot of power. And this is where NVIDIA's RTX chips come into play. And in their last earnings call, they said that this was their home run. They're expecting millions and millions of gamers to be upgrading, and these graphics are just incredible.
When you think about the concerns that have weighed on NVIDIA, one being that the China exposure, people sort of see semiconductors as sort of a proxy in that way on the trade front. There's also the concern about the mining issue with cryptocurrencies. Is all of that behind them, or how do you think investors should be looking at that as a risk now when you think about the potential they see in places like games?
Right. So they talked about China also in their conference call, and they said that gamers are actually sort of not so sensitive sensitive to these macro trends. They're not so sensitive to these trade issues, to slowdowns. And in China, gaming has grown for them. It's been very strong. They also even talked about one of their features that they have where they can sort of onlay your image onto a game and then you share that on social. In China, the communities are so social that this has been a very big hit for them. So they're really seeing this, for them, they're seeing this as a home run going forward pretty much everywhere.
Okay, and NVIDIA releasing a big pop today on the back of that upgrade. Our seventh ticker is Disney. Frozen 2 smashing several box office records this weekend with an estimated $127 million in its U.S. debut. The film also now holds the title of the highest grossing debut of an animated movie globally. Melody Hom is with me. Melody, we've come to expect some of these big numbers from Disney, but this is really a big franchise and a generational one.
Yeah, and I actually want to point out that it's in a very unique position as well because it's the first mega sequel for a Disney princess-led film that's actually in theaters. So if you think about even The Little Mermaid 2, it was straight to video. We're in a different era now entirely, and we've chatted about this before, right? Where they're hitting a whole new generation where whether it's merch, whether it's the whole fan base, even beyond the Let It Go song, this can be a whole new refreshing take for the 3 to, I would say, 10-year-old audience base. Also, it's just strategic timing, right? With Frozen 1, they announced it around the same time, so it was during Thanksgiving of 2013. They recognized that blueprint works very well because the second week bump, they will be guaranteed to see next week as kids are off for school. And of course, the nostalgia effect as well. Just for more context, I was graduating college at the time Frozen 1 came out, and so even though I'm way too old to be consuming this sort of content, there is a certain part of the nostalgia factor that resonates well. I think broadly speaking, 2019 has been an excellent year for Disney. When you think about Disney Plus, the 10 million signups that we saw within day one of the announcement, and if you think about the larger spectrum here, of course, Disney Plus will only be able to create more kind of original content that's exclusive to the platform with the likes of something like Frozen 2 coming out. And it's not a heavily R&D investment sort of strategy, right? You can create a 3-minute short film. You can create, these one-off exclusive things that typically you'd be able to see on YouTube, and now they'll be reserving it for the Disney Plus platform. So that is more of an enticing draw, perhaps, for some of the people on the fence who have those children who are going into theaters to see films like Frozen 2.
Yeah, it really does speak to the power of that Disney ecosystem, right? You go watch the movie Frozen 2 in theaters, and then you come home and you watch Frozen again on Disney Plus. There's certainly a lot of other players in this space that are hoping to get that knock-on effect from Frozen 2, Hasbro being one of them. How big of a bump is this likely to be for toy makers?
Kiko, I don't think we can really overstate this, that Hasbro actually had a very, very rocky 2018 holiday season for 2 factors, right? It was the first holiday season without Toys R Us, and it was also one of the first times that a Star Wars film was not actually in theaters during the holidays. So if you think about the knock-on effect here, Hasbro is doubling down, making sure that those satin jammies, the lip glosses, everything in between with the Frozen sort of ecosystem is in play. Let's also keep in mind that Baby Yoda, which is the Mandalorian's new hot trendy topic, they are making plush toys, and they have an exclusive partnership with Disney for all the Star Wars franchises as well. I want to note that Mattel actually, during Frozen 1.0, actually had the licensing agreement with Disney, and they actually failed pretty massively because they could not meet demand. We talk about this demand problem a lot, and it took a full year after the first Frozen movie came out for Mattel to really catch up. And then when the license was up, Disney decided to go with Hasbro because they recognized that perhaps the more of the inventory there. I think I also want to point out that 2/3 of Hasbro's products are actually manufactured in China. So tariffs have really, really affected the Hasbro industry and toy market in general. So they're relying really heavily on this year's holiday season with the Disney movies.
Yeah, and you talk about timing, all of this coming to market with just about a month to go before Christmas. Thanks so much for that, Melody. Coming up, it is a make make or break week ahead for the U.S. retail industry. A top expert tells us what clues to look out for and what they'll indicate about the health of the U.S. economy. Next. Black Friday is just around the corner, and some analysts think this could give the economy a big boost. JP Morgan is expecting sales to be up nearly 5% during the holidays, while the National Retail Federation puts the figure at 4%. Joining us is John Riding. He's a chief economic advisor at Bain Capital. John, what's your outlook as we go count down to Black Friday?
Well, I think a number somewhere between 4 and 5% is the kind of pace we've seen the consumer on this year. Funnily enough, in the retail sales data from the government, it will look stronger because there was this bizarre drop in retail sales in December of last year, and I'm not entirely convinced that it wasn't some technical problems in putting those numbers together. But I think in terms of what's actually spent, 4 to 5%, with inflation around 2%, a little bit lower, that's a fairly strong gain in inflation-adjusted terms.
There's been some concern about the shortened holiday season, 6 days less than last year, and yet you could also argue that the shopping season itself isn't necessarily shorter because the promotions have started earlier. How do you weigh those two?
Well, I think there's no doubt that November 28th is the latest Thanksgiving can be. But I can't think of a retailer whose list that I'm on, just from things that I bought, who hasn't already said that the Black Friday, they're not online people, not even just simply waiting for Cyber Monday, they're there now. And I think that consumers become much less promotion driven on the Friday after Thanksgiving. The things that really matter to the consumer is, do I have a job? Am I getting paid more? We have seen jobs created at 170, 180,000 a year. We've seen wages plus benefits rising around 4% pure on average. That gives the consumer a very strong backdrop going into the holiday season. And also, savings rates high, wealth to income ratio of the household as a whole is high. So all of that should add up to being a very solid holiday season.
So no question that's leading to, as you point out, sort of the optimism or the confidence that consumers may feel. You know, we always hear that sort of the last 10 days leading up to Christmas is really where the real push starts for retailers. Have we seen that marker shift a bit? I mean, how should we be looking at some of the data that comes out post Black Friday, post Cyber Monday in the context of this holiday season?
Well, I think it's going to be difficult to gauge because of these shifting patterns. Not only the promotion, less reliant on Black Friday sales, but I think ultimately, when you think about what drives the economy, strength in this season is important for the retailers, but not necessarily important for the economy as a whole. The thing that we've been missing in the economy has been investment spending, and that's really been hurt by tariffs and uncertainty around that. So that's the other area to think about when you look at the outlook. Are we going to come to a China deal? Is it on? Is it off? Is the market's up to date because people think it's on? But the response when a deal is reached is going to be very important. Brick and mortar retailers, a run to December is very important, of course.
And you don't think that consumers are thinking about the trade issue as they go out, unless they see it reflected on the price tag?
Less so. Yes, but the amount of additional tariffs per month that's being collected by the government is around about $3 billion a month. Now, $3 billion sounds a lot of money to me, you and the average viewer. But in the context of an economy that's north of $20 trillion, it would be a 1 or 2% on the price if it's paid by the consumer and not absorbed by importers' margins.
Okay, John Riding, good to have you in studio.
Thank you.
Coming up, why luxury tree houses are becoming in vogue for adventurous travelers. Stay with us. Time to go beyond the ticker. The luxury treehouse is not your average childhood playhouse anymore. Actually, no kids are allowed at this one, and it costs $229 a night. Let's bring in Melody, Jared, and Inez back into the mix. All right, Melody, Tennessee's first luxury treehouse. Here's what we know. It's decked out with antiques, a wall made out of 160 wine bottles, and a custom mural. $229, Inez and I were saying that's actually not a bad deal.
Yeah, it's not a bad deal. There's also 19 acres to actually hike, and there's some trails in the backyard. That was actually very appealing to me. After perusing the photos, it's quite enticing, I have to say, but I don't know if I'll necessarily make the trip to Tennessee to be in a treehouse.
Yeah, Inez, what do you think? I mean, is this kind of the next phase in glamping, right?
Yeah,
we were talking about places
sure,
that
of
charge,
course.
what, $500 a night, some glamping
Right.
spots?
I mean, you can stay in a really nice hotel, or you can go to a treehouse. I like this option of the treehouse if I'm in Tennessee. I think it's nice. It's different. But then again, I'm sort of eclectic like that.
And Jared, the owner there is also there's also a fire pit, a hot tub, and a doorbell made to sound like it is 120 years old. Good investment to rent out a luxury treehouse. Inez says she's on board. What about you?
Well, for them, sure. I think this could go pretty far in Airbnb. You know, it reminds me of Swiss Family Robinson. I always dreamed of staying in that place when I was a kid. But look, I think this is a nice idea for $229. Can't really beat that. And it kind of looks like Falling Water, which is Frank Lloyd Wright's house back in Pennsylvania. So, good deal all around.
Yeah, a different experience, right? We always talk about how the changing tastes of travelers. Now we'll see how it does. Thanks so much, guys. That does it for The Ticker. Stay tuned for the final round. That's coming up next.
Hello, everyone. I'm Jen Rogers in New York, and this is the final round. More record highs as the S&P 500 and NASDAQ rally, with the Dow back above 28,000.
Now, Miles, other than this, as it was yet another merger Monday on Wall Street, a slew of big deals closing after the weekend. We'll have more on that and all the market action coming up in just a bit.
Plus, Elon Musk touting 200,000 pre-orders for Tesla's Cybertruck. Could the sci-fi pickup actually be a hit? And game on, the gaming industry with another big year. Which companies and sectors are poised to be the big winners? Plus, Wells Fargo getting bearish on Netflix with a big downgrade. It is our call of the day. Fresh start to the week. Miles?
Feeling fresh. Fresh.
How do you feel now that you've been able to see? We haven't closed above
I haven't
28,000?
closed, yeah. So I'm with trepidation. I look.
It's pretty darn close, actually. It was looking better earlier. Look, these above 28,000, you will be in the country. S&P 500, NASDAQ hitting record intraday highs. Now both indices are on track for record closes as well. Today's gains coming after we saw our first weekly decline in over a month last week. And then today, a lot of M&A news.
Yeah.
But still, it's not like we're off to the races, right? We're just like, would you say we're still kind of just waiting, just closing this out, making sure nobody wants to have a foul here?
Right, sure. No, that's fair.
Yeah?
I mean, look, I don't think there's anything like new in today's market that you need to react to strongly one way or another. I think last week the market was off 0.5%. You didn't really need to react strongly to that either. I mean, we're kind of coming into, okay, you could say month end, maybe that's going to impact trading over the next couple of days, the short week. Maybe people are coming in on Monday saying, buy everything, then hit the road. You don't have to over-explain, I don't think, any one move in a market like this. That one has clearly shown confirmed strength, 2 weekly closes over 3,100 for the S&P. We've been within 1% of record highs now for more than 10 straight trading sessions. So really, you don't have to overthink this market in terms of what it's telling you, which is that it's been a great year. This is a strong market as we head into next year. And then we can start to debate what next year looks like. Do we see disappointment because of earnings revisions and so on and so forth? What's the election look like? All the stuff that we know is all out there. We will get to that as we get to that. But right now, I think for 2019, the market is basically saying, that's it. Great job. Great year, everybody.
Live in the moment. Like, you have some mindfulness about this market. Don't go ahead to 2020. Just stay right where you are.
You know me, big mindfulness guy.
Big mindfulness. I don't know. I mean, we'll see how many people are actually around this week. But as we have learned recently, it doesn't matter about volume on the upside so much.
Volume doesn't matter at all.
Downside to have any conviction. But just for everybody that's going to be saying this week, light volume.
Right.
Light volume. We could be in for some troubled times. We've debunked a little bit of that, at least on the upside.
All the way. I mean,
you've debunked volume.
Volume doesn't matter. It has no predictive value. It happens or it doesn't, but it doesn't suggest that any one rally or sell-off is real or not real, but for another time. For more on today's market action, though, let's go to Scott Gamm. He's live on the floor of the New York Stock Exchange. Scott, we're looking at record closes right now on the S&P and the NASDAQ. What's catching your eye? Well, Miles, watching shares of Uber today, which are down a little bit more than 1%, but earlier this morning, the stock was close to turning positive, even as news comes today that the City of London has revoked its license to operate there. Regulators in London say that Uber has made positive improvements, but they still cite a pattern of failures. Uber plans to appeal, so there shouldn't be any changes to riders' ability to use the app for right now once this thing gets sorted out. We're also keeping an eye on shares of General Electric. The stock is up about 0.6% right now. It was up about 1% earlier today. The company naming a new chief financial officer who will start in early 2020. Her name is Carolina Dybeck-Happ. She was the finance chief at the shipping giant Maersk. She's going to come over in the next couple of months and will be succeeding Jamie Miller, who will be leaving the company after the transition is completed. Now, we know that GE is, of course, in the middle of a multi-year turnaround plan. We talked about how the stock is up today, but it's still up about 60% so far this year. And right now, the stock is firmly above that $10 mark, guys. All right, Scott Gamm, live on the floor of the New York Stock Exchange.
Despite an embarrassing public debut last week, the Tesla Cybertruck has already received 200,000 orders. At least this is according to CEO Elon Musk. Musk tweeted the phrase 200K to followers on Sunday, implying that Tesla received 200,000 orders for the divisive vehicle. There is a new investor poll out from Morgan Stanley. 31% of those surveyed believe the Cybertruck can be successful with a material redesign. Who do you just think like anybody can sign up because it's not like you're actually buying a car?
That's right, you're putting down $100.
You're putting your name on a
The
list.
marginal Tesla buyer has $100 to spare, just to say they did it.
So, I mean, it's hard to say whether the 200K number is good or bad, right? Like if we were like 500K and it's just as easy to put it down, would we think that's good? Like we don't even know really what a good number here for Tesla would be.
As is the case with everything related to Tesla, it can be whatever you want it to be. If you want it to be good and really meaningful and a huge sign of demand for this truck, then that's how you're going to see it. If you think that it's just sort of a fake made up number because you put down $100 and you can get it back at any time, it's not really a pre-order per se. It's sort of like an intention to maybe want to buy, the right to buy, true call option in that sense. Then you could say it doesn't mean anything. So, I mean, I think the truck, like everyone staked their ground on the truck, and they staked their ground on the truck the second it came out. Like no one saw the truck and then has said, well, I've taken some days and now I think it's good. I think if you thought it was good coming up that ramp the first time, you're still like, this is great. If you thought it was ridiculous, I think you still think that way.
I'm coming around to parts
You're coming around.
to parts of it. But I was like that.
I don't love the thing that basically Morgan Stanley is like, it needs to be redesigned, or who they talk to says it needs to be redesigned, because I think the whole reason that the truck is going to work is because of the way it's designed. Like it is really cheap to manufacture, obviously, because there's no complications.
No paint.
Doesn't get painted. It doesn't get painted. So it can't be redesigned, otherwise it's not this actual car. It won't cost $40,000 if it doesn't look like that.
What I think is interesting about the news, so it comes out on Sunday, this tweet, and the stock opened much higher today. It's basically, the high for today, it opened around 345. It's come off substantially. Now we're just up fractionally here. I do think people were excited having seen some of that news. And then when you start to digest it, and I think people realize what the waiting list is, some of the Morgan Stanley surveys in here. As you say, there's two ways to look at every Tesla number. I think people throughout the day kind of weakened up on the excitement over the news.
It's like eating popcorn. It's like
You're very excited at the beginning.
Well, or you finish it and then you realize I haven't eaten anything.
Or you want to get water.
I mean, right, we could continue with that all day. But yeah, I mean, I think, look, Tesla is what Tesla is at this point. Like, we'll see what the next quarter is. We'll see what happens with production here. But very difficult, I think, to move the needle narratively when it comes to this stock and their future products.
Although I think they thought they did this morning.
They did for a little bit, sure. Stock's up less than the market in a record high tape. But, you know, you can take the win. Coming up here today on the final round, we will have the stock movers in this market. But first, let's take a look at where European markets closed on this Monday.
Now let's take a look at some stocks on the move today. eBay, as the company announced plans to sell StubHub for $4.05 billion in cash to online ticket vendor Viagogo. Note that Viagogo founder and CEO Eric Baker also co-founded StubHub while he was in business school. What have we done with our lives? But he left StubHub before it was sold to eBay back in 2007. Sukhinder Singh, the president of StubHub, is going to be on the final round coming up later in this hour. So we're going to have more on this deal shortly.
The life cycle of all companies. They start,
in your dorm
they break
room?
up, they come back together.
There you go. NVIDIA also moving as Morgan Stanley analyst Joseph Moore upgraded the GPU maker to overweight, predicting solid growth from NVIDIA's gaming and data center units. We're also going to be talking about that with EY. They've got a new study on video games. And finally, Dick's Sporting Goods. Take a look at this. B of A upgrading shares to buy, citing premium footwear success and that it's going to power same-store sales growth. We've had a lot of notes coming out about Foot Locker and how well they're doing with shoes, but the Dick's audience, Yeezy was also mentioned in here as something that's delivering for the Dick's consumer.
I don't think that's great news if you are a Yeezy collector, but I guess obviously good news if you are a Dick's customer. But I mean, I think, there's a lot of bubbles out there that are like mini ones, not the stock market, like literally everything but the stock market.
Like cannabis, Bitcoin, and
cannabis,
shoes.
Bitcoin, and I think shoes. Wow. I mean, I've seen some people suggest that the watch market is in a bubble that's now popping for certain reasons, and it's really the third-party market, right? And you've seen the popularity of StockX and other services. I think really poses a risk here to that market.
We're all searching for yield.
Right. I mean, look, I don't think Adidas and Nike want there to be a huge, robust market for their sneakers that is 3-4x retail. I think they want to sell their sneakers at Dick's to as many people as they would like. They don't want me to buy Yeezys and then go out and sell them for $500. They want me to buy them and wear them. So, more to come.
Well, we also have Reggie Wade coming.
Yeah, we got
a really cool sneaker.
Look, he's got the Jordan 11s. They'll be on set. We'll talk about all this stuff coming up in a bit. But coming up here, right after this break, it's game on for the gaming industry. Got another huge year in 2019. Which companies and sectors are poised to be the big winners? We'll discuss. But first, let's take a look at some of the leaders right now in the Dow with about 45 minutes to go in the session.
Our next guest says that while the economy may be slowing down, it's still growing overall and will only grow more with the results of consumer spending from the shopping season this holidays. Francine Lai joins us now from Santa Monica, California. She's an investment advisor representative at Gerber Kawasaki Wealth and Investment Management. Francine, why are you so positive about the consumer going into the holidays? Because we keep hearing how important the consumer is and that people are confident, but what are the dots that you're able to connect here to have so much conviction around this?
I mean, we look at the fundamentals of the U.S. economy, right? And consumer spending comes from full employment. It comes from people working. You know, we're going into a great time of the year where people are wanting to spend. So the fact that the U.S. economy is operating on full employment, we're pretty happy about that and bullish that, you know, the end of the year can still be a good year for us.
Francine, I want to talk about one of the names that you like here, which is Ulta Beauty. It's a stock that has done fantastically well over the last decade. It's struggled quite a bit relative to the S&P so far this year and over the last couple of years. What trends do you see in that business that make you feel like the stock is still something that's attractive even after kind of stalling out here, again, as I mentioned, over the last couple of years?
Yeah, so when we choose our companies that we want to invest in, we think about the next 5, 10, 15 years, right? And I think for Ulta, the reason why they're in a great position is because not only do they have premium beauty products and cosmetics products, but also affordable beauty. And I think that's really the sweet spot. If the economy continues to do well, you know, people will still buy cosmetics. And then if we do in fact go into a recessionary period, you know, I'm not going to stop using makeup, but maybe I will cut down the price point and be a little bit more conscious, which Ulta then is a great play for that.
And do you feel like in some ways Ulta is like a, I guess it's almost like a way to invest in Instagram without buying Facebook, right? Does that kind of, do you see that thesis there at all? Because I feel like we all know that the cosmetic space has exploded. And to me, it seems like so much of it is because of what's happening in social media.
Yeah, I think partly that's the reason why it's become so popular, right? And that's why, you know, for them to bring on big names like Kylie Cosmetics, you know, KKW Beauty, makes it attractive, and they're smart in that respect. So, you know, I think they're doing a lot of things to digitalize beauty, which now is how people consume and spend, right? They go online shopping instead of going into a store. So I think they've really done a great job keeping up with the times of what they're selling as well as how people buy products.
So other two picks you have here, Zoetis and Home Depot. And I'd love to get at how you like those, because you didn't pick other names in those categories, Chewy or Lowe's. Like, what, you know, there's other ways to play the pet craze. You say, you know, you've got your firstborn, your 90-pound golden retriever. Why not Chewy? What is it about Zoetis?
So Zoetis, you know, I do a lot of research too in terms of what I use, right? And the pet industry itself has been exploding. It will continue to grow as people continue to have less and less kids and spend more and more on their pets, right? And part of that is making sure they get good care. So with Zoetis, they are one of the largest in the world in terms of vaccinations and medication for cats, companion animals, dogs, as well as livestock. So I like the fact that they're not so niche into, you know, only one type of animal, but in terms of animals in general, they cover all the broad bases. So, and my dog personally has used a few Zoetis products. So that's when I started to do a little bit more research and digging into the company.
And then just on Home Depot, because I mean, we just had a huge sell-off, 6 days ago here. What is it about Home Depot, especially they are, you know, not performing on some metrics as the street had thought they would be at this point?
I mean, with the pullback that just happened, you know, Home Depot has been very vocal about what has occurred in terms of them spending a lot more money digitalizing their platform, making sure that they are focusing on their professional contractors and keeping those relationships. And in terms of how people buy, they also want to make sure that they're building a website where people will continue to spend there. And so with that type of company, if you are investing in the future, that's how you do it. And so for us, that pullback wasn't necessarily a warning sign. And they also said the way that Black Friday falls this year, it was more of a timing issue. And that's why they, you know, lowered guidance towards the end of the year. But they're not worried about the business itself and people spending at Home Depot. And so Home Depot has been a company that we've loved for a long time, and this gives us a buying opportunity.
Francine Lai, Gerber Kawasaki Wealth and Investment Management, thank you so much.
Thanks.
All right, and coming up, I promise this time we will talk about the gaming industry. It's had another huge year. We'll talk about the companies and the sectors that are poised to be big winners with this trend. But first, take a quick look at some of the winners in the Dow with 40 minutes to go in today's session.
...2019 revenue for the global video game market is forecast at $152 billion. That is a 10% increase from 2018. Sounds pretty good for companies in the space. But a new survey shows those in the industry actually see a lot of challenges ahead. And joining us is Scott Porter, EY's West Media Entertainment Advisory Leader, joining us right now on the phone. So you all just came out with a new study. How is your business powering up for the next video gaming challenge? And what caught my eye in here is that 70% of gaming executives actually see the next 5 years as more challenging than what we just came out of. What are the biggest issues for them?
Thanks, Jen. The study that we just conducted and published on the 14th revealed that the majority of video game executives feel that the rising costs of producing and distributing games, margin pressures that the companies are experiencing, plus a number of new entrants of titles into already a crowded market are forcing them to kind of rethink how they're approaching the market and coming up with new innovative ways of monetizing the content as well as coming up with new revenue streams.
Now, Scott, obviously, video gaming has done extremely well while television was, a ubiquitous part of American life. But there does seem to be a sense among some analysts and investors that maybe this, the new streaming wars, the idea that we're at a peak content moment, everything now is on demand, is a threat for the video game industry. Is this something that you guys are hearing as well?
Miles, I haven't necessarily heard that. What we have learned through conducting the study was that video gaming and, if you will, kind of the extension into esports represent the fastest growing segment within the media and entertainment industry behind the streaming video online demand services. And while there is, a lot of competition out there. You have younger generations that are spending more and more screen time on their various platforms consuming this game content. And it has really become part of the mainstream entertainment, offering that, consumers now have a choice to look into.
So we've seen some entertainment tie-ups, Fox's 21st Century Fox and Disney. Then today we've got a slew of deals coming out. Is this industry, video gaming, really ready for consolidation? And how do you see the puzzle pieces all fitting together?
So while I don't know if the industry's ready, the study revealed that the majority of executives in the space feel that the war for talent is going to be one of the driving reasons to, we'll see the increased M&A activity. And that is whether it is on the technical side, the creative side, even in the executive space. These companies are going after, some really talented people, and there's just not as many of them out there that we'd like to see. And so they're thinking that, okay, we're going to have to really start looking and making some of these strategic acquisitions to not only get the IP, but also get that talent into our companies so we can continue to exploit the market.
And then, Scott, just quickly, what about streaming? We've seen Stadia come out. There's a lot of buzz about whether that service is or is not quite as promised. Is that something that the folks you guys heard from are thinking about as the next frontier in the gaming industry?
No, absolutely. So when we looked into the results of the study and the almost 240 executives around the world that we spoke with on this, most of them think that streaming and the ability to then play a lot of these AAA titles on mobile devices is going to be the real game changer. And it is going to be something of a democratization of the gaming industry where in order, you don't have to go and spend thousands of dollars on the high-end gaming PCs or even some of the other platforms that are out there. You'll be able to have that same level of experience using mobile devices, whether it is a smartphone or a tablet.
Scott Porter, EY West Media Entertainment Advisory Leader, thanks so much.
Thank you.
All right, coming up here on the final round, we'll have more. We've got merger mania hitting the brokers. Schwab inking its deal with TD, why the industry has been consolidating like crazy. We're back with that right after this. Welcome back to the final round here on Yahoo Finance. Miles Eldon with you in New York. I'm joined as always by my co-host Jen Rogers. Let's take a look where we stand right now. 29 minutes to go in the session. We are looking right now at record closes for all three of the major indices. The NASDAQ is going to have no issue making a record there. The S&P, the same, 10 points above its recent record. The Dow hanging in there about 15 points above its prior record close. For more on today's market action, let's go to Scott Gam, who's live on the floor of the New York Stock Exchange. Scott.
Hey there, Miles. Well, watching a couple tickers heading into today's close. First up, Hasbro, which is up about 3% right now. The stock was upgraded by UBS to buy from neutral, but the analysts maintain their price target of $117. The stock right now is trading just shy of $100. There are a couple of reasons for their bullishness. First up, they think the tariff issue is already priced into the stock. They're also expecting better than expected revenues and synergies from that E1 deal that was announced a few months ago. And then finally, a possible boost from Frozen 2 merchandise. Now, Frozen 2 is a big Disney franchise. The sequel to Frozen, which was first launched in 2013, just launched in theaters this past Friday. And speaking of that film, the numbers in terms of box office sales were pretty impressive for the opening weekend. We're talking about reports of $120 million in the opening weekend in the US, something like $220 million overseas. And we know that Disney's stock has been on a tear over the past couple of weeks amid optimism from the recent launch of Disney Plus. That's its streaming service. So there's a lot to be excited about with Disney over the past couple of weeks. Now, right now, Disney shares are up about 0.5%. The stock is flirting with $150 a share. Even with all the gains over the past month, the stock hasn't meaningfully broken above $150 a share. That is the next key level to watch if you look at the chart of Disney, guys.
All right, Scott Gam, we'll talk to you after the closing bell.
Shares of Charles Schwab and TD Ameritrade getting a boost today as the powerhouse deal between rivals becomes official. The brokerage giants will merge in an all-stock transaction valued at $26 billion. And Yahoo Finance's Brian Chung is here with us now. So, Brian, this is like watching a movie when you know the end. And I felt like I knew this was coming.
It's like rewatching a movie.
Right. Okay, but you can still make it exciting. Now, what happened?
I'll try.
He was an analyst at the Fed after all.
Oh, my gosh.
So what happened today that we didn't know or that's important to know beyond what we've already talked about?
Well, it's official. So we already got the details, most of it on Thursday when the news broke that they would be merging again Charles Schwab and TD Ameritrade, two big giants in the retail brokerage industry. We have Charles Schwab that's got 12 million brokerage accounts. You have TD Ameritrade that has 11 million combined, 23 million. That would really size up with Fidelity, which is private. But these are the two big Goliaths that will be playing in the space if this merger is approved. This is really bad for the smaller guys. This is really bad for the E-Trade. This is really bad for Interactive Brokers and those other small firms that, quite frankly, are just so dwarfed now by the scale of these companies. When you consider that, for example, Interactive Brokers, only 700,000 brokerage accounts. E-Trade, in the single-digit millions. So this is going to be really tough to compete. But keep in mind, like you mentioned, this is a story. This is almost like the third episode that we've seen already. I mean, there's been a lot of merger in this space already. Ameritrade and TD Waterhouse in 2006, which created the modern-day TD Ameritrade. In 2011, Charles Schwab bought Options Express. 2017, TD bought Scottrade. That was a huge one. And then 2019, Charles Schwab buying TD Ameritrade. So this is just singularity here, happening in the brokerage space.
I mean, I think, there's sometimes mergers happen in industries where there's just consolidation or there's growth to a certain point that the bankers say, hey, you guys should, buy each other. It'd be great for us. This to me feels like sort of the death of the retail brokerage model, which grew out of if you go back to the way the space became regulated in the 70s, it sort of said, oh, normal people can now buy stocks. Well, people then bought stocks for a while. It crescendoed with the tech bubble. People have been buying fewer stocks or trading stocks less frequently, I should say. And now it's an admission. And, Brian, you and I have both written about this, that like the business now is like, oh, get a lot of cash and then lend it in the fractional reserve market, and you can get a few pennies on each dollar, but those pennies add up when you have $5 trillion under management. You don't really care if people are trading or not, because the answer is they're not.
Absolutely, and that's what really it's all about. I mean, you mentioned those pennies, but when it comes to pennies, you can make that add up if you have a large amount of assets to work with to begin with. So when we talk about the brokerage industry, with everything going to zero fees, the only money that they're making is by selling that order flow to those market makers, those Citadel, those Virtu Financials. And right now, the only way that you can make that an even marginally profitable business is if you have a massive order flow. So that's why TD Ameritrade is doing this. But Miles, you've written about this extensively. The idea that, look, at the end of the day, the brokerage industry is just dying. And you need to rely on other sources of revenue. So look no further than the fact that TD Ameritrade attributed a third of its $6 billion in net revenues as of the last quarter to commissions that they made on these fees. All of that is going to zero now. And they said the impact would be $880 million to $960 million per fiscal year. That's a sixth of net revenues. Compare that to Charles Schwab, where the brokerage fees were really only about 6% of its recent net revenue. So Charles Schwab was the one that needed to buy TD Ameritrade here. It's TD Ameritrade that's thankful that they got bought, quite frankly.
And maybe the other companies that are left out are not as thankful. So what happens to them? Because they could have been maybe picked up instead.
Well, in that race to the bottom where all these firms brought down their commission fees to zero, there was a lot of talk about E-Trade. I was reading a lot of analyst notes that were saying E-Trade would have been the attractive target. It was kind of much smaller than TD Ameritrade, a more digestible M&A target at an attractive valuation. But it ended up that E-Trade missed out on the party. And I don't know what that conversation was like. I don't know if that conversation ever happened. But Charles Schwab just decided, you know what, I'm just going to go for the big tuna here and just go for TD Ameritrade and see if we can make that happen. Now, for what it's worth, it still needs regulatory approval. And it's actually going to be fairly hairy because when you consider that TD Ameritrade is actually 43% owned by the Toronto Dominion Bank. That means that there's a little bit of complicated bank regulation, custody issues. So that could be a fight that's actually worth watching. I mean, obviously they've probably done their due diligence, talked to the requisite legal teams, but this is not necessarily a done deal. And Fidelity, actually, they had a note out earlier today, PR sent to a lot of members of the media saying like, look, this is something, you have to be mindful that TD Ameritrade is just going to be selling your order flow to somebody. Well, I mean, let's be fair. Fidelity's probably doing this.
Guess what? The most popular brokerage service for young people is Robinhood, and the only way they make money is by selling your order flow. So I think we're all set on the order flow thing. Except unless Michael Lewis. Michael Lewis is not happy about it. Everyone else is fine.
Can't wait for the book.
Have a great evening.
Thanks.
All right, coming up here on the final round, we will break down eBay's sale of StubHub with the president of StubHub. But first, let's take a look at how the big tech names are trading right now. 22 minutes to go in Monday's session.
eBay announced its plans to sell ticket marketplace StubHub to Swiss ticket reseller Viagogo for $4.05 billion in cash. And joining us now to discuss is Sukhinder Singh Cassidy, president of StubHub. And we're also joined now by Yahoo Finance's editor-in-chief, Andy Serwer. So let's just talk about this deal right now. I mean, StubHub has been in eBay. I think a lot of people have been looking at whether this was going to get out. Why is this the way to do it? What do you like about this partner?
So I think for StubHub, this is actually a very successful outcome, and we're very excited about the opportunity to put together our U.S. and successful business here with really Viagogo's international footprint to create truly a live and global player in live entertainment. And we're excited about the opportunity to really accelerate our growth in partnership with Viagogo. I think it's a win for fans, a win for content rights holders, and certainly a win for sellers on the platform to back more inventory.
Hey, Sukhinder, Andy Serwer here. Thanks for joining
Hey,
us.
Andy.
So this business of tickets is obviously something you know well now, but it's a business that's in transition. What exactly is the future of StubHub with this new ownership, and how's it going to work for consumers?
So I think there's a few key tenets of this deal that are really important to remember. First and foremost, as you think about fans and a footprint for fans globally to be able to buy tickets in the U.S., tickets internationally, and the phenomena we see, which is the traveling consumer being able to buy cross-border. I think the first thing you can imagine if we increase the scale and size of our operations globally, the opportunity for fans to have more choice across more territories to go to more events. And I think that that's a really important tenet of this deal. I think another important tenet is choice for sellers and choice for content rights holders. And as you and I have talked about previously, we really believe there's an opportunity for people to take advantage of our distribution who are, whether you are a consumer seller, whether you are a broker, or quite frankly, whether you are a sports team, a venue, an artist, looking to take advantage of the tools and distribution we provide. So I think when you think about what this means, I think for all players in our ecosystem, we think that it means the opportunity for more business and more choice. I think if you think about specifically the consumer, I think we think about the U.S. outbound consumer, the U.S. inbound consumer, the global traveler, all benefiting from this deal. Lastly, I think we see that mobile and the opportunity for consumers everywhere to be actually more capable of buy tickets at the last minute across multiple geos and on their devices will be another kind of future vision of this deal.
Sukhinder, you referenced the growth of live events, especially on the music side of the business, and I think we've all learned a lot about the financials of how the music industry is actually working over the last couple of months with Taylor Swift's latest Dust Up. I guess as you think about that space specifically and where StubHub wants to go and where you think this partnership could take you in the live music space, is this something that is kind of driving your thinking here, or are you looking kind of across all of your events that you're working at to kind of think about where the new StubHub under this new leadership goes?
So I think it's a great question. So first of all, you're right in thinking about the deal being beneficial to all the genres of business that we're in, including sports. So let me just touch on sports for a moment before going to the music question. First and foremost, let's remember the NBA, the NHL, the NFL, and Major League Baseball are all increasing the globalization of their own businesses, whether it's having a team abroad or franchise abroad or a game abroad. So we know that a global footprint is important in sports. In the music industry, artists are more dependent than ever on touring revenue, and that includes global touring revenue. So to the artists that we think about, leveraging our platform, and we do think that that's an opportunity increasingly for people to come direct and use our footprint and access to fans, even in the music industry, to be able to connect them with performers directly. I would say that the global touring nature and importance of global touring for them indicates that this should be a strong positive for them as well.
And then just in another space where we've had some resale news recently is the RealReal that has gone public. They've had some authentication issues. And StubHub, I've used it. I've never had problems. I think it has a really good reputation for that. Viagogo, there's maybe some more questions there. Putting these two together, is StubHub going to be bringing that reputation and what you guys have been able to do to bear here in the relationship?
I think absolutely. I think if you were to talk to Eric Baker, who's the CEO of Viagogo and actually one of the original co-founders of StubHub, he would tell you that the brand and the fan transparency and trust we bring to the table, as well as, of course, our premium content rights holders relationship of it with the NFL or Major League Baseball, I think he would see and argue they are all core aspects of this deal. One of the reasons, quite frankly, we had such success with that right and the premium that's placed on the brand.
Sukhinder, last quick question. What about your plans? What are you up to?
My plans right now are to continue running this company and make sure we're set up for a even more successful 2020.
Sukhinder Singh Cassidy, president of StubHub, thank you so much for joining us.
Thank you.
Thanks, Sukhinder.
All right, coming up here on the final round, Youssef Abbasi of INTL FC Stone will join us to give his take on the markets, the trade war, and everything else going on. We'll be back with that right after this. Stocks at record highs, 15 minutes to go in the session. Stocks starting this week hitting record highs. What does the rest of the year and 2020 have in store for investors? Joining us now to discuss is Youssef Abbasi, the Director of U.S. Institutional Equities and Global Market Strategist at INTL FC Stone. So, Youssef, to me, it kind of feels like the year's over for the market, right? We know what the Fed's going to do. We don't need a trade deal by year end, at least in your view. So, right, we can just kind of pack this thing up and we'll see you in January.
To some extent, right? Because you have delivered, this market delivered the Fed like a deus ex machina, right? In the unsettlement of the repo markets that happened in September and October. And the Fed jumped on that. They took the opportunity to pivot, go, easy money. Repo operations, obviously, we've seen even today, a 42-term repo operation, 2 times oversubscribed, right? So the Fed is telling you, we're not going to make the same mistake as last year. There's going to be ample liquidity. Nobody's raising rates. I don't think anyone globally from the developed central banks is talking about raising rates. Posture is the most dovish it's been in 6 years. So to some extent, you do have the Fed backstop. It is very active. Now, with regards to trade, you don't necessarily need a trade deal. You just don't need anything to be undone.
Yeah, but
right?
Don't we need like actual growth in the world to actually make companies' prospects improve and get real earnings?
That sounds incredible. Yeah. But this market has been devoid of that, right? This market has generally been devoid of that. And as it's been devoid of that, but there's still this dream that we're chasing, this escape velocity we're chasing. And what we're seeing is the Fed recommitting to easy money and hopefully getting there. So the growth prospects are on the sideline for now. Obviously, everyone wants to see how the trade deal shakes out. It looks like we got a little closer to phase one over the weekend, whereas the past 2 weeks kind of were showing us a little fatter tail risk on maybe the deal not getting done. So there is reason to be optimistic on trade, but my point is, I don't necessarily think you need a deal to be done and signed in 2019. You just don't need those December 15th tariffs kicking in, and you certainly don't need any tweet storms a la July, August this year.
You can count on that.
So the repo market is one thing, and you sound more optimistic than I thought you would be based on your notes here. Sure. But what about the credit market?
Yeah, so I mean,
we're there?
There are reasons to be concerned. There are definitely risks to this market, but you're never going to have a market that just goes higher with no risks and no concerns. That doesn't exist, right? So the concern on the credit side has been you're seeing a lot of deterioration of the lower tranches of high yield. And so there's a question, and does that ever tick up? And when it happens, is there a catastrophic downgrade of the lowest tranche of investment grade into high yield, and then how unsettling would that be? The reality is right now, the tranches that are getting impacted, in general, they're getting hit by energy and some telecom names that are distressed. They may not be one-offs, though. The one thing we're watching is we're watching the BDC universe, and we're really taking a close eye on their distressed loan level because it has nearly doubled this year. So the concerns in the funding market may be tackled by the Fed. These concerns in the credit market may also be tackled by the Fed. So the Fed is obviously going to keep a close eye on both. We'll see how it
and then just as we go towards next year, I mean, right now, it seems like everything I'm thinking about ends up being in the context of the decade is over, so what did we learn about the last 10 years? As you look to 2020, I mean, it sounds like this conversation we're having, we could have had in 2016, we could have had it in 2015, 2011, and in some ways, it seems like it was always just another version of everyone hates this market and stocks keep going up. Does that feel like where we're headed as we look to the 2020s?
Well, as long as the Fed, ECB, and BOJ continue to willingly expand their balance sheets, and without a credible way to unwind these balance sheets without creating mass turmoil, it seems like those central banks have little in the way of options, right? So you can continue to have a very below average growth global GDP type figure with easing continuing to happen and risk assets continuing to rally on the back of that.
I feel great, guys. Look, I know
I'm not saying you should feel great.
Table over here.
Well, but if you question the investability of this market in 2011 or 15 or 16 or 17, and I've worked with those guys who have, the guys who were saying, 1,300 before 1,500, and they were wrong. And it's pretty clear. You can't fight the Fed.
Right. Well, that's true. But I mean, man, you're putting an awful lot of chips in that basket. I mean, it's just, you're a believer.
It's worked.
Believer in that.
It has worked. And the one thing we're watching now is to see how the yield curve is acting, because the behavior of the yield curve is going to dictate the action of value stocks. And so the rally in value stocks is sputtering because you're seeing the yield curve start to flatten again. We need to see the Fed continue to maintain a steepening of the yield curve, in my opinion, too.
And their actions have shown that I think they obviously pay attention to that.
They like care. Them and Youssef like that.
That's right.
I wish.
Hey, pal and Youssef.
At that table.
Powell.
Janet and I, maybe. Me and Powell, we had to get there.
There we go. All right.
Really? I
Youssef
like that. That's
Abbasi, he's global market strategist at INTL FC Stone. Thanks so much for joining us. Have a great Thanksgiving. See you soon.
You too.
Thanks.
Coming up, we've got the closing bell on Wall Street just about 8 minutes away. First, though, we're going to get technical at the Wi-Fi interactive touchscreen. We're back in 2 minutes.
All right, 6 minutes to go. Record highs on the way. Jared Blickray at the Wi-Fi interactive touchscreen. Let's talk a little bit just about what stands out to you in this market, because I think it's not exactly the Dow. There's some other things going on.
Definitely. Well, we can't ignore the fact that the S&P 500 and NASDAQ are at record highs. Having said that, let's go to the Russell 2000, because really compelling breakout here. This is the best day it's having in about 2.5 months or so, and we can see it is broken to the upside here. Now, it's still off of its highs from last year, and we can see this using a 2-year chart. We still got some distance to go here. That's about 6 or 7%, but a really nice breakout for today on volume.
And we know that the small caps have lagged all year. Now, we've talked extensively about how that's not necessarily a problem for this market, but we'll see where that candle on today's action shakes out. But certainly the kind of move to the upside and the follow through from the small caps is something that has to make you feel constructive on where the market is headed.
Yeah, and you know, the previous guest was just talking about the yield curve, whether it's steepening or flattening. What does that do to value stocks? Today, the yield curve was flattening a little bit. The 10-year T-note yield was only down about 1 basis point, but markets kind of behaving as though it were expanding, which is really interesting. Small caps enjoying a nice bid here. Also, the Dow Jones Transports, those have broken to the upside as well. They broke out last week. So let's take a look at the 3-month. You can see this a little bit better. So here is our breakout, and we're just trying to base and move higher here. So really constructive charts here for a lot of these indices and markets that were lagging most of the year.
All right, now let's talk about something more exciting. That, of course, the crypto markets. Seen a lot of volatility in Bitcoin over the last several days, recovering just within the last 12 hours or so. But the chart has gotten a little bit sloppier here for Bitcoin over the last couple of weeks.
Yeah, it has. We were talking about this slide, I think it was, last Thursday, last Friday, and it continued over the weekend. We did hit support here. I think this is a low of about 6,500. Now, we did reject it. We can see that we have this, it's almost a hammer candle. You would have the body at the top here, hammer candle. Please don't hurt him, Hammer. But, it's the beginning of something here. I can't say if it's going to go lower or if it's going to basically go higher, but that's the very first step. I wouldn't get too excited about it, though.
Yeah, I mean, it does seem, if we look at Bitcoin over the last couple of years, okay, fine, we have doubled from where we hit the absolute low, which was right around a year ago. This time we were at 3,300 or so, I think, was the absolute low on Bitcoin. But there just hasn't been, you look at all these failed breakouts over the last few months, there hasn't been a ton of follow through when Bitcoin gets these price spikes. It still feels like the momentum is to the downside.
Yeah, and I think we still have yet to see that big push into institutional money. We do have the Bakkt network, and they've gotten their volumes up, but I just don't see that much excitement, that much buzz around this physical Bitcoin contract that they have. So.
Yeah, time to go back to getting ready for regular old stocks, right? At regular old record highs.
Which go to record highs.
That's right. Jared Blicker, the Wi-Fi Interactive Touchscreen. Thanks for joining us. Coming up here, we'll have the final round, the closing bell on Wall Street on the final round, plus Wells Fargo getting bearish on Netflix with a big downgrade as our final round call of the day. We're back right after this.
Welcome back to the final round on Yahoo Finance. I'm Jen Rogers with Miles Udlin and Yahoo Finance editor-in-chief Andy Serwer. And we're just moments away from the closing bell and what will likely be record highs here. We're looking at live pictures right now of the New York Stock Exchange and the NASDAQ market site. Again, on track for a record close. The Dow back up above 28,000 here. Sector-wise, we're also looking at healthcare having a pretty good day, and that is a record for healthcare. The XLV is up more than 1% right now. Miles, you've lived to see 28,000.
Is he going someplace?
He was on vacation.
Oh, I see. I thought it was
so now it's really happened.
Wow,
and we really added on there
Look at that.
at the end. These are
I feel totally different, Jen.
You do? I feel, yeah.
That's the God I can wish I could
Not
get
the
in
same,
and buy.
But look at that.
Fortunately, I've already been buying through my 401k.
That's the only set it and forget
Set it and forget it.
Yeah.
Technology XLK here up 1.3%. Some big tech names making nice moves today. Amazon was up 1.5%. Microsoft was up nearly 1%. Apple up 1.5%
Really?
here.
Oh, I got to check something out about Apple because.
And
You check that.
You know what caught a nice bid today? Lyft up 5%, and I think that with the news out of London on Uber, and we can say, okay, well they fixed it, last year when this exact same issue came up, it'll be fine. It reminds investors that Uber plays in so many different markets with so many different rules, and ultimately both Lyft and Uber, to some extent, are regulatory arbitrages. Really, they've kind of gone in and said, well, we'll just operate till you say we can't. And I think Lyft, with the domestic focus, is kind of that pure play ride sharing business. It doesn't have all the noise that Uber has associated with it. And, you know, Lyft also benefiting. A number of these 2019 IPO names getting a bid today, I think a real risk off kind of feeling in this market. You noted, Jen, that push right into the close. Really no let up, as you can see on the intraday chart, in the buying on any of these indices.
Peloton up 5%, Smile Direct up nearly 5%, Real up 3%, Luckin Coffee 52-week high, Luckin's up a little over 7%, Slack making a move, up 6% here.
And then getting back to the big one, can I talk about Apple?
Oh, yes.
Which is basically at an all-time high, 266, 268 is the all-time, but it's right around there. The $1.2 trillion stock now, right? Just the rounding is a big market cap.
Yeah.
The 0.2 part is a big market cap for almost any company.
Yeah, the 0.2 part was probably within the top 30 largest companies, I would think.
I would think that's right.
Maybe even higher.
Added that on.
Right.
So today, a lot of focus on this idea that, you know, Merger Monday's back with a lot of deals here. We're at records. When you sit back and look at this as we head into what is seasonally, except for last year, but usually kind of a strong time, I mean, do you think that people have the right level of confidence right now heading into year end? As Miles says, it's the end of the decade.
Right. It's the end of the world as we know it, and I feel fine, as Michael Stipe used to sing. So the mergers, it's sort of some standard stuff, though, right? It's enthusiasm, it's cheap money, it's growth is dear and hard to find, it's rationalization. If you look at the three deals today, you've got Novartis, you've got Schwab, and you've got Tiffany and LVMH. I think that it speaks to all those points. And, you know, the Tiffany thing, I mean, you know, that's probably a really good home for that company because they have maisons, as they call them, which are the brand. That's what they don't call them brands. They call them maisons.
Je ne sais pas.
Right, they call them maisons. So you can look at the statement.
Vraiment?
They look at the statement. That's what they call them. This will be a nice maison for this place.
Really?
Yeah. And so that's great. And we've talked a lot about, you know, the discount brokers and the brokers getting together and the fact that there's no commissions and you need to garner assets. And Miles can tell you more than you need to know about that because you know a lot about that business. And then the healthcare thing, I think, is sort of a timeless thing. I mean, that was basically one drug. They're buying the medicine company. It had basically one drug that they're buying. But I think a lot of those trends are still there and still driving this business. I mean, it's another good year for M&A, but you'd expect that with the market at a high.
Yeah, and I think it's funny, and I was thinking about this morning because I was, you know, pondering tomorrow's newsletter, which is not about M&A, and part of it was like, okay, well, what about the 2019 year for M&A? And reading a bunch of, you know, realize it's been a fine year, but it's sort of a benign year, I think. And if you go back and look at what happened in 17 and 18, especially with the enthusiasm around taxes, those were notable years. But this to me has a lot of a similar feel to what we saw in 2014, right? M&A went up considerably, really the first big post-crisis year. But then we had the oil kind of crisis, and there were a lot of concerns that we were going to fall back into recession around 15, 16. And so it never became this sort of blow-off, enthusiastic top. And I think in many ways the crash, you could say, we had in the market at the end of last year really tempered some of the optimism that I think the tax cuts brought.
And I'll tell you another thing that's tempered M&A is the end of globalism, as I sometimes call it. I mean, you can imagine, I mean, it's sort of the, you know, the LMVH Tiffany deal notwithstanding. I mean, you'd see a lot more cross-border stuff going on. I mean, can you imagine if there was no trade war, or if we were more on the same page with China, what would be going on with China? I mean, think of all the deals that have been blocked, and that you don't even know about all the deals that would have come to fruition.
Yeah, this is what I mean. A lot of these deals are what the bankers like to call defensive M&A.
Right. Yeah.
Right. You know, this is no one's really playing offense in the trade war
There's
world.
no great story with Schwab and TD Ameritrade. I think
unless you're in financial services, but that story's been going on for a long time. That writing's been on the wall.
It does feel defensive, though. For more on today's market action, let's go to Scott Gamm on the floor of the New York Stock Exchange. Scott, I know you've been watching all this M&A news as well. Take it away.
Hey there, Jen. Well, yes, a trifecta of record highs for stocks today, including a record high in the Dow. And it happened in just the last, 5 minutes of the trading session. It wasn't looking like the Dow was going to close at a record, but you did have a few notable stocks power the Dow in those final moments of trading. By the way, our viewers will notice that the Dow has closed once again above that 28,000 mark for the third time ever. The first time was about 10 days ago, then again a week ago today, last Monday, and then today. The best performing Dow stocks were United Health, Intel, and Dow Inc. Apple was not one of the best performing Dow stocks, but it was up there near the top of the Dow leadership board. Apple getting a nice surge in the last half hour, which contributed to the Dow's record close. The laggards in today's session were some of the safer areas of the market, the higher yielding names in the Dow like ExxonMobil, our parent company Verizon, and McDonald's. And then outside of the Dow, you mentioned M&A activity earlier. We had quite a few announcements today on the M&A front, including Tiffany, which surged today over 6%. It's the best performing component of the S&P 500. And of course, the company agreeing to be acquired by LVMH for about $16.2 billion. That's about $135 a share. The stock ending the session just shy of that level, and the deal is expected to close in mid-2020. Today is great evidence that a lot of M&A announcements tend to, spark this halo effect of optimism for the broader market. We certainly saw that today, guys.
Scott Gamm, we will talk with you tomorrow.
All right, time now for our final round call of the day. Today we've got Wells Fargo out on Netflix, the firm downgrading shares to underperform from market perform on concerns over subscriber growth, competition, and importantly, cash. Now, Wells Fargo acknowledges that Netflix has been a great stock and a great story when it comes to subscriber growth for several years. But they say that the free cash flow forecast, you just can't ignore them anymore. But I do enjoy this part of Wells's note. They say, where could we be wrong? Maybe it's because no one cares. And it does feel like with your Netflix names, Tesla fits into this bucket. There are these battleground stocks where everyone knows the numbers look dicey on what the go forward is for actually making money. But the market has ignored many of these things in many of these cases for a long time.
Well, it's interesting that those two companies, because, it's great to be a customer. They're legitimate businesses. I don't know what their valuation is at all, right? Yeah. And I think that's the common denominator.
It's great to be a customer. You know why? Because they lose money on every customer. They did the math in here. They're losing $2 on every one of us. Netflix, that we are all paying
you're served
up
well
for this
and you enjoy
huge
it,
growth.
right?
But I do love. I feel so. I get it. It's hard to be an analyst covering Netflix because you could totally be wrong because they don't want. The market doesn't want to go along with what you're saying. In the last paragraph here, basically he says, we think the spread between their free cash flow outlook and the streets makes a downgrade academically honest action. Like, we just have to do it based on the math, even though we know we could be wrong because nobody might care and everyone's just going to pile into this stock anyhow.
Speaking of math, did you see the one line in that report too? Well, people say it's 9 plus, we say it's 9 down. There's an $18 billion spread between what we think is going on here and what the consensus. $18 billion, that's real money. Holy smoke.
And they're not worried about the accounting here. I mean, some of this is sort of how Netflix does accounting, and they do make the point here that they're not really concerned about that at all, but just that when they start to think about, what subs are costing and what content is costing, when Netflix is going to get to the point where they don't have to go to the market, because right now this doesn't matter because they've been able to get cash whenever they need it. Yeah. But if you get to the point where you can't get cash, then maybe it becomes a different topic.
Well, and I think the difficult thing about covering Netflix for an analyst in this day and age is that we're now at the point in the streaming wars when it's a little bit about the money, but it's also about where does the consumer perception competitive stuff start to sort out. And it makes me think a lot about the inevitability of what everyone is now realizing, which is that the unbundling of the bundle will rebundle. Right, so it's already happening where you can get all these different services, but it still costs you just as much. At what point do people start really looking carefully at what they have, what they don't have? Does Netflix still fit into all of those baskets by default? And are they able to count on sub growth of, low to mid single digits every year when eventually people say, I don't want to have all these services?
Well, it's so interesting because the rebundle is just going to be the same kind of thing. Maybe people will be doing it 5, 10 years, maybe next year, maybe right away. Some people we already are, but it's just on the internet, not through cable, right?
But does that force Netflix to have to discount?
Yeah,
to get
oh
on
no,
a
I
per
think
sub
there are a lot of
basis,
questions.
you know?
I agree.
You know?
And not just discount, but it puts them specifically in what Wells notes is the hit business. And the hit business is hard.
Very hard.
Oh,
That's what everybody's been trying to figure out.
Apple's
And
trying to
so
do
that's
it.
why the content
Right.
spend has to keep going to keep up with your subs coming in and the different geographies you're going to. It's just going to be expensive for a long time. Just because you get scale doesn't mean you get to then say like, oh yeah, I think we're good. We don't need to do like a new series.
And you got to like please like Emily Nussbaum in the New Yorker, and all of a sudden like you're this little happy, software hardware company in Cupertino, California, and then Emily Nussbaum is writing about how the morning show is terrible. That's a different world.
Yes.
That's a very different world. Now, for instance, when Netflix decided to make a documentary, Wells Fargo, the bank that couldn't shoot straight.
Right.
Right? They could. They might. Especially after this thing. I'm not saying
That's
they'd
right.
do that. They might.
It was a good note though, but it is hard. There's so much that goes into it.
I don't envy.
I do not envy
Netflix
this team
analysts.
at all. No, because you got the tech, but you got the entertainment.
You'd rather be an investor. You just know if you're right or wrong.
Or New
You're
Yorker,
just gonna sit there and panic.
TV critic. What about that?
No, I don't envy
fun.
them either.
That's great. She won a Pulitzer.
Yeah.
That's great.
She's really good at what she does. I don't think I could do it. Coming up, forget Black Friday or Cyber Monday. Why Travel Deal Tuesday is going to be huge for cheap airfare seekers. We talk to Hopper after this. As consumers nationwide are gearing up for their Black Friday and Cyber Monday shopping, one travel booking service is gearing up for a day full of destination discounts. Hopper consumer travel expert Liana Corwin is here with us now to talk about what is in store for all of us on Travel Deal Tuesday.
I didn't know that holiday.
I had no idea.
It was a holiday.
Yeah,
It's
so
a
now
holiday,
this is like
okay.
an official holiday that soon will be making it to all of
Love
our
it.
computer screens. What is it exactly? What is going to be low on Travel Deal Tuesday?
So Travel Deal Tuesday really emerged in recent years as the best day to book flights and hotels in the post-Thanksgiving sale period. So it's really interesting. A few years ago, the data science team behind Hopper was looking at our archive of over 30 billion daily price quotes. And we were actually looking for deals on Cyber Monday. And what they found is that there were more deals on Travel Deal Tuesday than Cyber Monday and Black Friday combined. So we're projecting about 18 deals per second on Travel Deal Tuesday. So if you want to get away in the new year, this is really the time to book your ticket.
So you're supposed to book your tickets for holidays or for vacations in 2020, spring break even, looking forward next summer, all that stuff?
Yes. So unfortunately, with the holidays, you're less likely to find a good deal. It's a little too late. You might get lucky, but what I would say is really if you're looking to travel post-holiday season into the new year, those are the tickets you're going to get good deals on.
Now, do you have a sense of, I mean, obviously Travel Deal Tuesday hasn't happened yet, but just looking at trends so far this year, do you have a sense of where airlines and hotels are looking, especially the airlines, I guess, are looking to discount and get some of those fares or some of those seats filled that are kind of going by the wayside?
Yes, absolutely. Actually, so a lot of airlines don't publicize their deals ahead of time. However, we've gotten a little sneak preview from some of them. So Aer Lingus is going to be offering deals all across Europe, Dublin, Paris, Rome. We're also seeing deals to Europe from LOT Polish. And we're also seeing deals on other international destinations from Philippine Airlines, Singapore Airlines, South African Airways. So a lot of international carriers are really trying to incentivize travelers to book those longer haul bucket list trips because you're able to get them for about 40% off or more on Travel Deal Tuesday.
Why are they doing this on Travel Deal Tuesday?
I don't think they knew they were doing it. They didn't know they were doing it.
Because they pick the day.
So much money.
They did or they didn't? Because it must have been a low day.
But now it's become a thing, so I feel like I
don't
would.
know. How did
you know
it-
what I'm
yeah.
saying? Like, why not just be like, it's in January when you all have more money later? Why is it now? Like, what? I don't get it.
So what we're seeing is, airlines are really trying to take advantage of the consumer spending mindset. Black Friday, Cyber Monday, everyone's gearing up to pay for something, and travel is more of an experiential product. And so I think rather than selling it on Black Friday, Cyber Monday, I think they tried to give it its own sort of day. That's really why we saw those discounts fall on Tuesday rather than Monday or Friday. Tuesday also has just historically been a good day for flights, so that could have something to do with that as well.
There's no volume. I mean, people aren't spending money on the Tuesday after they've spent a lot of money on the Friday and Monday before, and they already have their plans for the. I mean, you can just see it. So then they fill the void, right?
And so let's say I went, me and Andy went and did Black Friday shopping, and then we came to work and did Cyber Monday. So we see a deal, but you guys have a price freeze feature, right? So I see something, I want to book it, but I need to wait until I get paid.
Absolutely. So if that's the case, Hopper just released a price freeze feature, which means if you put down a small deposit,
layaway.
$1 to $40, you can get that deposit back if you book the trip within the price freeze window. So if you want to go from here to Hawaii, maybe you see a deal for $200, but you're not. Well, that would be amazing. But let's say $500. You're not sure if you want to book that yet. You need to check with people. You can freeze that price and then get your deposit back once you book that ticket or any other ticket on the Hopper app. So it's free to use if you book through Hopper.
All right.
Let's go.
Now we all know what
Where
we're
are we
doing.
going?
Wherever you're going, wherever you're going for Thanksgiving. That's where I'm going.
Come on.
I'll trade you. You. You go to Cleveland, and I'll go to your undisclosed location.
And no thanks.
Liana Corwin, a consumer travel expert from Hopper. Thanks so much.
Thank you.
All right, coming up here on the final round, we've got the sector watch, but first let's take a look at how the FANGs finished on this day where we saw records for all three major indices.
Bang on.
All right, let's take a look at sector winners and losers. Only sector in the red today, utilities. XLU down about 0.4%. Safety trade not popular today. Edison, Alliant Energy, and Ameren were among the losers in the utility sector there. Sectors in the green, technology up over 1.4%. NVIDIA leading the way. That stock was higher after Morgan Stanley upgraded shares to overweight from equal weight. Also looking at Apple and Micron doing some heavy lifting in the tech sector there. Also higher consumer discretionary, up about 0.8%, led by Hasbro. Shares the toy maker higher after an upgrade over at UBS, citing the company's Black Friday sales as potentially getting a boost from Frozen 2 merchandise. Jen, is that tomorrow?
I'm going to Frozen 2 tomorrow.
Tomorrow.
Yes.
Both daughters?
Yeah, but I might be more excited than anybody else.
Okay.
I know.
Like
Yeah.
of the 3 women in the house, you're the most
Yeah,
excited?
I am, because I want to see them be excited. But it'll be fun.
Okay.
Yeah.
Well, you want to see them excited, but they're not excited. So
Are the men in your house?
Okay.
Yeah.
The guys are going too?
No.
Okay.
I'm taking 2 nephews that are 10
Okay.
and 7.
All right, got a brood.
They have not seen Frozen 1 yet.
Is that going to ruin? Okay, that's a lot of Frozen questions.
It's
I'm
fine.
sorry.
It's fine.
Okay.
Coming up.
Let it go.
What we're watching tomorrow in the
Okay.
look ahead. Plus, let's call them Tales of Newman. Was he really an informal advisor for Jared Kushner's widely mocked Middle East peace plan? You're going to find out after this. And now here's Miles with a look ahead at what will be making headlines on Tuesday.
Well, it's the week of Thanksgiving here in the U.S., which means it's also the 2-year anniversary of the beginning of the month-long crescendo of the great crypto bubble of 2017. Now, over Thanksgiving weekend in 2017, price of Bitcoin first topped 9,000. Within a month, we were above 20,000, and then the air kind of came out of it, and we all sort of moved on, which is great. But as we end, or near rather, the end of this decade, let's just not forget where this bubble sits within the decade's overall legacy, financial and otherwise. And I'd argue that the Bitcoin bubble in many ways kind of explains the whole trend that took hold in the 2010s. The price swings that fall and winter were notable, but the more damaging notion was that the promise of blockchain technology, not just the price of Bitcoin, is what people were really excited about. The whole bubble was about a group of people pretending the obvious truth wasn't actually true. It's a theme that we've seen play out in politics and pop culture and, of course, in financial markets. It defines what this decade was really all about, a decade where we were all told not to believe our lying eyes, even when the truth was sitting there right in front of us. Now, turning to the calendar for Tuesday on the earnings side, HP, Autodesk, Analog Devices, Hormel, Dell, and Best Buy are all expected to report their quarterly results. And then on the economic data side, we'll get the latest Case-Shiller reading on home prices, new home sales, the Richmond Fed's manufacturing index, and the Conference Board's latest data on consumer confidence.
I like the Bitcoin bubble.
It was great.
It was more fun than the
You liked it?
It was more fun than the cannabis bubble.
Really?
Yeah, I mean the whole.
I don't know. It was a fun
I
Thanksgiving.
didn't know we ranked or rated bubbles.
No, that's what we're doing.
I like the tulip bowl bubble. I mean, right?
Sure. Well, the cannabis bubble analog would be like, everyone's excited about cannabis, right? Because they like to get high themselves. But then they're like, no. It's really about getting into the pharmaceutical
really
market,
about the
right?
medicine.
And it's like, well, I get, okay, oh, sure, but you're excited about this because this is what you do recreationally.
Did Bitcoin really hit 20K, or was this right under?
It was right above. Yeah,
right there.
So on a daily close,
intraday.
Intraday was above.
Intraday, right.
Somehow, between WeWork's catastrophic IPO and declaring himself to be the future president of the world, ex-CEO Adam Neumann also had time to be a diplomat.
Who among us?
According to a new article from Vanity Fair, WeWork executives were shocked last summer to find that Neumann was supporting Jared Kushner. Yes, that Jared Kushner. In the White House administration's Middle East peace effort, Neumann allegedly assigned WeWork's director of development to hire an advertising firm to produce a video for Kushner that would showcase what an economically transformed West Bank and Gaza would look like. Surprising? No?
No, there's very little that Adam Neumann didn't think he was qualified to do.
Right.
And this is certainly well within his purview. And, a lot of people have died on that beach, though, right? And, good intentions tried to, and I'm sure his intentions were good, but.
I think that's fair. I don't think he was trying, okay.
Well, I wasn't trying to undermine the process.
Yeah. Right, I was just saying any area where there's controversy as a default setting, right? Like the West Bank.
Disruptor.
Right, the West Bank by default is a controversial issue. Adam Neumann will find himself there.
It's so interesting because we were just talking about Hollywood and people going to Hollywood. And you don't understand, I bring a new perspective to the table.
Yeah.
Same thing with all these things. I mean, I remember people, Wayne Huizenga, when he was buying a sports team, he said, I'm bringing a new perspective to running a sports team.
Yeah.
Well, you just have to remember, you're not the first person to say that or to come here or to believe that you could do that. And maybe you are, but a lot of other people have tried with that same perspective that they're bringing a fresh set of eyes.
But they bring that fresh set of eyes with such confidence.
Right, they do.
That
and sometimes they do
can
change
find themselves. Sometimes they do, but they find themselves in these situations. Whereas I might be like, all right, well, maybe I could get somebody to do this video.
Yeah.
But I just wouldn't
changing
go
the face
in
of
and
video.
do it.
That's kind of a that's an interesting
Forever
point,
changing.
Andy. Everyone's default operating thing should be, I don't know anything. So I'm here as an idiot. Now show me what to do.
Yeah, or I want to learn, and some people do say that.
Very difficult.
Get curious.
Right.
That's right.
Get real.
Coming up here on the final round, we'll get curious in real with all things happening in this market. Plus, Mike Bloomberg officially throwing his hat into the 2020 ring, just in time for Warren and Sanders to go on the attack. We'll talk about everything going on in the Dem race right after this. back to the final round here on Yahoo Finance. Miles Olin with you in New York. I'm joined as always by my co-host Jen Rogers, also joined today by Yahoo Finance Editor-in-Chief Andy Serwer. Let's take a look at where we settled on this Monday. Record highs for all three major indices, the Dow, NASDAQ, and S&P, pretty soundly topping their prior records. The NASDAQ taking almost 70 points here over its prior record close. The Dow back above 28,000 for the first time in 4 trading sessions. Looking at some of the standouts on the session today, we were talking earlier about what was happening in the IPO space, some of those 2019 names that have been beaten down. Uber off about 1.5% negative headlines out of Britain earlier today, out of London earlier this morning, suggesting the company could be in some trouble there. That stock down 1.5%. Their rival Lyft picking up the slack, up 5%. But go down the line of some of these beaten down names, and you're seeing gains 4% or better for Smile Direct. You've got Slack up 6%, Revolve up almost 8%. That stock's been really hammered over the last few weeks. So kind of all the last bastions of risk and fear and things people were selling in this market finally catching a bid in what was really a risk-on, buy-it-all kind of session. Utilities, the only sector in the S&P, lower on the day.
Yeah, those IPOs, that class that we talk about so often, so beaten down. And, at some point, people are always watching those things because so many of those companies are good businesses. I mean, I'm a big fan of Slack. I don't know what the economics are, haven't looked at it closely, but at a certain point, it's a very legitimate business. I think actually they've gotten hurt because Microsoft have made some noises about getting in the business, but
yeah, Teams, they've got 20 million people now on that one.
Right.
I know there's not a ton in the red here. Only big, really
Uber
red
and
name I've got is
utilities.
Comcast is up some 3%.
McDonald's
today in there.
Right.
It's my biggest one.
Oh my God,
here.
Target was red.
Oh boy.
Call the authorities. How is that possible?
Never.
That stock goes up every day.
That's that's a little profit-taking and rotation and all that, right?
Mike Bloomberg officially throwing his hat in the ring for 2020. For more on what he's up to and the heat he's taking from the Democratic field already, let's head to Yahoo Finance's Jess Smith for the very latest in D.C. Jess.
Well, Bloomberg is making the pitch to voters that he has the political and business experience needed to beat President Trump. He is selling himself as a moderate candidate who can bring the country together. This afternoon, in his first press conference since officially jumping into the race, he's touted his experience fighting gun violence and climate change. He called President Trump an existential threat to the country. Let's watch.
If President Trump wins another term in office, we may never recover from the damage that he can do. The stakes could not be higher. We must win this election, and we must begin rebuilding America by investing here at home and restoring our nation's credibility and moral leadership abroad.
Now, Bloomberg reportedly has a net worth of more than $50 billion, and he is self-funding his campaign. He is not taking any political donations. Senator Warren and Senator Sanders, as you know, they are running campaigns targeting billionaires, and they've attacked Bloomberg, saying that he's trying to buy the election. Reporters asked Bloomberg about this at the press conference this afternoon, and he said that he's always used his money to try and advance causes he cares about. He says he's going to make the case to voters and let them decide. Jen.
Thank you so much, Jess. Have a good evening. So there's
too.
also some news coming out here as well that Bloomberg News is not going to investigate its namesake owner as part of this while he runs for president or any other Democratic presidential candidate. The editor-in-chief sending out a note. I mean, they've said it's not going to be easy to
Yeah, I don't think that's, people were kind of outraged. I don't think that's a story at all. I mean, as opposed to actually we will write about ourselves and it'll be really tortured. So, okay, fine, you make a call. Like, let's just talk about him running for president, right? Which is does he have the energy? He's 77 years old. Will he be likable outside of New York City? There are a lot of issues, but there's one thing maybe in his favor. I'm reading a quote from Warren Buffett on Squawk Box. He told Becky Quick, if Mike Bloomberg announced tomorrow that he was a candidate, I would say I'm for him. I think he'd be a very good president. Warren Buffett's endorsement, this is in February, presumably it still is binding or still applies, I should say.
Yeah. I think it's very interesting on that, jumping off of that exact thing, because I think a lot of people in fantasy politics land have said for some time, like, oh, I'd love a candidate like Mike. I remember Bill Ackman at the 11th hour of the 2016 race wrote that op-ed saying Mike Bloomberg should run. Right. And that's all fine and well. But now he's actually running, and he's actually shown essentially no electability, because there's no sense that he's going to pull anything more than 1%, because some people know him, most people don't know him, and a lot of people who do know of him don't like him. His favorables were kind of in de Blasio territory in the first blush of a poll that came out last week. And so I think the question now for the Bloomberg faithful is like, you wanted it, now you got it, right? And how much can money really buy in these elections? Because, yeah, I mean, obviously Donald Trump spent a lot of money, but the way that his campaign spent that money and the way that Facebook and other social media played a role in the 2016 campaign, I think were different than what conventional wisdom would have thought that money would buy, right?
Billionaires are a big issue in the campaign this year, and I would say, Warren Buffett endorsed Hillary Clinton. I think that if he comes out and endorses Bloomberg, that's just going to be something for Warren and Sanders to be like, another billionaire wants this billionaire to
good point,
support
Jen.
him, and
maybe not a good thing.
Out.
I mean, it'll certainly get 2,000 people to vote for him.
Yeah, right.
You know what I mean?
Right.
Right.
We're about to find out a lot about what voters really do like and how far some
Absolutely,
of that stuff goes.
it's going to be very interesting. I'm so perplexed. I really am. I have no idea how this is going to resolve for the Democrats. No idea.
It's going to be especially fascinating when Pete goes out and wins the first two primaries.
Right.
Because it's like, because that seems like that's going to happen.
Those states have their own
now.
demographics.
Yeah, exactly,
and,
right.
It's all very curious, right?
Long way to go. Coming up here on the final round, just in time for the holidays, we've got a new unexpected Jordan drop. Reggie Wade joins us for the unboxing coming up right after the break.
Excellent.
Tis the season for sneakers, and Nike is celebrating early this year. The company secretly dropped the latest iteration of the Air Jordans on their app, where guess what? They sold out in minutes. But Yahoo Finance's Reggie Wade got his hands on a pair, and he joins us now. Okay, secret drop.
Yeah, secret.
What is this all about?
I was actually writing, these come out December 14th. I was busy writing the article and I missed the drop myself. So even I missed out.
But you got something.
No, I have here. These are a sample pair we have here. These are the Jordan 11 black and red, or as we call in the sneaker community, the bread. So, Miles, if you do the honors.
Well, he's doing that. These are just other ones.
Breads is a combination of black and red. So any black and red shoes.
All right, I like those.
The black?
I like them.
That's actually cool looking.
I like that one.
Yes,
Andy, you'll recognize these from the 1997 NBA Finals.
Yeah, wow. God, the Wayback Machine.
Yeah.
Michael Jordan wore these pairs in some of his greatest games, and we have 3 iterations of these. We have, of course, the breads. We have the original, the Concords, the white and the black. And next to Jen and Andy, we have the Space Jam model. That's the model that MJ wore in the movie Space Jam. So Jordan Brand comes out every year in December with a new Jordan 11. Last year was the Concords. 2 years before that, it was Space Jams, and now we finally have the breads and sneakerheads everywhere. This is what we've been waiting for.
This what?
Yes.
So tell me how much this cost when it dropped. In like not buying it.
$220 now. When it dropped originally in 1995, 96, they would go for anywhere from $139 to $150.
And they sold out right away.
Yes, sold
and
out in
now what are
minutes.
they selling for in the secondary market?
In the secondary market, you probably grab a pair of those, maybe $500, but they are releasing again on the 14th. That's the wide release. Nike likes to do these shock drops. People could get them early. They flood the secondary market, but if you want your pair for retail, December 14th.
So wait, if you could buy one in the secondary market for $500 and then they flood the zone after that and they're back down to $200 again?
Yeah, $220.
Oh.
Reggie, you and I were talking earlier today about the state of the sneaker resale market, especially as it comes to supply, when thinking about brands like Jordan or about Yeezy. As you see the space right now, does it seem like companies are still struggling to get that balance between the right amount of supply to keep demand up, but also not putting out enough that the price will skyrocket in the secondary?
Miles, you bring up a great point, because it's a double-edged sword. It's kind of, are they or are they not working with the resellers or for the interests of the resellers? So I think it's a balancing act. We can take Yeezys, for example. Adidas says, yeah, you know what, we're going to put out more Yeezys. More Yeezys are going to be readily available, and we're even going to see a sub-$180 Yeezy. All right, fine. Then they hold back on that, and then you see the limited supply drop. Then the next drop is more of a general release. So it's kind of this yo-yo thing where you really can't get a grasp on which side are they on, the resellers or the average.
Right.
And you know what's interesting to me is that Michael Jordan hasn't played in so long, right? But he still has this line of shoes. Now, 2 things. One, okay, he may have been, or maybe, I still think he was the greatest basketball player of all time. Still, sorry. Okay, so there's that. And then the other thing is but young people might say, who's that guy? It's a shoe name. Like, think about Chuck Taylor's. Right? Chuck's, right? Yeah. Chuck Taylor was a basketball player. Yeah. No one remembers that. They just remember him for the shoes. Yeah.
Like Stan Smith.
With these, I agree, but now with YouTube, I think the younger generation sees what MJ does, but you're exactly right. Chuck Taylor's, we remember him as a shoe, not as a person, and also the person that LeBron always gets mentioned.
Yeah, but you must be a LeBron guy, the way you were poo-pooing.
Yeah, I'm a LeBron guy.
LeBron's better than Michael Jordan?
Here's what's going to happen.
Where are the shoes?
Here's what's going to happen.
He's not. Okay, go ahead.
Everyone who's in their prime, as it were, as a viewer, as a consumer, will think that the person who they watched in their prime is the best, right? So I believe that millennials will, in general, believe LeBron was the best, because guess what? I used to sit every May and June and watch LeBron every night for 3 months, do LeBron stuff.
That's crazy.
I was a little kid when Michael Jordan was,
Okay, fair
and
enough.
We got, and Chicago guy, producer Praz in my ear right now, talking about how great Michael Jordan is. And that's fine, but that's his guy.
Thinks that, Zion Williamson is awesome.
He'll be awesome.
Or whatever.
I think James's best player hasn't come around yet.
Probably.
What's that guy? Plays for the
Luka Doncic.
No, was I talking about him?
John Morant.
John Morant.
Yeah, Grizzlies.
John Morant for the Grizzlies.
Doncic.
Right.
Mavs.
Yeah.
That guy.
These guys need shoes.
No, they do need shoes. See, so we get some of
deals.
these Jordans out of the way. Maybe these new guys can come up.
So Zion has his own shoe already?
Zion actually signed with Jordan Brand. He's wearing the Jordan 34. If he ever gets on the court, he's still injured.
What new player has a shoe, their own shoe?
Giannis has the Zoom Freak ones. LeBron has his line with Nike. Steph Curry has his brand with Under Armour. We have Kyrie Irving, his brand with Nike. So a lot of players have their signature models.
So the guy for the Bucks has one. I mean, he's sort of the youngest guy that I can think.
The Zoom Freaks.
Right, the Zoom Freaks.
I had to look
Backward swoosh on them.
I had to look up why they have 45 on the back.
45?
Do you know?
That's his number when he came back.
It says it's because it was his number when he played
What about
in
23?
middle school and high school.
Yeah. Remember the end
of the game.
Remember the end of Space Jam? He came back out with 45.
Yeah.
Space Jam.
He wore it while playing junior varsity, and you know what? It was also
my
the number.
jam.
It was also the number of his older brother.
Yes, and when he got to the Bulls, 45 was not available, so he went half of that, which is 22 and a half, but you have to have a whole number.
You know why he's
so round it
Michael,
up.
right? You know.
It's very nice.
Because it was Mike, and then the sports information director at UNC goes, I'm thinking you're a Michael, not a Mike.
You're getting trivia, you're getting sneakers. What more do you want?
Debates
Yahoo
about NBA players. It's great.
Reggie Wade with the latest iteration of the ever
Reds.
popular Air Jordans, and you get to
Red.
see your breads, and they're out for real
Best of
December
bread.
14th. Good luck to anybody. And obviously, this is great for Nike stock, I guess.
Yeah.
Yeah.
Oh, Andy Serwer, have a great evening.
Thank you.
You can go
Take my breads.
wear your breads. That's right. Coming up here in the final round, we'll hear from StubHub's president on eBay selling the ticket broker to rival Viagogo. We're back with that conversation right after this.
It's Monday merger mania on Wall Street, and among the big deals announced today was eBay unveiling its plans to sell ticket marketplace StubHub to Swiss ticket reseller Viagogo for $4.05 billion in cash. President of StubHub, Sukhinder Singh Cassidy, joined us earlier to discuss what it means for StubHub going forward. Take a listen.
So I think for StubHub, this is actually a very successful outcome, and we're very excited about the opportunity to put together our U.S. and successful business here with really Viagogo's international footprint to create truly a live and global player in live entertainment. And we're excited about the opportunity to really accelerate our growth in partnership with Viagogo. I think it's a win for fans, a win for content rights holders, and certainly a win for sellers on the platform to back more inventory.
Hey, Sukhinder, Andy Serwer here. Thanks for joining us.
Andy.
So this business of tickets is obviously something you know well now, but it's, a business that's in transition. What exactly is the future of StubHub with this new ownership, and how's it going to work for consumers?
So I think there's a few key tenets of this deal that are really important to remember. First and foremost, as you think about fans and a footprint for fans globally to be able to buy tickets in the U.S., tickets internationally, and the phenomena we see, which is traveling consumer being able to buy cross-border. I think the first thing you can imagine if we increase the scale and size of our operations globally, the opportunity for fans to have more choice across more territories to go to more events. And I think that that's a really important tenet of this deal. I think another important tenet is choice for sellers and choice for content rights holders. And as you and I have talked about previously, we really believe there's an opportunity for people to take advantage of our distribution who are, whether you are a consumer seller, whether you are a broker, or quite frankly, whether you are a sports team, a venue, an artist, looking to take advantage of the tools and distribution we provide. So I think when you think about what this means, I think for all players in our ecosystem, we think that it means the opportunity for more business and more choice. I think if you think about specifically the consumer, I think we think about the U.S. outbound consumer, the U.S. inbound consumer, the global traveler, all benefiting from this deal. Lastly, I think we see that mobile and the opportunity for consumers everywhere to be actually more capable of buy tickets at the last minute across multiple geos and on their devices will be another kind of future vision of this deal.
You know, Sikander, you referenced the growth of live events, especially on the music side of the business, and I think we've all learned a lot about the financials of how the music industry is actually working over the last couple of months with Taylor Swift's latest Dust Up. I guess as you think about that space specifically and where StubHub wants to go and where you think this partnership could take you in the live music space, is this something that is kind of driving your thinking here, or are you looking kind of across all of your events that you're working at to kind of think about where the new StubHub under this new leadership goes?
So I think it's a great question. So first of all, you're right in thinking about the deal being beneficial to all the genres of business that we're in, including sports. So let me just touch on sports for a moment before going to the music question. First and foremost, let's remember the NBA, the NHL, the NFL, and Major League Baseball are all increasing the globalization of their own businesses, whether it's having a team abroad or franchise abroad or a game abroad. So we know that a global footprint is important in sports. In the music industry, artists are more dependent than ever on touring revenue, and that includes global touring revenue. So to the artists that we think about, leveraging our platform, and we do think that that's an opportunity increasingly for people to come direct and use our footprint and access to fans, even in the music industry, to be able to connect them with performers directly. I would say that the global touring nature and importance of global touring for them indicates that this should be a strong positive for them as well.
And then just in another space where we've had some resale news recently is the RealReal that has gone public. They've had some authentication issues. And StubHub, I've used it. I've never had problems. I think it has a really good reputation for that. Viagogo, there's maybe some more questions there. Putting these two together, is StubHub going to be bringing that reputation and what you guys have been able to do to bear here in the relationship?
I think absolutely. I think if you were to talk to Eric Baker, who's the CEO of Viagogo and actually one of the original co-founders of StubHub, he would tell you that the brand and the fan transparency and trust we bring to the table, as well as, of course, our premium content rights holders relationship of it with the NFL or Major League Baseball, I think he would see and argue they are all core aspects of this deal. One of the reasons, quite frankly, we had such success with that company, right? And the premium that's placed on the brand.
All right, and coming up after the break, we'll have what you missed here on Yahoo Finance Today. We are back right after this.
Now it's time for all the best moments that you missed today on Yahoo Finance. Let's check it out.
The story with LVMH and Tiffany kind of, in my mind, really leads to some more questions than maybe answers at the moment. I think this is clearly, a big deal for the luxury goods market. So you have to wonder, is this kind of signaling some kind of peak in luxury goods?
It's going to be an okay Black Friday. I think the data that we get tells us that consumers are going to spend, but they're really prioritizing other categories more than apparel and footwear right now. So they want to spend on their home, they want to spend on travel, they want to spend on experiences. Apparel and footwear is kind of on the low part of the totem pole when it comes to what people want to spend their money on.
U.S. in particular, although the valuations are a bit more heightened here, we think that we're the sort of clean shirt in a pile of dirty laundry as far as growth is concerned.
It's a combination of nationalism. There's been a lot of pushback by activists on buyers in big deals. Think about Oxy and Icon and AT&T and Elliott and all that. And lastly, I think the market was a little tired. There was so much activity from 2015 to takes a while to digest and reload.
Our aim is to launch a few more locations over the next couple months, and then before the end of Q1, we're going to be testing outside of New York. It's not just good business for Bandit to be able to open in, a couple of hours, or really, from soup to nuts, 30 days or less, but it's actually good business for landlords because vacancy is expensive.
A lot of people, because it's free, now they're going to start trying to trade their own retirement plans or do those things. It becomes almost recreational. And I think people have to decide whether doing this is an investment or recreation. And I think that before, people didn't trade quite as much because of the incremental cost.
I think for StubHub, this is actually a very successful outcome, and we're very excited about the opportunity to put together our U.S. and successful business here with really Viagogo's international footprint to create truly a live and global player in live entertainment.
That's going to do it for us today. We're closing out here and also starting the week at record highs.
The week's over. Short week.
The week is I count tomorrow as a day. Maybe Wednesday, not so much. But this is different than what we had last week, that little bit of a breather. We're back to moving, and you cannot discount that move on the NASDAQ there and the Dow above 28,000. I'm Jen Rogers with Miles Edlin. This is the final round on Yahoo Finance.
You may have seen Target's newly launched flagship food brand Good & Gather while shopping at one of their stores, but the owner of a similar line, Garnish & Gather, is suing the retail giant for copyright infringement, saying that Target knowingly and willfully violated trademark laws. Here to talk about the lawsuit is Emily Golub, owner of Garnish & Gather. Emily, good to see you here. So what has been your interaction with Target up to this point?
Yeah, so when we found out about the launch of Good & Gather in mid-August, we sent a letter to Target and let them know about the infringement. And unfortunately, Target really hasn't taken this matter seriously. They let us know that they would be happy to help us out with some search engine optimization. And unfortunately, that's just not acceptable. You know, this is the future of our brand, and the brands and marks are just way too similar. So it's really disappointing.
That was a cease and desist letter, I would imagine, that you sent Target in mid-August. You know, this has all the trappings of a David and Goliath story here, Emily, and I'm sure you're very well aware of that. I'm curious if you have seen a direct impact on your brand recognition, on sales since Target came out with its line.
Yeah, we have seen a lot of our customers share with us that, gosh, this brand is really similar and really confusingly similar and such. So we are really worried about what this looks like for us in a year from now. Once Target's been able to pump millions and millions of dollars into making this their flagship brand, where does that leave us? It's really challenging, and it just feels like all of our growth is really in jeopardy. If we were to enter into a new market, we've been considering growing in the Southeast, growing to Nashville, to Athens, and we have customers in those markets who would be excited that we were there and excited to support us and tell all their friends about Garnish and Gather coming to town. But when those customers then walk in the next day and see Good and Gather all over the shelves at Target, it's bound to be very confusing. And it just really makes our ability to grow and support our company really challenging.
Emily, what's next for you in your fight against Target?
We're hopeful and feel very confident in our legal team and with our counsel that we will be able to, pursue this in court. But honestly, I would hope that we could have a discussion with Target before getting there. I never wanted to take this to court or have a legal battle with Target. I just wanted to grow the brand that I've worked so hard for the past 6 years to protect and to have. And I would hope that Target would take responsibility and come to the table and have a reasonable discussion about how we can resolve this. I would like for them to stop carrying the brand and to rebrand, and their flagship grocery line is something different. And, I wish them all the best in that. But, I really need to protect my brand.
Emily, we reached out to Target and they sent us this statement. I want to read it to you. At Target, we have a deep appreciation and respect for trademarks. We're aware of this lawsuit and are confident that Target's brands, including Good Gather, are distinctive in the marketplace. We've shared that feedback with Garnish Gather and will continue to defend these claims through the legal process. What is your reaction to that statement?
Yeah, unfortunately, I just don't think that's accurate. If you look at Good and Gather and Garnish and Gather, they're incredibly similar. While the brands and logos themselves are not identical, we're really concerned about the words. We're a word of mouth business. And so we don't have the resources to be advertising on billboards or in magazines. Everybody hears about us through word of mouth. And so when you're saying these words, Good and Gather and Garnish and Gather, G&G, they're incredibly similar. If Target had Good and Gather on the shelves for the past 6 years, and it was their flagship grocery brand, and we tried to launch Garnish and Gather as a new brand, you bet your bottom dollar that they would be coming after us and saying that this was infringement.
Emily, what if they come to you with an offer to buy your company? Would you consider it?
We would definitely be open to having some discussions. And I think that Target's a great brand, and up to this point, really respected what they did and would have been interested in a strategic partnership with them. But, so far we haven't had that sort of response from Target.
This morning, we also have our eyes on shares of Oramed Pharmaceuticals. That company is touting a successful phase 2 trial of a new oral form of insulin for treating type 2 diabetes. And the CEO of Oramed, Nadav Kidron, is here to talk about it now. Welcome and good to have you here.
Thank you. Good to be here.
If this is approved, would this be the first pill taken orally for treating diabetes too?
It will be the first insulin pill in the history of the insulin. Since insulin was discovered, we're almost going to hit 100 years for that, never insulin was being able to be delivered orally.
And how does it work? It goes straight to the liver, or does it go through the bloodstream first? How would it be different from a needle, aside from the fact that a person wouldn't have to get the needle?
So the advantage goes ways beyond the patient's compliance. The idea is that when we give insulin as an injection, it goes directly into the bloodstream. But when you take the Oramed's technology and you take the oral insulin and you give it as a pill, it goes into the liver. And the liver is the organ that regulates the secretion of the insulin into the bloodstream. So it's really mimicking the physiological way that the body works.
How far are you away from FDA approval on this?
So the biggest news was about 2 weeks ago when we announced that we had a successful phase 2B trial. So we showed for the first time in history, we took a large group of patients, we gave them the Oramed oral insulin, and the other group got the placebo, and we showed that it works. Now we left to go through a phase 3, get the FDA registration, and we have a drug on the market.
I always thought that an injection would be a quicker acting way to deal with diabetes than the pill. What about that? When time is of the essence, would the pill still work?
You're absolutely right. The biggest advantage of the injection is the timing, but the biggest advantage of the oral is that it really helps us control the disease in a much better way. So at the end of the day, what we should see in the market is oral insulin with some injectable insulin, and 2 of them will give us a new horizon for the way we treat diabetics.
What's the roadblock to getting the FDA to approve this?
Okay, so the FDA wants to see, first of all, that this is a safe drug, and it wants to see that the efficacy works well enough. So even though it's insulin, so it's not a new drug, and we know that insulin has been around for many, many years, Oramed still needed to go through the whole trials, phase 1, phase 2, and now we're going into a phase 3 to show those 2. It's safe, you can use it, it works, and it's going to help a lot of diabetics out there.
How big could this one pill be in terms of sales, in terms of profits? Surely you have some kind of, maybe some estimate on it?
So I'll tell you, the good news maybe for shareholders, but the bad news for us as a society, we spent last year almost $800 billion on diabetes. And the oral insulin can take a meaningful part out of that, because people will start with the insulin much earlier. Because someone would be afraid to take the needle, but he will start with oral insulin as an earlier treatment. So hopefully we can take a big part of those patients that will switch and will start off with the oral insulin.
If and when it gets to market, because we're going to stay positive here, any idea on cost, and would insurance pick that cost up?
Okay, so part of the idea of the cost is that it's going to be in line with our other ethical medicine. But we also want the payers to look at the big picture. And the big picture is that by starting giving Ormed's oral insulin as an earlier treatment, we can potentially lower the overall crazy cost that we pay for diabetes these days.
And last but not least, do you need to be part of a larger company just to reach full potential for this drug?
So at the end of the day, diabetes is so much all over the place, so you need someone to distribute it, you need a big pharma to do it, and that's like you saw before, but another deal, usually they need to fill up their pipeline, so they come to the small companies. And
are you in talks with anyone?
We are in talks with some potential partners, but once things are at the point that we can disclose more, we will disclose more.
We're talking streaming today because Netflix and Disney are getting into the holiday spirit by adding more Christmas content. Streaming services are ramping up on seasonal cheer and taking on more traditional cable channels that have been dominating the annual holiday movie binge. But the Hallmark Channel, which has been pushing out Christmas content for almost a decade now, seems ready for the fight. It will be airing 40 new holiday films across its channels this year. And joining us now is actress and star of one of Hallmark's soon-to-be-released films, Christmastown, Candace Cameron Bure. Candace Cameron Bure, thank you so much for being here.
Thanks for having me.
Appreciate it. I mean, we were doing the math. I was looking back. 22 Hallmark movies
Yes.
is the total you're up to now.
Right.
I mean, that's a lot. How have you enjoyed managing all of these things?
Well, I've loved it. That's why I'm a part of the Hallmark Channel, and I love doing the movies, and I love the company and the values that they have, and I love the audience, and I love making movies that make people feel good.
Yeah, have you noticed? I mean, Hallmark's been good at doing that, right? I mean, as
Yes.
we were just talking about, I mean, not Halloween, Christmas is their season, right, for
Yeah.
Hallmark. But now as we're seeing other, content platforms out there, we'll get into Fuller House on Netflix in a while. But I mean, Disney, Netflix, all kind of targeting the holiday theme as well here. So how do you kind of manage all of that?
Yeah, well, Hallmark's done such an incredible job, and obviously there's a real niche for holiday movies, and all the other networks and streaming platforms have caught on that there's an audience that wants them, loves them, soaks them up. But in my opinion, no one does it like Hallmark. No one does the holidays. And, it's all different. I think that there is room for all of them because Hallmark is very specific in the type of movie that they have because their audience knows what they want and they stick to that. And so some of the other streaming services that have holiday movies, I think it's great, and they'll probably pull a different audience to those. And there's room for lots of actors and producers in the Christmas genre.
Yeah, for sure.
And as an actress who works both with traditional networks like the Hallmark Channel and then with content that's put on something like a Netflix, do you find that when you're in front of the camera, is that experience different? Are those production companies different, or what is that differential?
No, the difference, it doesn't make a difference whether it's streaming or on cable or network television as far as being an actor. It all depends on the production and what your budget is. That's what makes the biggest difference. I do find though when you're on traditional cable, because you have advertisers, that does make a difference. And whereas streaming, you watch what you watch, and that's kind of it. So there's disadvantages to that as an actor and as even a producer when you're on streaming. And although there are some advantages to both.
Yeah, well, let's talk about...
I'm happy that I'm on both platforms because...
It doesn't hurt to have some options at your hands here. And I mean, we've seen that too with Netflix, right? Because they have Fuller House season 5, the final season, is going to be debuting here December 6th. So I mean, what's that process been like? Because I know it's afforded you the opportunity to jump in and actually direct some of these episodes as well.
Yeah, it's been really wonderful. And Fuller House has been so special for me, obviously, because it's been about, over 30 years I've been playing this character that is beloved by not only the fans, but by me. She's like my sister. So I'm sad to say goodbye, but we have a great season 5 ahead of for everyone, and we wrap up the show really wonderfully, I think, for the fans.
I mean, one of the questions too that we've been getting from people who have been following the series, and I know you've talked about this before, is the absence of Lori Loughlin from the Fuller House season 5 here, because we've seen after the cheating admission scandal. I mean, how has that impacted the way some of the concerns when we talk about having to have everybody along for the ride here? How has it impacted the Fuller House family, as you call it?
We've done the show, and the writers and producers have done a really great job, and the show must go on.
It does go on, and it's made Jeff and his family very happy because, as he was saying, it's been on all the time, nonstop.
Every night in our house, my 8-year-old daughter Kate goes to sleep to it every night.
Oh.
That's what I'm saying. So family it's very true. People have a connection to the show.
Put her to bed sometimes. Night, night, Kate.
Yeah, I'm sure. Candace Cameron-Bure, thank you so much for joining us.
Thanks
and
for having
congrats
me.
on all the success.
Thank you.
Fuller House, again, debuts, final season, December 6th. Thank you again for joining us. Well, Kylie Jenner sold a majority stake in her billion-dollar business, and we're breaking down what that could mean for other cosmetic giants in this week's Fame and Fortune. All right, joining us now is Yahoo Finance's Alexandra Canal, and Alexandra, Kylie Cosmetics is pretty much Jenner's baby here. Yes. So, I mean, she's kind of putting the baby up here, majority stake, now owned by Coty.
Right, and Coty shares did pop on this news, so Wall Street clearly very bullish on Kylie Jenner. And if you didn't think she was a billionaire before, you certainly do now. They bought a 51% stake in Kylie Cosmetics for $600 million. That values the company at about $1.2 billion, which is pretty insane. Kylie was very young when she started this, a teenager. It was just lip kits. Now it's exploded to eyeshadows, highlighters, blush palettes. So this is a big move for her, and also a big move for Coty because they do have a few beauty brands under their umbrella, like CoverGirl, Rimmel London, but they were really missing that prestige skincare and that prestige color cosmetic. So I do think it's going to open that up for more acquisitions in that space moving forward.
Yeah.
Of course, we had that Reuters report yesterday that there are several buyers interested in Coty's professional hair and nail brands. So I think we're going to see them start to trim the fat when it comes to their portfolio and really focus on areas of high growth. Clearly, by the amount that they paid for Kylie Cosmetics, that is an area that they think they see a lot of potential.
Yeah.
Yeah, what do you think this really says about the beauty industry? I mean, we've seen Coty's one of the top 10 performing stocks in the S&P 500. It's up like more than 70% for the year to date.
Yeah, I think over 80%.
Exactly.
Crazy.
So what do you think it is that really differentiates these brands? I mean, even with something like a Procter & Gamble, it's their skincare, it's their cosmetics that are really driving the performance. So what is it about Coty that is pushing them ahead?
Well, right now in the cosmetic space, we're seeing a lot of disruption, and that's due in part to the Kylie Jenners of the world, Rihanna, Lady Gaga. They're coming out with these direct-to-consumer brands and really focusing on social media and focusing online. So a lot of these traditional retailers, they're having to be innovative here. And I think Coty lining themselves up with Jenner is a great partnership. She obviously has a cult-like following.
Yeah.
So I think moving forward that this is a good deal for them.
Not to play devil's advocate here, but you did just name some other celebrities that are pairing up with other people. Lady Gaga on Amazon, we know about that. So, I mean, when we look at that, there is a question of whether or not Coty may have overpaid for some of this too, because obviously Kylie Jenner doesn't have a monopoly over the celebrity status.
She does not, and that was a concern amongst analysts. They just overpaid for this. If you look at recent sales of Kylie Cosmetics, they've been slipping recently. I think in the last 12 months, it was $177 million for net revenue. If you compare that to that $1.2 billion valuation, that's 6 times that. So that's a big concern. Another concern is when you're betting on a brand that is based on a person, you have no guarantee that the brand is going to outlive the person. You look at Estee Lauder. They bought Bobbi Brown in 1995, that cosmetic line. Now, 20 plus years later, that's one of their more, like, the weakest brand in the Estee Lauder portfolio. So this happens all the time. We see this a lot, and the cosmetics industry is fickle, and there's no guarantee that Kylie Jenner, even though she's hot now, that she's going to be hot in the next 10 years.
That seems to be, that would be my biggest concern here, is just that the idea that the cachet of a certain celebrity wanes over time, and somebody else could come along and maybe have a better lip kit. I'm not sure if it's judged that way when it comes to quality over just the actual brand ambassador.
And you look at Lady Gaga, she partnered exclusively with Amazon. She's been doing really well. She just released a holiday lipstick a few days ago. Already it's an Amazon bestseller, so she's killing it on that front. But what I'm interested to see is how Coty is going to take Kylie Cosmetics. Are they going to double down on this cool factor that Kylie Jenner has established that really grabbed her loyal following to begin with? Or are they going to revert back to those time-tested sales models that worked for CoverGirl? Will we see Kylie Cosmetics in the CVS aisle? Perhaps, and that would completely draw a new type of consumer, a consumer who doesn't really care who Kylie Jenner is, they just want a lipstick. So there's different ways that they could take this.
Or you can make the argument that might water down the brand cachet, perhaps.
And you could alienate those followers that really liked Kylie because of who Kylie is.
Yeah, a lot to be worked out there, I suppose, but nonetheless, big money moves in the cosmetic space. Alexander Canal, thank you so much for that.
Our next guest turned a passion for exercise into a career. Now, not only is he an icon for everyone who's into CrossFit, but he's sponsored by Nike and has the most followers of any of the top CrossFit athletes. Joining us now is 4-time reigning and defending fittest man on earth, Matt Fraser. Matt, let's start with the idea of investing in yourself. You took a $500 prize and have basically made a career out of it. Can you tell us more about how you did it?
Yeah, I started competing in CrossFit. I was a full-time college student at UVM pursuing mechanical engineering. And, I didn't want to get a part-time job, but I saw an opportunity to make some pocket money competing. And so it slowly just built, and I started investing more time into myself to get better at that. And by the time I graduated college and the job fair came to the school, I I didn't go.
So I guess, Matt, in thinking about how your career has progressed and the finances of it, right? Because it was lumpy, obviously. You know, if you go to a meet and you win, you get the money. But over time, you know, the sponsorship will come in, things have smoothed out. When you were first making some money and you realized you weren't going to have to get a desk job, I guess that would have been, what, 2013, 2014? Yeah. Where did you kind of start in figuring out how to structure and budget your life? Because, you know, things are a little bit weird when every 3 months, you know, you make 10 grand or whatever, but that's not happening every day.
Yeah, you know, there's a lot of risk in having this as a career, you know, especially early on when a majority of your salary comes from prize money and you only get paid if you win. So, you know, I'm lucky enough now to work with brands that, you know, support me throughout the year. But early on, before those sponsors were there, I basically set up my life so that I had no costs. So that if I went to a competition, didn't perform well, and made zero money, I was still okay. So, you know, I lived with my parents for the first couple years of it. You know, I drove a very inexpensive car. You know, I kept my expenses as close to zero as possible so that I could take the risk in gambling on myself.
You're like a fire person almost. I mean, you don't still live like that, do you?
No. I have my own house now, yes.
So talk to us about some of your, since you've been doing this, the advice that you've gotten on how to not just invest in yourself, but now you have money as well. What are you doing on the investment front?
Yeah, so, you know, early on, you know, I was trying to do the responsible thing and, you know, it's invest your money while you're young. And so I went to a broker and basically just was like, here you go, do something with it. And then as time went on, I had more free time to do some research and trying to educate myself on the topic. You know, basically every book that I read was saying, you know, don't pay someone else that 1%. That 1% over 40 years, it compounds. So I started doing some more research on myself and found a low-cost site. Started dabbling with it and trying to learn the platform of the site on my own. And just recently, you know, I took all of my assets in, so it's all under my management. And I have a good friend that helps me. And so, you know, just trying to play it safe, but I'm trying to capture the market.
Yeah, I mean, are you thinking about your investments actively right now, or are you still mostly just focused on your career? And obviously you're doing a lot of other things besides your competition at this point, right? You know, the last couple of weeks, if anyone's following you on Insta, you're all over the place. How close are you paying attention to what's happening, I guess, in the business world, and kind of thinking about what's next for you, maybe?
Yeah, so it depends the time of the year. You know, if I'm leading into a competition or at a competition, it's kind of hands off, and, you know, I try to get it in a good place where I can walk away from it for a little bit. But then when I'm in my off season and, you know, I'm just kind of laying around the house, you know, on vacation, I'm very, very involved with it. But, you know, it's all accessible from your phone, so it doesn't really matter where I am, what time zone I'm in. I have access to it.
So what's next for you after this? Because we have a lot of athletes.
Like after CrossFit?
Yeah, like how long? I mean, I guess it's kind of a new era. Like, how long does a CrossFit career last?
I mean, that's kind of the question on a lot of competitors' minds of, you know, the sport's relatively new and people are still trying to work out the kinks of how to train properly, what's the life expectancy of a CrossFitter, all this stuff. So, you know, I'm kind of in the middle of that as well. You know, I never expected this to end up being a career. I figured it was a good way to make some pocket money while I was in college, and then I was going to go on and get a desk job as an engineer, but it kind of worked out.
Matt Fraser, really appreciate the time. 4-time defending CrossFit champion and CrossFit Games champion. And I'll talk to you soon.
Yeah, thank you for having me, guys.
It is Monday, and that means we're taking a short break from Wall Street to find out what is happening on Main Street with some of these small business owners across our country. Today, we have the owner of Para-Lee Boyd Salon in Detroit, Dana White. Dana, thanks for coming on.
Hi, thank you for
All
having
right,
me.
let's talk about the company. Why did you start the brand, and what do you think is your sort of brand? What do you guys stand for? How do you stand apart from other salons?
So I started Para-Lee Boyd because women were tired of making appointments, being in the salon all day, and paying a premium. So I was working overseas, and I too was having a hard time navigating appointments and when to be there and when not. So I decided to come up with a walk-in only hair salon that was open 7 days a week, so women can come in and go and get them out in and out in a certain amount of time.
No appointment.
I think this is really important as a woman who has to deal with this as well. So talk to us, how do you do that? What are the economics of it? How do you get there?
Yeah, so I used automotive principles from Ford, GM, and Chrysler, lean manufacturing principles. We're actually a very data-driven salon. So in order for us to operate walk-in only, we have to keep a certain amount of data to know how many people are coming within 15-minute increments so we can manage that flow properly and get women in and out in a certain amount of time.
So you're ready to franchise this business, as I understand it. So what does that expansion strategy look like? And why are you picking franchising as opposed to managing your own new branches?
That's a great question. So I think this is a problem that women are faced with everywhere, as she said. And I think the best way to reach women everywhere is to franchise. We're looking at multi-city unions, and that would make me one of the first African-American female franchise salon owners in the country. So it was a better fit, this model, as opposed to company-owned. Company-owned takes time. Right? And a franchise model is rapid growth, and we can reach more people quicker.
When you do franchising, I guess the concern always is consistency, right? We talk about this with food chains like Chick-fil-A. I mean, you want every location, even if it's owned by someone else, to match the same feel and culture and efficiency of your original business.
Absolutely. And so we have very lean standard operating procedures that can be replicated. And that's the core of any franchise. If you can't duplicate it or train it, then you can't franchise it. So we can, and it's proven. We've been in business 7 years, and we've got 2 locations. So it works. I was like, the operations work. I'm sorry.
You know what busy women like? They like convenience and they like saving time. So how does it compare from your experience before, just going to a salon as a woman, versus now? What kind of time are you saving?
Oh man, so before I'd make an appointment weeks in advance, I'd get there at, let's say, 9 o'clock. I wouldn't leave till 2 or 3 o'clock in the afternoon. Yeah, sometimes 1, 2, or 3 o'clock. Now, if you walk in our salon at 10 o'clock on a steady day, our metrics have you in and out anywhere under 2 hours. Quickly. Yeah.
That is good.
Now, from a labor standpoint, I mean, sometimes at barbershops, for example, if you go in during a really low time, I mean, you'll see like 3 to 4 or 5 barbers just kind of sitting there waiting. How do you make sure that the turnover is kind of even so that you have people coming in, but then at other points in time, you're making sure that people aren't waiting out the door?
Again, that's the data, right? So having been in business for so long, we know within 15-minute increments how many people we should expect between 9 a.m. and 9:15, 9:15 and 9:30.
And you staff accordingly.
And we staff accordingly, yeah.
Let's wrap this way, Dana. I know that you guys are in Detroit. Love to have a business in from Detroit. Give us a read on what is happening with small business in Detroit, because for years the story was the city's still bouncing back after everything that happened with the car industry, and now what you hear is that things are really starting to boom again.
Absolutely. I lived in New York and decided to open this business in Detroit. Detroit is, I won't say it's just not only coming back, Detroit is back. Detroit is home to one of the largest communities of African-American women business owners, if not business owners in the United States. So if you're looking to start a business, all the programs and grants and just the resources available to help business owners get started, you're not going to find it any better than the city of Detroit.
Wow.
I love that. That's awesome.
Let's go do Wi-Fi AM from Detroit. All right, Dana, thanks so much.
Thank you for having me.
Really
Nice to meet all of you.
out as a fashion blog has developed into a full-fledged business. Danielle Bernstein boasts 2.2 million followers on Instagram, has a swimwear and overall line, has recently launched, is MOE Assist? Mo Assist?
Yeah, Mo Assist.
Mo Assist, all right. Workflow tool for influencers. Danielle Bernstein's behind We Wore What, an influencer herself. So 2 million followers. I guess we've had some influencers through this space talking about how they manage that kind of following. When you think about using your Instagram account on a daily basis, we were just talking before, it's your account, it's kind of attached to you. You still, I guess, remember when it was just your friends and it was a smaller thing. Has it changed, having that bigger reach, changed the way you think about interacting with that platform every day?
Of course. I mean, Instagram has given me a career. And so I think the first post I ever did was my 18th birthday cake 10 years ago. So, we weren't looking at Instagram as a business then, but it has fully given me a career. And We Were What has become a platform that I have grown and built brands off of, and now a tech company. So when you think about, I guess, the growth of this platform on Instagram, and you mentioned you've got the other platforms going on off of that, where does the Instagram ecosystem stand in your view right now? Does it feel like it's still growing? Is it kind of mature? Definitely.
Because there's a lot of different businesses being built off of Instagram. Is the growth still though on the main platform?
I think the growth for Instagram is still my focus, and it's still the platform that's allowing me to run these other businesses. And I do think it has longevity, and I don't think it's going away anytime soon.
So on the topic of Instagram, obviously recently Instagram started testing the hiding of likes. And I know that's extremely crucial to influencers like yourself as well as many others. Obviously, I want to get your thoughts on that. How is that going to affect you if it does go?
Yeah, I think for someone like me who's been doing this for so long and has sort of been at the forefront of the influencer industry, it won't affect my business with brands because you'll still see the conversion rates, you'll still see an ROI, and you'll still see sales. So I think that for up and coming influencers and new influencers, it might affect them a little bit, but overall, removing the likes will be a good test for the mental health and surrounding the likes and the way that that's affecting our youth.
I mean, do you feel the pressure as someone with a large following? How closely are you watching your likes, your engagement count, and how do you feel the pressure of the platform has impacted you as you were very young, you're still very young,
yeah,
right?
No, I mean, I've really essentially grown up on my Instagram. Yeah. I started at 18, I'm 27, so I think that I've definitely felt the pressure along the way, but I try and just do my job, post my content, act like the creator I am, and then not look at the effects of it.
All right, so let's talk a little bit about Mo Assist. So
yes.
I guess it sounds to me like one of these things where you were getting overwhelmed with how you were going to manage all of the opportunities that were coming your way. What exactly is this tool designed to do for influencers who have, let's say, 100,000 followers, or even 50,000 is enough to monetize?
And that's actually who our target customer has become. So Mo is a project management platform that we built to satisfy the specific needs of an influencer's workflow. So it's an end-to-end solution, everything from project management to invoicing and payments all through one platform. And it really is something that we built to solve the pain points of an industry that's still so new and sort of undefined, but it's a $12 billion industry and growing. So there has never been an office tool really built for influencers that's specific to what we do, and we created that.
What is next for you? Because you've accomplished
so
much at this point. What's next?
Well, I wrote a book that's coming out in the spring, so that's kind of what's next. Shop We Were What is my brand that has overalls and swim, and those have new collections launching soon. I have a watch collaboration launching in 2 weeks. So nothing short of busy.
And I guess when you just think about trying to grow that core We Wore What kind of platform, what beyond just what is next in terms of products, I mean, does it feel like there's another platform that would ever come up? Is it like a traditional e-commerce situation that you want to go
Well, yeah,
into?
I have a Shopify website for We Were What, but I think, there's TikTok and there's all these new platforms, and it's
Are you
important.
on TikTok?
No, but I was thinking about it. I actually did a poll and I asked my Instagram followers if they would follow me if I went on that, and only 20% of them said that they would. So for me, it doesn't make sense to do it, but I think that it's important to diversify the type of content you put out there. So Instagram feed posts versus stories versus IGTV, I try and differentiate that.
Well, and I was looking at your feed. You post a lot on the feed.
Yes, 1 to 2 times a day. If I'm on a trip, then 3 to 4.
How do you decide though?
I have a series of sponsored content and then posts that I have to do that are required, but it's really just what I'm wearing and what I'm doing that day.
All right, Danielle Bernstein of We Wore What, thanks for joining us.
UPS is changing the drone delivery game. The company recently received approval from the FAA to expand its flight forward service. UPS now partners with CVS to make drone deliveries to some private homes. Bala Ganesh is the vice president of Advanced Technology Group at UPS, and he joins us to talk about the future of drone delivery. Good to have you here. You have more than 1,000 revenue generating drone deliveries already. That's key because you've already been paid for this. So let's talk about the thing that gets a lot of people excited. I can call CVS and then it'll come to my home. We're not quite there yet. Why not? Because you've already done a delivery that way.
So we are in the beginning of a journey, right? So there's three things that need to come together to make this reality. The first one is technology, a safe and sustainable technology that can be deployed. Number two is the regulatory environment that puts some guide rails around it. And last but not least, you need the customer needs. So we need to put all these together to get to a future where this can happen over time. Now, what we are starting off is in the beginning process of a journey which says, what are those critical use cases for those customers that would be a good fit for this technology and would fit into this regulatory framework? And so that's where we're beginning in the healthcare space.
And when you look ahead and for future planning at UPS, how important a part of your business is this going to be? Do you have any kind of projections as to what percentage of deliveries, for example, will be made this way?
I think we're looking at, it's very early days. So first of all, let me kind of caveat it that way. There are two pieces we are looking at. The first is as a growth engine, what are the new revenue streams we can create? And the second is what are improved efficiencies we can create for our existing business. For a growth engine, we are looking at the healthcare movements within the B2B or the campus model that we call, which is moving specimen samples between hospitals and labs. We think that's a really good use case because it's life-changing. And then the second is the urgent kind of same-day model, which could be either to businesses or to consumers, like the example we started recently.
Bala, have other retailers approached you about using this technology?
It's going to be a process, right? So yes, we've had a variety of conversations, both with other healthcare providers and also with other people from other industries, not just retail, but also industrial, high-tech, et cetera. The question is, what is the right fit at the right time for the use case? Because the cost curve over time is going to come down, and the regulatory environment is going to expand, and we have to fit in the right customers at the right time at the right place.
So picking up on what Brian just asked you, though, you pioneered the B2B delivery with the medical space with WakeMed. You expanded to, I believe, a hospital campus in Utah. Who else is in the pipeline? Because I know you're talking to several different medical centers, and nobody else is doing what you're doing in that regard. So who else? Can you share names with us?
So let me kind of make sure that we don't jump the gun, right? So there is conversations going on with the FAA to figure out how do we expand from here, right? So there's still a regulatory framework that requires flight path by flight path approval as we expand. So we are having conversations. While we have announced publicly University of Utah is interested in doing with us, we are figuring out the regulatory framework for us to go and deploy it there. That's still a work in progress. In addition, we've also publicly announced companies like Kaiser and AmerisourceBergen, whom we are having conversations with as we move forward. In addition, we have a pipeline with about 50 plus customers that we're working with, trying to pull through into this environment. However, again, I'll make sure you understand that we have to work hand in glove with the FAA and DOT as we move forward because it's still a framework that's constrained by what we can do within the regulatory framework.
And last question for you. Help us understand the time frame. I mean, how many years out are we from a day when this will be not a news story, that CVS is sending me the pharmaceutical or whatever via drone? 5 years, 10 years?
So let me kind of give you some real specific dates that'll give you a flavor. So we're working with the FAA and DOT, this really cool program called the Integration Pilot Program, or IPP. So the way I look at that program, it's a two-way symbiotic kind of relationship where the FAA helps us learn or operate within this environment, and we give back data, we contribute data back to the environment so they learn about what's working and what's not. Now, this program is going to continue till October 2020, where it'll end. And from there, it's going to take some time where they're going to publish some permanent rules going forward from there. which will then potentially come around 2021, which will then start putting some guardrails and roadmaps to what can be done in what part of the country. So that'll give you some specific dates that'll help us move forward.
Bala Ganesh is the Vice President of the Advanced Technology Group at UPS. And we wish all of you, because I know it's going to get real busy in just a few days for the next month for everyone at UPS. So thank you very much and all the best to your team.
All right, a new way of framing finance for women. It's not a chore, it's a form of self-care. That's how we're trying to frame it, and important for your overall well-being. And it's critical that women become more involved in their own financial futures. That's according to our next guest. Holly Newman-Croft is Neuberger Berman Managing Director, and she's joining us now as part of our Women and Money series brought to you by USAA. So, Holly, thank you for joining us. This is an interesting way to frame it as a sort of self-care, because the self-care movement is big right now, so it makes sense. So how do you transform doing the finances of your home into that self-care from feeling like a chore, which it is for many people?
It's not as much fun as a massage,
right?
Or a facial
Exactly,
or something like that. I think it's really important for women to recognize that, statistically speaking, at some point in their lives, they're going to be responsible for their financial well-being. It's really easy to sit back and let your husband, your partner, your father, whomever take control of your finances. But women outlive men, statistically, we all know that. Divorce rates are 50%, we all know that. What a lot of people don't realize is that divorce rates among the 50-plus-year-old couples are rising. And so that all bodes for women sometime in their life will have to take control.
Don't women, and this might be, some kind of urban legend, but don't women actually wind up being better investors because while they're willing to take on risk, they're less willing as men would be to jump in and out and in and out?
Yeah, that's a really good point. So women have much less of a knee-jerk reaction, statistically, of course. Oftentimes men will go to a cocktail party and they'll hear about a home run investment. They'll call their advisor and say, I want to do it. They may not know anything about it. They may not know the risk profile, the return statistics, but they want to hit that home run. Whereas a woman is much more likely to digest it, learn about it, figure out if it fits into her overall financial plan, and if it does, then perhaps make the investment.
So I'm interested in the way you're framing it as self-care. I've read a couple of articles where they talk about where financial advisors are teaming up with mental health therapists, and it's actually a combination where you're working with these two professionals. The financial advisor is saying, hey, this is what you should probably do, and the therapist is helping you get comfortable with making those decisions. Is that what you're thinking of?
I would love that type of partner, but oftentimes I feel my role is dual, some part therapist, part financial advisors, because we're dealing with people who oftentimes are in a life change, whether it's divorce or death. It's unexpected, it's overwhelming. And so I have one client who came to me after a divorce. She was the breadwinner. She had created all of the family wealth. And this divorce just stripped her of all of her confidence. It took us 4 years to have a meeting where she didn't cry. And now every time we have a meeting, it's like a celebration.
I was at an event recently where I heard a woman who, not quite retired, but she was apologizing for her wealth. That blew me away. You rarely hear men apologize for anything, right? But and I wanted to say to her, you got nothing to be ashamed of that you're wealthy. Do you encounter that? I mean, we're talking about helping women grow wealth, but do you have clients who are embarrassed by the fact that they might have a seven-figure net worth?
No, I don't find so much that that's male or female specific, nor do I find that many of my clients apologize for their wealth.
Yeah, I wish everybody to have that problem, by the way.
Yes, exactly. No, that's not so much male, female. Women just tend to lack confidence, but like you were saying earlier, they are proven to be better investors.
And it's not just the confidence that you're talking about. You talk about the 5 lacks: lack of time, lack of confidence, urgency, perceived lack of knowledge, and lack of a trusted financial partner. What do you do about that stuff? Those are some pretty big lacks.
Well, so let's take them one at a time. Lack of time. Many women are working outside the house, even if they're not, they're CEO of their household either way. So sometimes you have 2 full-time jobs, one outside the house, one inside the house. So how do you find the time to take on this additional, what some would view as a burden or a chore? We try to get them to think of it as self-care, but taking responsibility for their well-being. They don't believe in themselves. Statistically, both men and women think men are better investors. That is proven not to be true. So what do you do to get ahead of it?
Right.
Start asking questions. Start talking to your friends, male or female. Talk to people who have similar philosophies, outlooks, risk tolerances. Maybe the person who you go to the gym with or go shopping with isn't the person who you want to ask for a financial advisor, but it might be someone who has similar values and sensibilities to you. You don't have to have the answers before you go to the meeting. You know, I think oftentimes women feel ignored in meetings because the advisor speaks to often the moneyed or the wage earning spouse. And historically, that's not the female. But you don't have to have answers. You're there to learn.
Well,
so,
hopefully
and you're
that
the
is
client.
changing. Yeah. All right, Holly, thanks for coming in. Holly Newman-Croft of Neuberger Berman. Thank you.
Thank you.
Frozen food company Kid Fresh started as a physical retail store back in 2007 right here in New York City. Today, its frozen food offerings are sold at 10,000 locations across the United States. CEO of Kid Fresh, Matt Cohen, joins us now. And Matt, you know, the bottom line here is to get kids the nutritional value. Is it hiding the vegetables and the grains that they need, or is it just being upfront about this is really good stuff and it tastes good?
First and foremost, it's good stuff and it tastes good. Our number one priority is that the kids will eat the product, right? So victory for us, as for I think most parents, is an empty plate, right? So it needs to taste good for the kids. But then secondly, you know, only 1 out of 10 kids in the US today eat enough fruits and vegetables. So there is a big gap from a nutritional standpoint. And it's also very often a battle at the dinner table, right? So what we do is we enhance our products with additional nutrition coming from vegetables. So we hide them, we blend them, and we hope by doing that, you know, helping kids eat more vegetables, but certainly not replacing the real vegetables.
Why do you think that this niche wasn't necessarily being met in the marketplace, right? Because this is an ongoing challenge for parents, right, to get their kids to eat healthy food.
You know, I think it's been too easy for, you know, large food corporations to put licensed characters on boxes of junk and sell them. So why bother, right? But as an entrepreneur, I try to sort of change the status quo here and say, well, we can do better. You can have a great chicken nugget. There's nothing wrong with a chicken nugget as long as it's made with, you know, real chicken, good ingredients, and good stuff.
Why are frozen food sales continue to be so strong? We just recently talked to the Conagra team. They are dominating the frozen food section. Very strong sales.
Yeah, I mean, frozen food went through a decline, right? I would say about 5-10 years ago, it started to decline because it was really packed with junk, right? Packed with junk food, and you know, millennials coming into the marketplace were starting to become more picky, right? But today that has changed. The offering within the frozen food category has dramatically transformed, Kid Fresh being part of it. And millennials are very agnostic. You know, if it's convenient and good for you, they'll eat it.
How do you face the fact that kids have different taste buds? You know, the taste buds have not matured. They like sweeter versus, say, like a broccoli tart, although your kids love broccoli. How do you adjust for that? You don't add sugar, do you?
Oh, no, we don't. Absolutely not.
So how do you deal with that issue? Because their taste buds are not necessarily the same as an adult.
Yeah, I mean, first of all, we have a panel of children that taste our product. moms also, very important. And it's a matter of sort of getting to a taste profile that works for the kids, but not compromising with nutrition. We don't add, absolutely, we don't add sugar. But, we see some other chicken nuggets out there that have added sugar. You look at the bag and they have 3-4 grams of sugar. Why would you put sugar in a chicken nugget? You tell me. It beats me.
Having grown up on Fruit Loops now, but that's another generation. Matt Cohen, Kid Fresh CEO, we wish you continued success and good luck in your upcoming discussions.
Thank you.
Okay, Thanksgiving is almost here, and that means millions of shoppers will be spending on Black Friday, or so we hope, for the health of the economy. Joining us now to discuss the outlook for the big retail names, UBS retail analyst Jay Soul. Hey, Jay. Thanks for coming on.
Hey, thanks for having me.
Do you think it'll be a big, successful Black Friday?
Well, Dan, unfortunately, I think it's going to be an okay Black Friday. I think the data that we get tells us that consumers are going to spend, but they're really prioritizing other categories more than apparel and footwear right now. So they want to spend on their home, they want to spend on travel, they want to spend on experiences. Apparel and footwear is kind of on the low part of the totem pole when it comes to what people want to spend their money on.
That's actually an interesting point because when you look at the broader economy, the U.S. is doing well, the consumer's doing well. So, I mean, what does that say about apparel and footwear going forward? Are we going to see like a total paradigm shift? Or, I mean, the economy's good. It's not like we're in a recession, so.
Right. Well, Julie,
RIP apparel.
What I would remind everybody is that there's major disruption happening right now in retail. The shift to online spending has continued to make the retail marketplace evolve. People are using the internet to find ways to price compare, better than ever. It's a value-focused environment. People want to go to TJ Maxx, they want to go to Ross stores, maybe more than a department store, where they can find a great brand for a low price. And that's something that's really depressing sales. So yeah, the economy is good. People are spending, but the dynamics within retail specifically are making it hard for the companies to get this kind of sales growth.
Those trends about apparel, maybe people are buying plane tickets instead. Now, do we expect that to hold through the rest of the holiday season as well? Because something that's really interesting to me is that sometimes apparel purchases, especially during the holiday season, will be driven by the temperature sometimes. If it just gets really cold, more people will go out to buy winter jackets for Christmas, for example. Have you seen that as a dynamic? Is there any expectation for that in this retail season?
Yeah, Brian, that's a great point because, this time of year when it's cold outside, if it's really cold, people go buy jackets and sweaters at full price, and that's great for retail. But what's interesting is the weather in November has been cold, but we haven't seen that lift to sales, that we would expect to get because of the cold weather. So maybe if December turns out to be also cold, it sort of says that like we shouldn't expect a great boost because, we haven't had it yet.
Yeah, and when we talk about apparel and how things have shifted, most recently, as I understand it, there's also been a major shift in sneakers that I think might not just be about e-commerce. I mean, we hear a lot about how performance sneakers have just struggled for many, many, many quarters now, thanks to the athleisure trend.
Well, you're absolutely right. I mean, I saw Brian's sneakers when I walked in. They immediately caught my eye because those are some really cool. But you know what? That's what it's all about right there. I mean, what he's wearing is totally on trend, but that's not for running. That's just fashion, and it's cool, and that's what people are buying. So sneakers are good when we talk about that casual side.
And I brought up sneakers. Can we get your take? I know you covered Nike very closely and all those other names. There is something going on with Nike, clearly. The CEO stepping down and that being announced on the same day as Kevin Plank stepping down from Under Armour. The full story there, I feel like, still has not come out, but that is just too big of a coincidence. And of course, Nike has had certain cultural issues in the last year that have been heavily reported on. Where do you see Nike right now and headed into the next year after Mark Parker steps away from the CEO reins?
Yeah, so I mean, Dan, it's very coincidental, I think, that the two things that Under Armour and Nike have at the same time. Maybe there's a story there, but I think the important thing with Nike is, there's been a lot of talk about Nike in the news. We really look at Glassdoor very carefully. So the UBS Evidence Lab does a study of Glassdoor on a regular basis, and what we find is we look at over 70 companies in the apparel and footwear space and get employees' sense of satisfaction with their job. And you know what? Nike still remains at the top.
Okay.
So despite all these things that are going on, the feedback, at least on Glassdoor, still continues to be very positive and really no change year over year.
I just want to get your take on what's going on in women's apparel. I mean, I think there are a lot of things. I mean, as a consumer, I'm using Rent the Runway more, not buying as much. So what is your read on women's apparel?
Well, Jill, you just answered your own question. I mean, I think there's a lot of ways for people to buy apparel now that didn't exist 5 or 10 years ago, whether it's Rent the Runway or just buying, off a website like Rebag or something like that, or Fashion File, which is, secondhand goods that can be authenticated and that are strong. A lot of people are more comfortable shopping in the off-price channel. There's a lot of new, Amazon and ASOS and a lot of other competitors coming to the marketplace. There's just so many choices, and really all of them create deflation. And so people are buying fashion, but they're looking for value, they're looking for bargains, and that makes the sales that we see when companies report earnings, look kind of lackluster.
And if I could ask quickly, do people care about malls? Because I just drove past the American Dream not so long ago, and I'm like, I don't know if malls are completely dead.
Right. And yet a new mall also opened right near me recently in Norwalk.
It's
Connecticut.
crazy.
A huge fancy
Maybe
mall.
it's just a Northeast
I
thing.
couldn't believe it. Yeah.
Yeah. Well, the American Dream's interesting because that's not really a mall. I mean, that's basically like Universal Studios with high-end stores attached to it, right? I mean, otherwise, malls across America, they do face a lot of pressure because there's a lot of struggling retailers out there. So if there's about 75 publicly traded apparel and footwear companies, on this New York Stock Exchange, and 15 of them are making zero money. Right, and that represents about $30 billion in sales and about 12,000 stores, and a lot of those stores are in kind of the lower end malls that we have in the country. So those malls are going to be under pressure. Now, that doesn't mean a great mall. I think you're talking about the one in Norwalk, Connecticut, which is really cool, or the American Dream, which is super cool. Yeah. Right, there's still a place for the mall. People still want to have stuff to do. They want to have fun. They want to go out with their friends. But it doesn't mean, but we don't need all the malls that we have. If we have 1,100, maybe we need fewer than that. But it doesn't mean malls are dead.
Yeah. And parking is just awful.
Oh, God.
That's
a whole other thing.
All right, Jay Sol, thanks so much.
Thanks,
really
Dan.
good insights.